Yeah, so in terms of the dot plot, as you know, at the moment it's essentially showing sort of 5%, 5.6% year end this year, down 4.6% end of next year. I think we'll be focusing on, we expect them to remain pretty much the same for this year, given that while we think they'll be on hold, they are still very, very data dependent. The question is, I think, more whether we could see an adjustment to that, but more I think it's, again, next year, what could we see, whether we expect to see, and whether the voting members expect to see rates higher for longer. And as you know, you do expect, at the moment, they're showing a cut of 1% in total next year, but from where they currently think will end this year. But we could see, next year and also further out into 2025 as well. If they expect rates to be higher for longer, then I think that will have an impact.
What has to happen for a 1% cut, Marilyn? What has to happen for 4 cuts next year?
So at the moment, the economic data, I think, has consistently surprised to the upside, both for for the FOMC as well as for many market observers as well. And I think what we would need to see for them to change, or what they're expecting next year, is to see if they were to, maybe reduce their forecast further for next year in terms of interest rates. We would probably have to see more deterioration in terms of economic activity, the US economic outlook. Also in terms of inflation, it has been moderating, it is coming down, but it's still above the target. And so, but I think really what we would need to see is a deterioration really in economic activity, in GDP, in the unemployment rate, in the labor market. And at the moment, we're just not really seeing that in terms of the data.
All right, Anders, Marilyn, sit tight. I want to get over to Mike McKee because, early this morning I thought crude had to be the asset class to watch today. But you look at these intraday graphs and yields are just taking off right now. The Fed obviously headlining this busy week of central bank decisions, with the Bank of England and the Bank of Japan among the others meeting, and maybe the latter being more interesting. But Bloomberg's Michael McKee joins us now for more as we watch. We just saw almost 508 on the 2-year. We're looking at 435 on the 10-year. They're taking off.
They're taking off, and it's because who needs the UN General Assembly, Matt? We've got the Global General Assembly of Central Banks. Not only did that chart show you a few of the people who are meeting beyond the big three, but we have meetings this week for central banks all over the world: Indonesia, Philippines, South Africa, Sweden, Switzerland, Taiwan, Turkey, Egypt, Brazil, Norway. Just the list goes on and on and on. And in general, most of them are going to be looking at raising rates, or at least sounding hawkish, as inflation continues. And now we see those oil prices going up. The big three will get the big attention, however, and rate hike odds, as you mentioned, Matt, are getting a little interesting. The Fed, nobody cares. They don't think the Fed's going to raise rates this meeting. It'll all depend on what Jay Powell says. But the Bank of England is pretty much priced in for another move. And then you take a look at the Bank of Japan. It's been a long time since people really traded on the idea that the Bank of Japan might do something. They don't think they will actually raise rates this month, but they do think that what we're going to see at some point here is them getting a hawkish tilt towards their policy, because inflation has risen high enough. And you can see there that they are going to be the most interesting of them all, because the Bank of England and the Fed have already raised rates so much. Look how far back you have to go to see a movement in the Bank of Japan's base rate. The number to watch, though, this Friday is the dollar. Once we get through this week of all these central banks moving, where does the dollar end up? We've seen the dollar index continue to rise as the Fed has raised rates, and that'll be a signal to the rest of the world about where we are going now. If the world thinks that maybe the Fed has slowed down, then we will maybe see a little bit less pressure on the other central banks. So right now, keep an eye on oil prices going into the week. At the end of the week, let's see where the dollar is.
Yeah, we're looking at $92 now for WTI, West Texas Intermediate on the NYMEX, $94.84, so near Zammit to $95 for Brent. What do we look for in the dot plot, in the SEP? I think we get that this time, in the face of rising oil prices.
Well, we're probably not going to see a whole lot of change, Matt, because we don't know how long those rising oil prices are going to, A, continue to rise, and B, how long demand is going to hold up for gasoline prices when they start going up. So the Fed can't really forecast that. But look for the dot plot to still retain the idea of one more move this year because they don't want markets to start pricing cuts. And then look for the summary of economic projections to suggest we may have a little bit stronger growth and a little bit less unemployment than the Fed had forecast going forward. We'll want to see what they say about inflation as well.
All right, absolutely. I hope we don't hear the word transitory, though, even in relation to oil. Mike McKee there with a look ahead at this busy central bank calendar. Sticking with central banks, Nouriel Roubini delivering a warning to the BOE and the ECB. Take a listen.
The problem is that the Bank of England right now is sending sort of dovish signal in a situation in which the policy rates are well above the Fed, but inflation is well above the United States. So what they should be doing is actually hiking rates all the way to at least 5.75. The signals are telling us right now is they're not sure whether they want even to hike more. If that happens, there could be a de-anchoring of inflation expectation. You could have a true stagflation. That's a dilemma for both the ECB and the Bank of England.
Marilyn Watson and Anders Persson back with us. Anders, let me ask you your take on the other central banks. I mean, how close are you paying attention to what happens at the Bank of England, what happens at the Bank of Japan, considering that the Fed has been driving policy globally until now?
Yeah, no, at this point, you definitely have to pay attention to all these kind of key central banks for sure. I think, certainly the Fed is still setting the tone more or less globally, certainly here for the U.S. But I think all these data points are important. I think Bank of England, I think, is probably in the most tricky spot right now. Most central banks, we do expect, as Michael mentioned, as the market is expecting one hike here coming to 5.5%, and maybe one more after that as well. I mean, it's just a very tricky environment going on in the UK at this point, more broadly. The Bank of Japan is probably going to be, a little bit less influential here for the near term. I think the market has already kind of accepted that the yield curve control is playing through a little bit here, and I think overall that's been fairly well messaged in the market at this point. So all in all, I think the focus will quickly go back to the Fed and potential next steps that the Fed's going to be doing in the November timeframe.
Marilyn, what's your take? I mean, everyone's excited about the Bank of Japan because it'll actually, potentially do something interesting and different. But does it matter as much?
So it does matter. And I think in particular, it does matter increasingly going forward as we do see the Fed get to the end of this rate hiking cycle. And then we look at the divergence in terms of the economies, the economic activity of the different regions. I mean, we're seeing increasing divergence between the US economy, the UK certainly, the Eurozone, and then Japan, again, is in a very different situation. So I think it does matter, and it will matter increasingly as we do start to see, this divergence in terms of when central banks get to the end of the hiking policy, but also in terms of economic activity, prices, valuations, and then where investors can find opportunities globally, in the different regions and in the different, financial asset markets as well. So I think as we do see, the Fed potentially pause and get to the end of the cycle, I think it does matter, and I think it matters for investors to be able to really be nimble and really get at the different opportunities that we'll see as we do see, a dislocation potentially between market pricing and the opportunities for investors.
All right, looks like we bounced off 148 yen to the dollar with greenback strength continuing, but maybe that's a level to watch. Marilyn Watson and Anders Persson are sticking with us, joining us now with a look at the stock market ahead of the opening bell. Here's Abigail Doolittle. Abigail?
Well, Matt, we do have U.S. futures lighter by just a little bit. Let's take a look at what's weighing, starting out with the shares of PayPal, down about 1.7%. This as MoffettNathanson has downgraded the stock to a market perform from an outperform as the growth out outlook slows. Lisa Ellis is saying that profit growth will remain anemic and EPS growth is slow as PayPal is facing fierce challenges. Tesla had been higher earlier in a Wall Street Journal report that Tesla and Saudi Arabia are in early talks for an EV factory, but with yields higher pressing big tech down. Ford down 0.8%, along with Stellantis. This as the UAW strike is in its fourth day. So a little bit of soft stock action this morning, Matt.
Yeah, very interesting developments on that front. A 21% pay rise offer pushed aside at Stellantis by the UAW. Thanks very much, Abigail. We're going to talk more about the union coming up unmoved by this sweetened offer.
So 21% is a no-go for you?
It's definitely a no-go, and we've made that very clear to the companies.
U.S. auto workers extending their strike to a fourth day. That conversation up next. This is Bloomberg.
Die Welt zu einem besseren Ort zu machen, das treibt uns Menschen an. Ob im Beruf, in unserem Zuhause, dem Auto oder auch beim Kaffee am Morgen. Wir möchten unser Leben verbessern. Es geht dabei nicht nur um uns selbst, sondern um alle, die uns wichtig sind. Und genau das treibt uns bei Bayer an. Unser Ziel? Health for all and hunger for none. Mit Hilfe der Wissenschaft kämpfen wir gegen lebensbedrohende Krankheiten. Wir wollen, dass alle in eigener Verantwortung mit ihrer Gesundheit umgehen können. Wir wollen eine Landwirtschaft, die alle ernährt und dennoch die Erde schützt. Wir wollen, dass jeder Mensch die Chance auf ein besseres Leben hat. In einer Welt, die wir mit Stolz an nachfolgende Generationen weitergeben können. Bayer.
So 21% is a no-go for you?
It's definitely a no-go, and we've made that very clear to the companies. We're prepared to do whatever we have to do, so the membership is ready. The membership is fed up. We're fed up with falling behind. It's been decades of falling behind.
UAW President Shawn Fain rejecting the latest pay raise from Stellantis, the automaker calling the offer a compelling solution for protecting jobs at an idled Jeep plant in Illinois. The disagreement signaling, though, that the union and Detroit's Big Three are still pretty far from a deal 4 days into the strike. Bloomberg's David Welsh joins us from Detroit. He's our bureau chief there and has been covering this very closely with his team. David, you know, we focus so much on the pay part of their demands, but the union has asked for a lot more than just a 36% pay increase at this point. They also want to bring back defined benefit pension plans, and I believe they're still sticking to a 4-day work week. What's the status of the demands from the UAW?
Look, they still want those things. The companies, if you look at their offers, that stuff's never in there, particularly the retiree stuff. They've even asked for retiree health care. Those are the two big ticket items that just weighed down the balance sheets of all three companies, played a role in driving GM and the former Chrysler into bankruptcy. Ford had to borrow $24 billion to stay out of bankruptcy. They're not going to do that. The companies will take a very long company-wide strike before they would agree to those, fixed retiree benefits. They are willing to move on pay, obviously. They're already up over 20%. And I think they'll continue to bump that, not interminably, but they will. That's something they can play with. But those other retiree benefits and the 32-hour work week, I don't think they'll budge on either one of those.
In terms of the damage this could do to companies, when you think about handing out a 21% pay increase to so many tens of thousands of workers, you might worry that it bankrupts GM, Ford, and Stellantis. But they've done well, and it's not actually a huge part of the cost of a car, is it, labor?
No, I've seen estimates. It's somewhere between 5 and 10% is the cost of labor. There's a lot of other labor in there from the suppliers, but they wouldn't all be getting 20% raises. So, yeah, it will bring their costs up. It will bring their labor costs would definitely be uncompetitive with Toyota, Honda, Tesla, Hyundai, and Kia. They'll be in a worse position. But there are two things. One, it's not the kind of money that bankrupts the companies. It eats into what are now very good profits. And two, you know, these other companies, and we've seen Toyota do it over the years, they've had to raise compensation and improve benefits to keep the UAW out of their plants. You can't be at a $5, $8 labor disadvantage versus a UAW contract and expect your workers to not maybe listen when a union organizer comes around. So union contracts do, and they have, raise all boats. Now, they've always stayed, you know, something under what the UAW can get to maintain the advantage, these other companies, but they will end up having to pay more as well if they want to keep the UAW out of their factories.
Yeah, it's a very interesting point in terms of the competition, and it'll be interesting to see if a win here for the UAW can actually get them into some of those competing plants. David Welch has been covering this. We'll continue to. Obviously, the big story, I would argue, not just in Detroit, but nationally right now. Marilyn Watson and Anders Persson are back with us, and let's talk about how this strike could translate into the fixed income world that you guys are so focused on. Marilyn, clearly it's going to drive up compensation, so there's the concern about a pay wage spiral, you know, driving inflation further. Is that the only connection that you can see?
So I think it certainly, you know, highlights the strength of the labor market at the moment. And I think in terms of the fixed income market in the long term and what that means, also when you look further down the line at monetary policy as well, I think one of the factors to really bear in mind is that the US has an aging population in terms of demographics. You're seeing, you know, many people becoming of pensionable age. You have a workforce that, you know, you don't have the same supply in terms of younger workforce. And I think we'll continue to see these pressures for some time in terms of, we've already seen the last couple of years, particularly since COVID, you know, just how strong the labor market has been, how there's still a deficit in many areas in terms of getting the number of employees in different sectors back to pre-COVID levels. We've seen pay rises, you know, across the board in most different industries. And so I think, you know, in the long term, it just really highlights the fact that it is an aging population, that the economy is still very strong at the moment. And we've already seen this in other sectors where we have seen wage rises.
Anders, obviously wage price spiral is the phrase that was eluding me there. It doesn't seem that monetary policy is really holding that back. What connections do you see with the fixed income world that you run at Nuveen?
Yeah, no, I would echo those comments, basically. I think the broader dynamic here is more key here, that the labor market remains very tight and wage pressures really haven't eased sufficiently. I think the Fed's going to keep a very close eye on that. And you know, more broadly, these kind of type actions and discussions is going to put pressure on wage prices and inflation moving forward overall. That being said, I think it's important to keep in mind that you know, from a credit perspective, we're not expecting these discussions to really put a whole lot of pressure on these issuers. You're seeing bonds and stocks and CDS, for instance, holding up just fine for GM and Ford and what have you. So it's been pretty well flagged, and we're not seeing much deterioration from that perspective. So I think investors, you know, they basically appreciate that this is an uncertainty, but you know, this industry and this sector has come a long way and is pretty well positioned. And so I think there's a balance there that we're trying to make sure that we're kind of basically taking into account at this point.
All right, Anders, thanks so much for joining us. Anders Persson there from Nuveen, Marilyn Watson joining us from BlackRock. Pleasure having you on the panel today. Coming up, the morning calls, and then later Morgan Stanley's Andrew Sliman joins us, making the case for an equity rally in the next quarter after this September lull. That conversation still ahead. This is Bloomberg.
Just an unbelievable place. It's a cultural oasis, and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
Time now for our morning calls. A look at some of the analyst recommendations on Wall Street that could affect the market this morning. First up, MoffettNathanson downgrading PayPal to a market perform, expecting softer EPS growth due to mounting competitive pressures there. Next up, Guggenheim upgrading Ralph Lauren, or is it Lauren, to a buy, seeing an attractive entry point with shares 14% down off of this year's peak. And then finally, Deutsche Bank upgrading Micron, the chip maker, to a buy, saying recent checks point to improving chip prices and strengthening demand for that sector as well. Coming up, Morgan Stanley's Andrew Slimin on why he expects stock to rally heading into the year end. That conversation up next. This is Bloomberg. This is the countdown to the open. I'm Matt Miller for John Farrow. We've got equity indexes moving down for the big caps, not so for the Russell 2000. You've got an all-star lineup of bell ringers at the NYSE and the NASDAQ moments away from the start of trading. Here are the opening bells. One stock to watch at the open, we're going to get to in just a moment. Here you see the euro dollar at 106.69, the 10-year yield. That's really the stock to watch, is the 10-year yield, I think, or the price of oil. Both of them soaring to highs that we haven't seen in months, if not years. 435 almost on the 10-year. NYMEX crude at 91.86. So there you go. Former Vice President Al Gore ringing the bell at the NASDAQ. One stock to watch at the open, I was going to say Apple. Shares edging higher as pre-orders for the new iPhone 15 surpass expectations. Bloomberg's Abigail Doolittle is here with more on Apple. Abigail?
Well, Matt, it's interesting because there's a little bit of a mixed picture in terms of these pre-orders. Let's save the bullish picture for the end to end on a bright spot. But there are a couple of analysts out there saying that these pre-orders for the iPhone 15 might be a little bit flat. In particular, Barclays is saying that the early pre-order data point that China continues to point to a difficult iPhone 15 cycle with a negative mix shift, meaning trending toward the lower end phones. Bernstein saying historically Apple, the stock, has treaded water a bit after these iPhone launches. That is true right now. We have Apple breaking down to some degree, down more than 9% or around 9% in this quarter. Although today we do have Apple up 1.1%. So let's get to the positive. Morgan Stanley saying that the early iPhone 15 pre-order data is good. And Wedbush going even further, saying that the trend is toward the higher end phones and that it could be 10 to 12% above the iPhone 14 orders. Most important, Matt, I think to some degree are the numbers. This company has been showing over the last few quarters negative growth for both top and bottom line. The first quarter of their fiscal 2024, which is the December quarter, is expected to show a return to growth. If they can have that growth for the December quarter, well, Apple might come out of its recent doldrums.
All right. Abigail Doolittle there on Apple. Let's turn to the media space right now. Disney holding preliminary talks with potential buyers for its India streaming and television business. Bloomberg reporting Disney is weighing strategic options for the business, including an outright sale or setting up a joint venture. Plus, heck, we've had so much news on big asset moves over at Disney. Let's bring in Bloomberg's Ed Ludlow from the West Coast here in New York.
Yeah, good morning. Good morning to you, Matt. Disney modestly lower, 0.3%. What Bloomberg sources are saying is they could take the Disney Star property in India and sell it outright, or they could do more of a piecemeal approach where they take the sporting rights that are India-based and the Disney Hotstar regionalized streaming platform, put them in combination. As you said, Bloomberg had also reported first in July that forming a joint venture in the region is an option. It's interesting because one of the parties in talks, according to Bloomberg sources, is Mukesh Ambani's Reliance Industries. That goes back to Disney losing the rights to the Indian Premier League cricket in that nation. Where did those rights go? They went to a JV between Mukesh Ambani's Reliance and also Paramount. So now Disney looking at his options, an outright sale potentially, a joint venture, or a more piecemeal deal where specific rights and properties sold off. By the way, the stock's off to 0.2%. It was initiated at Raymond James this morning with an outperform. And their argument's basically like it's been a horrible time for media companies. But beyond that, cash flow looks good, valuations look good compared to the rest of the sector.
All right, Ed, thanks very much. Ed Ludlow there taking a look at Disney for us. Now, a cybersecurity incident that affected Clorox last month has been contained after addressing the unauthorized activity. The company saying the attack damaged portions of the IT infrastructure, which caused wide-scale disruption of Clorox's operations. The company now believes the impact will be material on Q1 financial results. Simone Foxman here with more. You'd rather hear marginal there than material, wouldn't you?
I think you would, and it's unclear, the company says, if this will actually weigh on its full year guidance as well. And that's why we're seeing shares fall in today's trading, now down about 1.5%, weakest since early February. But more details of this cyber attack is really that it's continuing to have all these impacts on operations. The company saying it's operating at a lower rate of order processing and that customers are feeling some of the impact of product availability issues. It damaged the IT infrastructure that the company has. And I think this is really concerning as well. The company isn't going to be able to move back to its normal automated processing for orders until the week of September 25th. So we're not already back where the company should be. Now, this will have a material impact on the Q1 financial results. That is the quarter that ends in September 30th. But the company saying, again, it's premature to look at the year and potentially see an impact there. Bloomberg Intelligence saying that this is really a concern for the company as it tries to transition from this price hike-led sales growth to the volume-led sales growth, has the potential to weigh on margins, and that's clearly being reflected in trading today. Matt.
All right, Simone, thanks very much. Clorox down 2% at the open. Let's turn to the IPO market, stories around which have been very hot lately. Online grocery startup Instacart has been flirting with an IPO for years now, and it's finally taking the plunge, making its trading debut tomorrow. Bloomberg's Shonali Basak has more. Shonali?
Matt, you're looking at Instacart, which will price tonight, start trading tomorrow, as you've been saying. And last week, after the successful ARM IPO, Instacart and its bankers went ahead and increased its price range. Now, at the high end of the price range, you would have a company worth more than $9 billion, almost $10 billion. And while that's below its most recent funding round, where it was valued at about $13 billion, the name of the game for the IPO market is no longer high flying. The new game in town is smooth sailing. So you do have these companies now looking to set expectations, make sure that they're making it into the market with a popular IPO pop. These pops, as we saw with ARM, could be muted at first, but you saw ARM continuing to hold steam into the next day of trading. Now, one thing Instacart has on its side so far is the cornerstone investors that it has lined up. Even though the market is watching the story on margins moving forward on Instacart, you do have PepsiCo coming in as an investor into the IPO, as well as cornerstone investors that could take up 60% of the shares. That includes a division of Norges Bank and Dan Sundime's D1 Capital. Now, do those names give the market enough heat to buy into the stock? One thing these firms have in their favor is timing. They're all coming ahead here of that big Fed decision on Wednesday. They're trying to get a calm market into their debut. Klaviyo, the following day, has also increased its pricing range. Will price tomorrow night, trade Wednesday.
All right, Shonali, thanks very much. Shonali Basak there on IPO Watch. Let's get to Morgan Stanley's Andrew Sliman right now. He has been making the case for a rally in the fourth quarter, writing, quote, underweight to equities will likely become more painful into year-end. According to consensus estimates, earnings are likely to inflect from negative or flat in 2023 to positive in 2024. Investors should greet the resumption of positive earnings growth warmly. I'm pleased to say Andrew Sliman joins us now. Andrew, great to get you on this. As we start to see all of the bears throw in the towel, has every last one capitulated, and wouldn't that make you nervous?
Sure. Well, it's one thing to say that you've turned from bearish to bullish. It's another thing if you put your money where your mouth is. And if you go and look at fund flows on a weekly basis, that follows from funds and ETFs, they remain negative on a weekly basis. And that is very symptomatic of the early stages of a recovering bull market off a bear market low, where investors are sellers. It happened in 2020 off the March low. It happened in 2009 off the great financial crisis low. Investors sell into the rally. That is consistent with the first stage of a bull market. Eventually they capitulate and they turn back and go in, but that hasn't happened yet. So it's one thing. Sentiment is one thing. I watch what people do with their money. I think that's much more significant.
That's exactly, well, it's paraphrasing what Alan Greenspan, I believe, said, Andrew. In terms of valuations, what's the best measure to look at? Is it still, forward PE, and where do you put that?
Well, what Wall Street is classically overconfident in is their ability to predict earnings. I mean, it is yet again this year has turned out to be a better earnings year than what many on Wall Street predicted. So what I watch much more is revisions and what companies are saying versus what's expected. And you know what? That's turned out recently to be better than expected. So that number for next year, the consensus is somewhere just below $250. That's come up recently. And so I think that's more important. There's no question that interest rates weigh on multiples, but I think in a recovery earnings, we're going to get a rally first and then ask companies to deliver on what's expected next year. So I suspect this year will turn out to be an even better year for equities than next year.
In terms of the headwinds, are you concerned about, the consumer seems to be putting a lot more on plastic. Default rates on credit cards are rising. Same is true with auto loans. Student loan payments are going to resume. Oil prices, we're looking at $92 a barrel now for WTI, 95 for Brent. Households have run out of excess savings. I mean, the bearish list could go on and on and on, but I'm not sure how you feel about it.
Yeah, I mean, many of those statistics are what the bears throw out, but really has the household run out of excess savings? I mean, energy as a percentage of a consumer's expenditures continues to drop. Am I worried that the Fed is raising rates, interest rates moving higher tends to deter economic activity? Of course I'm concerned, but I think the story is that it's very hard to know when that will occur, and the simple reality is the consumer and corporations fixed a lot of debt during COVID so that they're less interest rate sensitive than they've been in the past. Doesn't mean it won't have the same effect. It just will take longer. And I think that's really what the story is. The inverted yield curve is telling you there's a slowdown out there. It's not very good at telling you when. And I take comfort from the fact that we keep pushing out the first Fed cut. I don't want a Fed cut because that's a sign of the economy weakening. The fact that we keep pushing that out, the fact that the 2-year yield remains high tells me the economy is stronger than what many people predicted.
What sectors do you like, Andrew? Because we've obviously seen most of this year's rally supported by only one, not even one sector, just a handful of companies. Do you see a broadening out? Do you like something besides tech here?
Sure. Well, but yeah, I mean, I like growth and I don't like value, or I don't like value, I like growth. I think you want a combination. What is clear, and again, consistent with the first leg coming off a bad bear market, is the worst performers are the defensives. And lo and behold, that's because, last year the market went down, defensive stock, consumer staples, utilities, etc., healthcare, they held up the best. And so what do investors do at the end of last year? They all piled into dividend-paying strategies. It was the #1 selling strategy last year, and yet that's lagged this year. So I think you want to have a combination of growth, technology, and value, financials, energy. And right in the last month or so, energy has really done very, very well relative to tech. So I suspect going into this fourth quarter, you'll get money coming back into many of these well-known cap names because they're liquid, they're easy to buy, and I suspect that their quarterly earnings won't disappoint.
Andrew, great to get some time with you. Thanks so much for joining us. Andrew Sliman, they are coming to us from Morgan Stanley. Coming up, GOP tensions looming over a potential government shutdown.
I want to make sure we don't shut down. I don't think that is a win for the American public, and I definitely believe it will make our hand weaker if we shut down.
Our team coverage up next. This is Bloomberg.
I want to make sure we don't shut down. I don't think that is a win for the American public, and I definitely believe it will make our hand weaker if we shut down. I gave them an opportunity this weekend to try to work through this, and we'll bring it to the floor, win or lose. I believe we'll get agreement this week.
That was House Speaker Kevin McCarthy speaking yesterday as tensions rise on a possible government shutdown. House Minority Leader Hakeem Jeffries saying, quote, "The House Republican civil war is hurting hardworking American taxpayers and limiting our ability to be able to solve problems on their behalf." Let's bring in Bloomberg's Kayleigh Lines in Washington for more. So, Kayleigh, it looks like the Speaker making some pretty adult statements there. Is the class going to listen?
Well, this is the question, Matt. We are now just 13 days out from a potential government shutdown, and so it was a working weekend for House Republicans. We do have on the table now a deal between two very key factions, the far-right House Freedom Caucus, which includes many of the members that are giving Speaker McCarthy a headache on this issue, and the center-right Main Street Caucus. They have a deal that would temporarily fund the government for 31 days, so through October 31st. The issue is, even if it can pass the full House, which remains a massive question because Speaker McCarthy is going to have great difficulty getting enough members in line with only a 4-vote margin of error, it wouldn't necessarily pass a Democratic-controlled Senate or be signed into law by the Democratic president, Joe Biden, who would have to sign it once it comes across his desk. The reason why is this measure that they have agreed to would include an 8% cut to domestic agencies funding everything basically except for veterans and the military. Also includes some measures on the border, like resuming construction of a border wall, making it more difficult for migrants to claim asylum in the U.S. It also doesn't include any funding for Ukraine or disaster aid that the Biden administration has asked for. So it's likely a non-starter if it can even get through the House of Representatives. That said, the Rules Committee is going to take it up today. They're planning a full floor vote in the House on Thursday. It's just not really clear that this measure is going to get us any closer to averting a government shutdown. And Matt, the clock is ticking louder and louder.
Absolutely. Kayleigh, thanks very much. Kayleigh Lines there covering all things Congress for us out of Washington. Turning now to foreign affairs, National Security Advisor Jake Sullivan met with Chinese officials in Malta over the weekend, discussing a possible November meeting between Presidents Xi and Biden. The White House writing, quote, "This meeting was part of ongoing efforts to maintain open lines of communications and responsibly manage the relationship." This coming just ahead of the UN General Assembly here in New York City, which she plans to skip. Bloomberg's Anne-Marie Horton is in New York, and she joins us now. So, AMH, what do we know about, who's not coming to this meeting and how, we're doing communication with our with our foes and allies in other ways?
Well, that's right. I think what's interesting about this UN General Assembly, or as everyone likes to call it, UNGA, is the meetings that are happening not here. So Jake Sullivan over the weekend sitting down with Wang Yi in Malta is almost a breakthrough, I would say, in the meetings we have seen and the outreach we've seen from the U.S. administration to their Chinese counterparts, because this would really be the meeting that could set the tone and the agenda for a Biden-Xi bilateral meeting, which potentially could happen before the end of the year at the APEC summit in San Francisco in November. Then you have Wang Yi on the heels of his meeting with Jake Sullivan going to Moscow to sit down with Sergei Lavrov. So obviously there's going to be a swapping of notes, I imagine Wang Yi will take from Sullivan to Lavrov. So that's one of the interesting developments around this UN General Assembly. We also have President Volodymyr Zelensky to be attending UNGA in New York City. And while he will meet with individuals here and he'll give a speech, more importantly is going to be his meetings that take place later this week in Washington, D.C. Of course, he'll be at the White House. He will go to Congress. How does he convince Republican lawmakers that at the moment are still unnerved and concerned about sending more taxpayer dollars to Ukraine, that they should pass that bill. Remember, the U.S. administration, the White House, asked for in a supplemental spending bill more Ukraine aid. And what Kayleigh was just talking about, that Ukraine aid was missing from that CR that the Republicans were discussing last night in a phone call.
It's amazing that, so many people are skipping not just Putin and Xi, but we saw there Macron and others in the Western world who are our allies not coming. Is the UN kind of dropping in its level of importance?
Well, that's a great question. I think every time you have these big UN General Assembly meetings, the question remains, is the UN obsolete? I mean, Zelensky has said that the Security Council should be dissolved and the whole thing needs to be really redone, because Russia stands on the Security Council while the UN writ large has condemned the war in Ukraine. They really can't do much about it when you have Putin sitting on the Security Council. So it's a big question, but at least this forum does provide an area and an arena for a dialogue.
All right. And we're glad to have you here in New York. Anne-Marie Horton, thank you very much for that. For some of the sector price action this morning, let's get over to Bloomberg's Abigail Doolittle. This market just opened 22 minutes. Abigail, what do you see?
Well, we have a very small decline here for the S&P 500, Matt. And from a sector standpoint, not a lot of drama here, as John would like to say. On bottom, real estate, utility. So as yields go higher, the dividends of those sectors look less attractive. Up top, communication services, energy getting a bid once again on oil strength, tech also higher. Now, interesting, Andrew Sliman earlier was saying that into the end of the year, he expects this rally and he would like a diversified growth value portfolio. That's actually what's happening over the last month. You can see tech, energy, financials, utilities, a little bit of everything there for anybody, all higher. It's going to be interesting to see whether this trend will in fact continue into the end of the year.
Yeah, absolutely. Although I think even Andrew said September is, not the strongest trading month historically. We know it's the worst, and he expects that trend to continue. Abigail Doolittle, thanks very much for that. Coming up, the market-moving events you need to be watching out for. That's next in our trading diary. This is Bloomberg.
There's a place where global markets are always open, where you can explore and discover innovative new offerings and hundreds of trading products right at your fingertips. That's CBOE, the exchange for the world stage.
This is Bloomberg's The Open. I'm Matt Miller, in for my good friend Jonathan Farrow. Quick look at the markets as we stand 25 minutes into the trade. We're looking at the NASDAQ 100 up about 0.1%, the S&P 500 down about 0.1%. It's time now, though, for our trading diary to show you what you should be watching all this week. President Biden speaking at UNGA, the UN General Assembly, tomorrow on Tuesday. On Wednesday, we get the Fed rate decision and a news conference from Chair Jerome Powell. Then the BOE announcing its decision on Thursday. Plus, we'll get U.S. jobless claims and existing home sales on that day for the U.S. of A. And finally, on Friday, a BOJ rate decision. This was the countdown to the open. I'm Matt Miller for John Farrow. This is Bloomberg.
China's economic model, which is driven by investment, is all about growing GDP at almost any cost. The thing is, Xi Jinping, the Chinese president, isn't exactly playing by that playbook right now. He's intentionally downshifting, holding back from doing more to stimulate the economy. Do you understand Xi's ideology, and do you think it'll work?
Well, I think that Xi Jinping is a change from the leadership we saw prior to him coming in 2013. previous leaders since Deng Xiaoping really put economic growth first and foremost. And with Xi Jinping, I think it is more about party ideology and things like national defense. It's a much more muscular China than we've seen in previous decades. And this raises sort of the global risk level of what happens if the economic model falters. And we see some sort of other efforts, whether it's increased defense spending or foreign adventures, to distract the Chinese populace from what's going on with the economy.
Okay, we can get to that a little bit later on, but I want to talk about the cost of the economy for now. Do you have a sense of how bad China's credit losses could get? Because I've heard one estimate of up to 42% of GDP from 31% last year, not just in real estate, but across other sectors too, like technology, for instance.
Well, we saw this once before. When China entered the WTO in 2001, they had to clean up their banking system. Now, back then, the debts were mostly to state-owned enterprises. But when all was said and done, about 40% of the loans were bad. Now, that number would be horrific because China is so much more leveraged today than it was back then. I don't know. We don't have a number on what we think losses as a percent of GDP would be, but certainly that's in the ballpark, the numbers you quoted. In fact, if anything, that might be a little bit low. So it's a bad problem. And it's the real problem with the economic model, Scarlett, in that if you never write off the bad investments, right, your GDP is inflated because you're borrowing money to put up another airport or another high-speed rail link that's uneconomic. And that resides ultimately in the banking system with the debt related to that. And so that's the inherent problem with the investment-driven economic model. Sooner or later, the diminishing returns on these investments begins to make a difference.
Do you think other people, though, have woken up to that? I mean, we're still talking about a nation that still has a lot of foreign direct investment despite some of the challenges as of late.
Well, I think people have figured out the risks. Well, when we turned bearish on China back in early 2010, I think the New York Times ran not one but two op-eds ridiculing the call. And so, it was just after the Beijing Olympics, and China was unstoppable. And I think now people realize it's a little bit more accepted that this investment-driven model has real risks. So, look, I mean, China, we get tarred with the brush that we think China's going to be in smoking ruins, and it's not. No. It's going to have to downshift its economic growth, and it's going to have to make a transition from this model to a more traditional model if it's going to keep growing at a reasonable rate. And that's why we think the speed bumps that'll occur when they try to shift to a consumption or service-driven model will be more severe than people think.
It doesn't seem like much of a shift just yet, but I am curious with regards to Western investors maybe dialing it back just a little bit here. Is that because of the economic model? Is that because of the economic decisions, or is it more tied to some of the political decisions and social decisions?
I think it's two things. I think you've hit it right on the head with the political risk, and tied in with that is governance risk, because Western investors have rediscovered the risks of the so-called VIE structure, which is the structure that Western investors have to use to invest in Chinese entities, because direct investment is basically prohibited. So we have the situation where if you buy stock in Alibaba or JD.com on the New York Stock Exchange, you're buying shares in a parent company sitting in the Caribbean, which has an economic agreement with the underlying businesses in the People's Republic. And if anything goes wrong, you have very little recourse to the assets inside the People's Republic.
So when anything goes wrong here, people look for a Fed put. They look for the Federal Reserve to ride to the rescue. What will it take for the Beijing put to kick in?
So I've always said that there's two things that Western investors count on in the last 10 years, that central banks will ease and China will stimulate, right? So every time we see a slowdown in growth, the call comes for China to spend more. The problem is you're just kicking the can down the road. And as I've said a couple of times, at some point the can kicks back. And if you have a bloated more and more debt in the banking system, more and more of the debt is being used to pay the interest on the old bad debt. And inevitably, that can't last.
It can't last, so that's why people do expect some kind of big bang stimulus. Would a big bang stimulus or the current drip feed of targeted measures that we're getting right now present a better opportunity for investors like you?
Well, again, we're not investors in China, so let me be clear.
But you could be betting against in different ways.
Oh yeah, of course. And so I think that stimulus is expected. I think that stimulus does nothing but just, in effect, add to the debt problems. I mean, in effect, if you have investment, 40 to 50% of GDP every year, you're always stimulating. Literally, once you finish a building or a bridge or a rail project, you have to put up another one, because the GDP drops off immediately once it's completed. And this is the inherent problem with the model. You just constantly have to be sticking a shovel in the ground. And sooner or later, the returns on the marginal project just don't justify the amount of capital put in.
Scarlett mentioned that you were supposed to testify at this House Select hearing, and we know that most of the Congress people, at least the ones at this particular hearing, are concerned about the economic linkages and the political linkages. The idea here that if the economy is weakening, as most outside investors seem to think it is, despite what the official numbers tell you, that this could exacerbate some of the political and, more importantly, some of the military issues that I think we're all fearing.
Yeah, I saw a report today that someone respectable pointed out that they thought Chinese defense spending was much higher than the sort of official $300 billion figure. That it was much closer to $1 trillion, and that would put its spending as percent of GDP higher than the U.S. So this is concerning certainly members of Congress and the administration, I think, as well as other countries in and around the area.
But what's concerning is that you can't give that number, and I don't know anyone outside of China that can give you a reliable number on that or the economic data. I thought the whole entrance to the WTO, the embrace of some modicum of capitalism over there, was to create more transparency around what's really going on there. And yet I feel today, here in 2023, I probably know a little bit less about what's going on there than maybe what I knew, I don't know, 15 years ago.
Well, I think it gets back to your political risk question, which is, I think the country has gotten less transparent in the last handful of years as Xi Jinping has increased his grip on power. And so towing the party line and making sure there's no bad news becomes paramount, as opposed to getting the amount of information that other investors need to make decisions.
You mentioned earlier China's foreign adventures. What do you think policymakers underestimate about the linkage between China's efforts to transition its economy, the challenges inherent in that, and its foreign adventures like saber rattling in Taiwan?
Well, I mean, I think that there's a myriad set of risks there. Just the general amount of defense spending. China's increasing its spending on its Navy, for example, to make a blue water Navy. And so all of these issues raise alarm bells for our allies in the area, Japan, Australia, Philippines. But what I worry about is a miscalculation. Right? Things happen in this world, and history tells us things can happen. And you get an incident where someone, fires a missile they shouldn't fire or whatever, and suddenly you have a crisis. And what we don't want is this Cold War, which seems to be growing, becoming a hot war. And as more and more planes and ships are in this congested area, sort of trying to claim sovereignty or exercise their right of passage, the chances of something bad happen. And I think that's something that everybody should worry about.
There's also a Cold War on trade and on economic relations between the two countries. Do you think Congressman Gallagher's committee and its work on the Chinese Communist Party will have any influence on the field of finance? Will this scrutiny lead to any changes in the way that Wall Street or financial people think or behave?
Well, I mean, I would like to echo some of the things that Jay Clayton said in his testimony. I think that one place to start would be reforming some of the rules that Western investors invest in and through Chinese instruments like the VIE's accounting standards. I mean, that's sort of my world, and I feel comfortable in saying that should be tightened up. And I think that the whole idea that you're investing in shell companies that the Chinese, by the way, the Chinese courts do not recognize. It really is problematic, and I think that some reforms there would go a long way.
Yeah, I think Archegos found that out the hard way. I am curious, though, how much do you think China needs at this stage Western investment, external investment? You talk about this idea of them becoming more of a consumption economy, sort of turning inward, something Xi Jinping himself has said explicitly here. Is that realistic?
Well, the good news in all of this is that the cross-border risks right now are not huge, right, in terms of banking problems transmitting into Western financial institutions. It's basically equity and debt investments direct through pension funds and mutual funds, ETFs, and others. You know, it's a couple $1 trillion. It's not. It would not be the end of the world. On the other hand, you would notice it. I think that the real issues are going to be internal to China. That's what I'm more worried about, and how China deals with it internally without necessitating more Western direct investment. I think they can get by without more direct investment, but they like it.
They certainly like it here. But it gets to the idea that if there are problems there, you know, everyone wants to know about the contagion risk. As much as it could potentially be contained, we're still talking about a behemoth of an economy, not just in terms of the dollar, the value of its in size, but also just its reach. I mean, the amount of investments that it's made in so many other emerging market nations throughout Africa and Latin America and Asia as well.
Commodity demand.
Yeah.
Think about that.
Yeah.
And so, of course. I mean, China is inextricably linked to the global economy, and will be in ways we don't even, fathom yet if something should go really wrong. And I tried to keep my remarks to the committee really attuned to the economic model and the financial implications. But sure, I mean, there's broad ways in which China is connected both directly and indirectly to the global economy that would pose some risks.
Do you think the comparison of China to Japan that we saw 30 years ago, the slow bursting of the Japanese bubble, is that a valid comparison?
I think it is. I mean, I used to have a slide in one of my presentations that say, "Who am I?" And I had this list of sort of attributes: directed economy, reliance on real estate markets, right down the list. And people thought I was talking about China, and it was really Japan in 1989. And we know what happened, right? Japan kicked the can down the road for so long that it had 30 years of its, hollowed-out economy. And so there are some parallels. Obviously, there's lots of differences.
Yeah.
Japan's a Western democracy and had an open currency account would be the two biggest differences. But, in terms of the economic model, Japan was running investment around 30% for years. And finally, paid that price. And by the way, the Asian tigers in the 90s had investment levels above 30% for about 4 or 5 years before that faded.
A lot of people are wondering whether we'll eventually see a decoupling of the Chinese economy with global financial markets. What do you think?
Well, I mean, the Chinese market has been a terrible place to invest for the last 10 to 20 years. The Chinese economy, if we believe the numbers, has quadrupled in size, and the equity markets are flat, maybe even down a little bit. And so it's been a terrible place for Western capitalists to invest, by and large. Obviously, there's some individual issues that have done well. But broadly speaking, you were well advised to avoid China for the last decade.
You spent a lot of time talking about China, but I do want to talk about kind of the hype mill right now around artificial intelligence. Certainly, there's got to be some substance to what we've been hearing over the last few months.
Oh, I think of course there's substance. It's a technological advancement, and there will be companies that clearly benefit. But what everybody forgets is that in these leapfrogging moments for technology, there's as many losers as there are winners.
Well, let's talk about that, because everyone's drawing comparisons to kind of the dot-com boom, right? We had kind of at the end of the 90s, early 2000s, the internet became this thing. And we know there are a lot of companies that never really made it out of the graveyard. Quite a few companies that are stars today, like Apple and Microsoft and the like, that sort of came of age in that space too. Are there not parallels now?
Well, there are. And to my point earlier is that when the internet came, any business that was in the business of selling something that was analog that became digital was in trouble. think about companies like Eastman Kodak.
Yeah.
Right?
I cover that company well.
Film went to digital. And so their entire business model collapsed. And if we're seeing the same kind of situation with AI, there'll just be entire industries that are affected positively and negatively. And I think it's too early to tell. I mean, that's the thing. We're in that nirvana phase now where everything benefits from AI.
Yeah. But everybody's throwing money at it right now.
Oh, that's Wall Street. You would expect everyone to throw money at a hot story. Come on.
Everyone's thrown money at Tesla for a number of years now. You've called it the it girl of the pandemic rally, post-pandemic rally as well. Is there an it girl of the AI bull market?
Oh, I suspect it's probably NVIDIA, which had the monster earnings back in May and again in August. So I would hesitate to say that there's something that's even more of an it girl for AI than NVIDIA. Might be out there. I don't know it, though.
Okay, so NVIDIA is possibly the it girl at the moment, but the previous it girl, Tesla, you are still short on, but using options, yes?
We are. We're short the stock, and we just think it's ridiculously overvalued.
Right, but betting against it has not worked out yet. What do you think would
I've noticed.
Right. What do you think would prompt the market to be convinced of your take that Tesla is just a car company, nothing more?
Well, again, the Tesla story keeps changing, right? Every few months, the Tesla faithful trot out it's batteries, it's robo-taxis, now it's AI. And I'm a little bit bemused, having followed the company as long as we've been following it, that Tesla sort of admitted just recently in its full self-driving effort that it had been pursuing sort of the wrong avenue for 7 years, and that it's now going to a different type of software development for the next iteration of full self-driving beta. And so I'm just sort of wondering, this technological leader just told you that they basically were doing the wrong thing for 7 years.
Yeah.
Now, my problem with that is they've been selling it as a product. They've been selling full self-driving since 2016. It doesn't exist. And so, this is, but this is a company that has gotten a wide berth from regulators in all facets of its.
It's gotten a wide berth from investors too, particularly amongst the retail set. And I am curious. I mean, as someone, as a short seller, and as someone who's been doing this for so long, you've seen how the execution of a short trade has changed. At least how, to a certain extent, it's become harder, right? I mean, you can't necessarily do things as much out in the open as maybe you could have, I don't know, back in the WorldCom or Enron days. How much harder is it to execute that?
Well, I think you also have to watch your position sizing. We use options, as Scarlett indicated. The options market has gotten dramatically more liquid since 2019 than it's ever been. When I did Enron back in 2001, Enron's options were illiquid. It was an $80 billion market cap company, and the option market was fairly illiquid. Today, I have shorts on our books that are $2, $3, $4, $5 billion market cap companies where the options are more liquid than the shares. That's a big change.
That is a pretty big change. One of your big shorts since last year has been data centers, and I know that we talked a while ago, you were also bearish on commercial real estate even before the March banking crisis. How are data centers similar to commercial real estate?
Well, data centers are basically seen as REITs. In fact, they are in REIT form for the most part. And so real estate investors have been gobbling them up recently because of AI, to get back to Romaine's issue. And so people are assuming just automatically that the legacy data centers will benefit from future AI demand. The problem is AI hastens the obsolescence of the old data centers. That is, the infrastructure that's in the guts of an old data center is not compatible with the new AI architectures. And you don't have to believe a short seller. You can see what Meta has written about this and other observers have talked about in terms of changing the architecture that the hyperscalers, Amazon, Google, and Microsoft have told you. This is going to be a whole new set of data centers that are needed for this architecture. architecture. And so the data centers trade at 80 to 100 times earnings, and the earnings aren't growing. And in some cases, the companies have negative free cash flow.
Yeah.
So it's not exactly a safe REIT. And we don't even think they're really real estate companies, Scarlett. We think they're technology service companies. And if you look at the financial statements, you would see that the returns on capital are really low, and they're heavily leveraged.
There's a place where global markets are always open, where you can explore and discover innovative new offerings and hundreds of trading products right at your fingertips. That's SIBO, the exchange for the world stage.
Good morning. Happy Monday morning. It's 9 a.m. here in Hong Kong, in Beijing, and in Shanghai. Welcome to Bloomberg Markets China Open. I'm David Ingles with Yvonne Mack.
Our top stories this morning, a risk-off start to the week with the rush of upcoming central bank decisions in focus, including the Fed and the Bank of Japan. Fresh test for embattled developer country Garden, with deadlines looming for both yuan and dollar bonds, and a Xi-Biden meeting on the agenda as U.S. National Security Advisor Jake Sullivan and Chinese Foreign Minister Wang Yi met in Malta. So, yeah, that was a bit of a surprise meeting there, so certainly we'll see if that lifts the mood in any way. But, yes, a lot of questions about the data that's looking a little bit more positive now. Can we really see sentiment improving on from here? But this week, right, 36 hours that we're talking about central bank action. And we got plenty more on tap with Country Garden, too.
Yeah, so there's a vote today. There's the Evergrande story, of course, and the police, of course, and some of the wealth unit there. They're at 9:30, in about 30 minutes from now, local time, we have, of course, the winding up hearing of Logo. So that's sort of the property part of the conversation. Logan, yeah. And the reason I bring that up is everything almost was good except for property prices.
Yeah.
On Friday, right? So that's certainly a conversation we'll be having, of course. Oh, we have a star-studded lineup in the next few minutes to talk about all these things.
Brought in the best of the best, right? And this was actually their idea, mind you, I would say. But I think it was a great one to bring in Monica Xiao from Triada, also Johanna Chua from Citigroup, to really talk through all these themes that we've been talking about here. The Battle of the Titans, we're calling it today.
Yeah. They love each other so much that
they want to battle each other.
This is going to be epic to watch. In a couple of minutes, before we get to that, though, let me just sneak in a status report of these markets right now. As Yvonne is pointing out, risk off, big drop on Friday. Japan is closed for, I think it's coming of age day, if I'm not mistaken. Yeah, there we go. So no cash treasuries today. Down about a fifth of 1% right now. Flip the boards, please. So we're looking at materials and also oil, and we'll get to oil in just a moment because oil's still pushing higher. So we're flat on that. Singapore's coming online. I think we had some we had exports numbers coming through, apart, of course, from F1, which was, of course, the big headline over the weekend there. 1% lower in Taiwan. Bond markets down 11 weeks in the last 13, government bonds, that is. You look at the Bloomberg gauge. These are Treasury futures, as Yvonne is pointing out, 36 hours of central bank extravaganza awaits us, of course, from about Wednesday. Currency markets, dollar yen, I believe, is still at the highest so far this year. That's really gone the opposite way when you look at dollar China, and I think the yen is down about 7% against the renminbi this year so far. And just very quickly here, we mentioned oil. Just have a look at where we are. See, oil and the oil contract in China just coming online right now. There we go. And iron ore price is just coming off. And at 2.4% down, we're still above 120. So that really gives you an indication of how far some of these contracts have actually run up.
Yeah, here comes consolidation. I mean, it was about time, it seems, just given this run-up we've seen. All right, let's bring in our panel now of guests. Johanna Chua, Chief Asia-Pacific Economist at Citi, and Monica Xiao, Founder and CEO at Triada. Monica, I'll start with you. Obviously, we've been seeing the data showing some early signs of life now in China. Can the mood continue to be more positive from here, you think?
So from my standpoint, although the activity data picked up, as you mentioned, I think property is still an area that is pretty gloomy. And I still believe that because property has been a mainstay as sort of a pillar of GDP growth for so long, that still is an area that I think matters the most. And also, from my perspective, the activity data, it's one set of data. And so we need to see that sort of on a sustained basis. And that really remains to be seen. On property side, it really, I think we are looking at pretty dismal numbers overall this year. And, we saw in August the property prices are actually falling.
Yeah.
So this is really all feeding into general sentiment that we're still pretty concerned about.
Any early signs of a rebound? What do you think?
No, so yes, we are seeing a little bit of a kind of cyclical rebound. But, I mean, as Monica said, right, real estate is such a big drag to the economy. We've had huge shocks to private sector aggregate demand. Our thesis has been that policymakers will chronically underdeliver the amount of policy support needed to narrow the output gap and bring it to at least to close the output gap. So we're going to have pretty low inflation deflation. So actually my concern is, there's always a little bit of a mini cycles in kind of the long-term structural trend. So the fact that data is looking a little bit better, if anything, that probably suggests policymakers are going to be more reluctant. Like, for example, this week, we're not expecting any LPR rate cut. We've actually removed our rate cut call from PBOC. We don't get a sense that policymakers are going to be even more kind of motivated or driven to do additional policy support, especially on consumption and private sector. So again, the lingering long-term story is still there. But in the short term, I think, there's definitely signs more on the manufacturing side that, you have this destocking cycle, you get a little bit of a cyclical bounce. Yeah. The other thing we're looking for is on the infrastructure side. So the data was still a little bit weak in August, but we had very extreme weather events. So the expectation is maybe, because they're asking the local government to front load all the bond issuance by September and implement the projects to October. So it looks like the government's going to lean more to look at traction on infrastructure to provide a little bit of aggregate demand support. But again, on the consumption side, I'm still a little bit wary. On the real estate, there's obviously still a lot of stresses. So, I think that situation will continue to rear its ugly head again after we're past a little bit of the cyclical bounce.
Citi had a dividend of a non-consensus call on where policy goes next. I think the majority of the economists that we've been talking to saying, look, monetary and fiscal needs to be more forceful for the remainder of the year. You're thinking it could be more of a wait and see from policymakers. Well,
I think it should be, but what I think they should do versus what they will do is different.
Okay.
So I don't really get a sense from PBOC standpoint, given their desire to stabilize FX, their desire to protect net interest margins of the banks, because they're using banks as an instrument of national service to support the economy. I don't get a sign that their policy stance is moving towards aggressive interest rate cuts. And on the fiscal policy, it's more kind of delivering on this year's policy rather than adding more to that. Yeah. Certainly, I'm not getting any signs of sort of direct consumption support at this juncture.
Yeah, I mean, I would actually point out that also on the retail side, yes, there was a bit of an uplift, but if you look at the composition, a lot of this is services, which actually relates to travel, and that travel bump has sort of like passed now from the after the summer. I do expect that they could do another triple R cut, but that probably will be sort of more normalization and stabilization of liquidity for banks. So I do agree with Joanna that there needs to be a lot more in terms of a coordinated effort between fiscal and monetary, and we haven't gotten hints from the government that they're ready to do that yet.
Well, can we at least find consensus between the two of you that rates will remain lower for longer in China? Let's start with you.
Yeah, I think that's an easy one.
Absolutely. I mean, we're targeting 10-year CGBs, for example, to head lower to 2.3%.
Wow. Okay.
So that's,
because that matters for the carry trade, right?
Yeah. Yes. So I think because everybody expects lower for longer, and I think in addition you have the headwinds of stronger dollar. And that staying, I think, you're going to have at least a couple quarters of pretty firm dollar, then that, directly sort of feeds in still with a secular trend of weakness for CNH.
It brings to that whole question about the investability of China. We've seen, despite the data turning a little bit more positive, foreign outflows are continuing to be net selling, right, for 6 straight weeks
almost
now.
Every day since the start of August.
What can you say about that question on the credit space overall?
So I think the credit space, if you look at on the high yield side, it remains to be seen when we're ever going to be able to have the markets open to a new issuance again. I don't see that. in the foreseeable future. I think the outflow, a lot of that has already happened, and also just by force, just from the sheer number of issuers that have, collapsed. Country Garden still is in the balance. In the meanwhile, end of last week, Sino-Ocean has stopped making payments. So I think there's going to be more defaults to come, and by defaults, again, I include, any distressed restructuring or forced acceptance of consents. The outflow, I think we are already seeing from local investors, local long only, already sort of reallocating. Overall, I think that it's very clear that the outflows will, in my mind, continue through, I think it affects credit sentiment even when we continue to see the numbers from the A shares, from Hong Kong Stock Exchange as well. That is, the one consensus everybody has is, stay away from China for now.
Yeah, well, just to follow up on that before I bring Joanna back in, the legal enforceability of some of the issues right now in offshore, in the high yield space, because that's your wheelhouse. You're not seeing any good information at this point in time to jump back in?
So, I wish we could return back to the, old ways of looking at fundamentals, that there is a price for everything. Unfortunately, there isn't a price for everything in this case, and that's been the hard lesson for all of us doing fundamentals here, especially for China high yield. I think the issue is that for the, 2-3 years now that we've seen this suffering in high yield, and through all the defaults restructuring, we haven't seen one precedent that has been a good case study, for everyone. I think everybody at one point last year thought maybe Evergrande would be a case study. Unfortunately, we don't have any good precedents to demonstrate not only a result of recovery, but more importantly, the process. So we don't have a clear framework, and there's been a lack of enforceability both onshore and offshore. So what you see on paper isn't something that you can rely on in a normal way. And so I think very firmly we put China back into emerging market, maybe even towards frontier now as far as analysis of high yield goes.
Yeah, and the 30,000-foot view here, to your point, is you have small cyclical rebounds amid a structural decline. The Japanification of China, whether these are symptoms of a balance sheet recession, let's start with you. Where are you in that conversation? Are we?
Yeah, so let me first clarify. Of course, it's not exactly like, everything's a little bit different. It's not exactly like Japan. But when I mean Japanification, it's this economic condition where output always kind of falls below potential or hovering below potential.
Well, no, inflation.
So you've got a prolonged period of low inflation to quasi-deflation. And when I say Japanification, there's a level of persistence to that. And that persistence is kind of a symptomatic of the balance sheet stresses and future expectations about future growth prospects. And in those definition, I clearly think China's already headed towards Japanification. And I think, obviously there's a little bit of difference between China and Japan. So on the liability side, China and Japan both had a significant buildup of leverage associated with the real estate cycle over the last decade up until the peak. But where there's a little bit of a difference, what we're seeing is that in Japan, asset prices really ballooned and then collapsed. And then the ramification of the collapse of asset prices amplifying through the banking sector was what created a protracted downturn in kind of 2 lost decades in Japan. In China, it's a little bit different, only to the extent that we had a preemptive deleveraging on real estate ahead before we even got to kind of the bubble territory. So they're cutting new supply significantly in the hope that you get further, you're faster towards price discovery of equilibrium. So you don't have a big collapse as before. Now, the challenge to that is, I think, as you try to control supply on preemptive deleveraging, you're also controlling demand, you're also destroying demand at the same time. And the lack of countercyclical policy support to offset that income shock. And you did it during pandemic, you did it during so many private sector regulatory shock. So there were so many things happening to demand at the same time, which really created this pressure. Now, maybe the difference between Japan and China is because, in Japan case, the banks really got a huge hit in terms of insolvency, NPLs ballooning. In China, because of the more, kind of muted decline in asset prices and stronger balance sheets of the banks, you don't have that same kind of pressure. Nonetheless, I mean, the behavior of private sector in terms of, being very precautionary, being very cautious, that's very similar.
in terms of that's why you're seeing a lot of, kind of reluctance demand for consumption and lots of preference for liquid precautionary savings. And there's a lot of other similarities in terms of policy response. Like in that environment, when you're worried about this big shock and chronic shortage of private sector aggregate demand, you also have a big decline in future growth expectation that I think you're also seeing in China. Like demographics are deteriorating even to some cases faster than Japan. People are aging before they're even rich. You've got a lot of productivity growth shocks because of all the regulatory uncertainty on the private sector, not to mention that the geopolitics in China is a lot more complicated with the US than it was with Japan. So that really is driving level of kind of deteriorating optimism, deteriorating kind of more pessimism. So my worry here is the policy response. I mean, when you look at the amount of rate cuts we've seen, very little. So real rates, expected real rates is still too high relative to what is the equilibrium. So people in China are just happy to put their money in deposits and safe assets. And this will continue until something changes. But my worry is kind of similar pattern. The policy response has been quite, incremental.
Monica, what needs to change then? What could resolve that?
I think it is a matter. So in my mind, between China and Japan, the difference is that China, I believe, for as bearish as I sound on China high yield and credit market, I do actually think that there's still room if they choose to use it. So first, you do have China still having some growth. In Japan, when, the bubble burst, they didn't have a lot of room there. In order to control asset inflation, they had to keep raising rates. We're in a lowering rates environment. There's still some room in terms of policy, in terms of reserves. There have been people who've even written about an additional shadow reserve. So I think, there's a certain amount that China still has in terms of leeway and tools. I will, say that in terms of price discovery, there is a bit of a difference also with China, where we have seen stories in the primary markets where prices were not allowed actually to lower by so much. It was, controlled. So I don't think we have a real price discovery just yet. It's probably if it were a totally free market, the prices would probably be down even more, frankly, onshore. What needs to happen is really something that is a Fed-style bazooka that we saw out of the GFC, frankly. And I think you really need a type of stimulus that isn't just about selecting which industries. You can't just be focused on EV, semiconductor, hard manufacturing, or biotech. I think what you need to do is to really put money in the hands of the consumer, and unfortunately that doesn't really jive with the thinking of the regime.
All right, so still some ways to go between the two of you. Round one is done. We'll have more. More is coming up.
Nah, it's been very friendly.
Can't believe it's only 60 minutes into Monday here. Joanna Trott from Citi, Monica Hsiao will be rejoining us in a couple of minutes. RMB fixed of the days out. There you go, bottom of your screen, 717, 36. That's, Yvonne, you want to do the math? That's below 1,000 pips. It is, yeah. Oh, what are we doing?
Yeah, okay, let's just do it. It's just another day of strong support.
Yeah.
I'm sick of doing all the math. No, you do it for yourself.
One stock we're tracking as well, Singtel over in Singapore. This deal, of course, KKR buying a stake in data center. We'll have more on this, by the way. We'll be joined later on the show by the CFO Arthur Lang in about an hour from now. Counting down to the open of trade, just 13 minutes away. The opening bell here in Hong Kong, up in Shanghai, and in between in Shenzhen. This is Bloomberg Markets China Open. Good morning.
Die Welt zu einem besseren Ort zu machen, das treibt uns Menschen an. Und genau das treibt uns auch bei Bayer an. Mit Hilfe der Wissenschaft verfolgen wir unser Ziel: Health for all and Hunger for none. Wir wollen, dass jeder Mensch die Chance auf ein besseres Leben hat. In einer Welt, die wir mit Stolz an nachfolgende Generationen weitergeben können. Bayer.
There's a place where global markets are always open, where you can explore and discover innovative new offerings and hundreds of trading products right at your fingertips. That's SIBO, the exchange for the world stage.
Yep, it is going to be a busy sort of central bank week, of course, with the Fed to kick things off on Wednesday. But then 36 hours of that, right? Basically, most of the G10, if you look at beyond the Fed, are likely could actually hike. The likes of the BOE, SMB, Norsbank, all that. Then we got the BOJ to kind of wrap things up here. Given all the confusion we had with that way to print article and about talking about negative rates and lifting out of it for next year, he clarified that a little bit late last week. So we'll see if that has any sort of, this meeting, is it really going to be that important for yen?
What was that Leo DiCaprio movie where they plant the seed of some, what's it called, the title?
Inception.
Inception, yeah. Kind of, he snuck that in with that report, and maybe just
the market,
and then we'll see, right?
Yeah.
All right, let's bring our team back in here. Joanna Chua still with us here, Chief APAC Economist at Citi, and of course Monica Xiao, Founder and CIO at Triada Capital. Central banks, I don't know where to start. Are we almost done with hikes? Let's start there.
It depends which central bank you're talking about. But
well,
yeah,
everyone.
For the most central banks, yes. I mean, I think we're expecting, this week Fed is going to be on hold on Wednesday, but we still have one more hike in November. We've got 4 European central banks. All of them are expected to hike 25 basis points. Bank of England, Riksbank, Norges Bank, and Swiss National Bank. Yeah. Out of the 4, I think we think 3 out of the 4 is the last hike. There's one more that will have a few more hikes. Interestingly, in Asia, we have 3 central banks. We have BI, BSP, and Taiwan CBC. All of them are expected to be on hold, which is pretty much telling you a little bit of the divergence, because a lot of central banks in Asia have basically been on hold for a long time, right? Even as others still incrementally tighten.
So yeah, I agree with Joanna that I think now it's not, for me, it's not so much about how many more hikes if the Fed hikes, but my opinion in November is it's still on the table. It's 50-50 probably. But I think what's more important is what people are saying and the message that's coming through, because I think for the other countries, for the most part, it's really about, if there's a hike, it's a dovish hike. And then meanwhile, I expect the Fed to pretty much keep their dots where they are around there and still talk as though that they will leave room and will consider another hike. The U.S. Economy is, still going strong. We're really seeing still this theme of U.S. exceptionalism.
The House view, though, for Citi is still calling for a recession in the U.S.
Well, at the moment, that's more into going into next year.
Okay.
So we actually still embed one more rate hike in November. But even though we're calling for a recession, I have to say our economist is putting, kind of more evenly distributed probability distribution around different outcomes. Like we have to have a base case.
Right.
But there's also a decent chance that we may have a delayed recessionary outlook. And we have a non-negligible probability we could have a soft landing. So obviously we acknowledge the latest data coming out of the U.S. The narrative seems to be more supportive of a little bit of a softer landing, but it's just that based on historical evolution of how we get to a 2% inflation target, in order for us to see wage growth slow down, we really need to see more meaningful softness in the labor market, which will lead to a little bit of a recession.
Okay, bear steepening, that's been happening. Does that continue?
So again, because we still have the baseline scenario of a recession, if you look at our rate strategist, I don't think that is his base case view that, this kind of bear steepening we have at this moment is kind of capped out. And then we actually expect eventually 10-year yield to be well anchored. But again, in the short term, that seems to still be kind of what the market seems to be talking a lot about.
Monica?
Yeah, look, we've come from on 210s. If you look at, where we have come from since I last was on the show, it was around 100, and we've come down to around like 70. I do think that will continue for now. Now, that type of bear steepening is also because it's around the story of U.S. Engine of growth continuing. So that said, I think that what I agree with Joanna on is that usually there's a lag effect. And so in terms of the higher rates and higher for longer feeding through, eventually, there's a good probability something will break. On this inversion, I will point out one thing: the 210s inversion. It's actually pretty unusual, the U.S. compared to the rest of the world.
Hold on, Monica. We have some breaking news now. We've got to check Evergrande shares right now. In that pre-market, you're starting to see things really go down to the downside here. You take a look at how the news that we got over the weekend was police detaining some staff at the Evergrande Wealth Unit. More than one employee was taken into custody here. and police are calling on investors to provide leads now on what is going on in that wealth unit. The stock's down close to 10%. Country Garden, of course, we're still waiting for two things. There's a dollar bond that's due, also voting for it to extend one of those yuan bonds, also due later on tonight as well. We got plenty more ahead. This is Bloomberg.
Die Welt zu einem besseren Ort zu machen, das treibt uns Menschen an. Ob im Beruf, in unserem Zuhause, dem Auto oder auch beim Kaffee am Morgen. Wir möchten unser Leben verbessern. Es geht dabei nicht nur um uns selbst, sondern um alle, die uns wichtig sind. Und genau das treibt uns bei Bayer an. Unser Ziel? Health for all and hunger for none. Mit Hilfe der Wissenschaft kämpfen wir gegen lebensbedrohende Krankheiten. Wir wollen, dass alle in eigener Verantwortung mit ihrer Gesundheit umgehen können. Wir wollen eine Landwirtschaft, die alle ernährt und dennoch die Erde schützt. Wir wollen, dass jeder Mensch die Chance auf ein besseres Leben hat. In einer Welt, die wir mit Stolz an nachfolgende Generationen weitergeben können.
Right, good morning. We're just under 4 minutes away from the opening bell. It looks like we're going to get losses here at the open.
Yep, it looks like it. Some news of Evergrande, of course, being detained, some of these employees. Of course, we have Country Garden, two major tests happening on this Monday as well. We're already seeing quite a bit of movement in the property space. We got the open coming up next. This is Bloomberg.
Good Monday morning, just over 40 seconds to the opening bell. It's generally risk off across these equity markets today going into this open. Just keep in mind Japan is shut, so you don't have trading in cash treasuries. There's a lot of event risk on the table. We talked about this, Yvonne, this 36 hours of central bank decisions, but ahead of that, there's lots to get over.
Yeah, they may not be live, especially when it comes to the Fed, but certainly it might set the tone for what policy expectations and settings are going to be for the remainder of the year, right? Those dots are going to be very front and center, those economic projections this time around, for not just this year, but next. Certainly one to watch there for the Fed, and then there is that China discussion once again. Now that things are looking a little bit better on the data front, can we continue to see the mood music improve from here? Today, unlikely, it seems, just given what we're seeing across futures and, of course, what Hong Kong is doing. The news of Evergrande, employees being detained in the wealth unit, that certainly is leading to some negative headlines out there. And that's why we are seeing quite a bit of red across the board here this morning. And even, when it comes to dollar China, we're still seeing a bit of stabilization there, that strength of 728 or so. But yeah, you take a look at, where we are from where the net selling was, the peak of this year. We're basically seeing global funds selling half of those Chinese stocks purchased in 2023. So basically 6 straight weeks of net selling from foreign investors here when it comes to those northbound flows. So we haven't seen that sentiment turn too positive just yet. Take a look when it comes to, sector by sector, what we're looking at here. So it's like consumer staples, real estate, everything basically in red, except for Macau gaming, which is only just barely above water here this morning. Hang Seng's down about 0.7%. We're just teetering around the 18,000 level here right now. But we are seeing a little bit more moves when it comes to the 8 shares here this morning. And of course, it is still the dominant theme and still the weak part of the economy, property. Evergrande shares down close to 15% here right now on news of where we are. This may signify some sort of new phase of Evergrande here now that we're starting to see more people being detained in that wealth unit here. So we're still looking for more questions on that. And of course, Logan Group, there's a winding up petition in Hong Kong here today. Country Garden, dollar bond that's due. Also, when it comes to that yuan bond, they've extended that deadline to extend that down payment 3 times already. We'll see if we get any sort of outline here today. But yeah, there you go. CSI 300 dropping to the lowest level this year. In terms of individual movers we're watching out for, of course, it's the property space. It's also when it comes to some other things, airlines, for example, in China. Given just kind of where we are in this kind of pent-up demand, the summer travel season is showing some pretty interesting numbers here when it comes to the airlines. Guys, do we have that board? I think it was more than double in terms of from year on year when it comes to passenger traffic, the like here. Also, when it comes to Meituan, there was a line that was basically talking about how much they've been selling those iPhone 15 on Meituan. I believe it was pretty remarkable. Can we show that strap? I believe it was.
How much was it?
I was trying to look for it for myself.
Not that I'm interested. But.
No, but just goes to know there's a lot of demand for the iPhone 15 in China. There you go. 28 million in 30 minutes in terms of sales of the iPhone. There's also a buyback for Miniso as well here in terms of the shares, Dave.
That's amazing. 28 million. If you could only use that. And imagine paying an iPhone. Maybe some of these coupon payments due might sort of disappear. Anyway, speaking of that, as Yvonne is pointing out, so developers are very much in focus still. It's extremely busy this Monday. Just to give you a sense of what the agenda looks like. So you have a vote on Country Garden. That's a local currency bond. There's a debt where there's a coupon payment. That's a dollar bond, I believe, here. Should be starting any time now. And we will get you the headlines on that if we do hear anything on that winding up here in units of Logan. Let's bring in fact, the king himself, Kevin Kingsbury, our Bloomberg China credit editor, who, of course, has been very busy, him and his team here. Let's start things off with Country Garden.
Sure.
What do we know on the two issues?
So we have this $15.4 million coupon that's effective due date is today. There is a 30-day grace period for that. So like we saw in August with the $2 bonds that weren't initially paid then, we're liable to see probably another move into the grace period again, just kind of give themselves, they have these extra 30 days to use. And so we've seen builders again and again increasingly use this extra time to gobble up whatever cash they need to in order to do that. And we have this third vote deadline for this yuan bond. This bond isn't due until late October. So conceivably, this bond vote can get extended several more times between now and then.
Theoretically. Okay. The other big story, to which Yvonne was talking about there, police detaining some of the staff at an Evergrande wealth unit. Yes. What is that about?
Well, it's they had some missed payments recent months that they announced. It obviously isn't involved directly to the business of building homes or making property, the home construction there, that we don't really, it's not key to the company itself, but it may have an impact with the defaults and the restructuring plan overall, because it's just one more question that the bondholders have to face as far as whether or not they're going to go with this bond plan later this month.
Very quickly, Logan units, what do we know? What's happening today?
We have a latest hearing today for winding up hearings for 2 units. Okay. We've had this, it's before the same judge who has issued winding up petitions against several other smaller developers. Okay. Now, if there is a ruling in favor of the plaintiffs in this case, it's related to getting money from the units to the creditors. So that's where this is all about ultimately.
Kevin, thank you so much. Great stuff to start us out. Of course, fresh trading week. Kevin Kingsbury. Yvonne, our China credit editor there.
Yep, let's bring in our next guest, Kelly Chen, VP and Senior Analyst at the Corporate Finance Group of Moody's Investors Service. Kelly, interesting that you had a recent revision, right, where your outlook for the property market has basically changed. It was stable just 4 months ago, now revised negative. What's changed in your eyes?
Oh, thank you, Yvonne, and thank you for having me. Yes, we did just change, our sector outlook for property sector. This obviously, has something to do with our expectation of the contracted sales. That's the key reason behind the outlook change. At the beginning of this year, post-COVID lockdowns, we actually did see some very notable rebound of both economic growth and also national contracted sales, and we had then expected contracted sales to stabilize for this year and then to come slightly above 2022. But entering into June in the past several months, the rebound has been losing steam clearly, and it's now much weaker than we previously expected. A couple weeks ago, our in-house, GDP forecast for China's growth next year was actually lowered to 4% from 4.5% previously, and that's reflecting the weakening momentum of economic recovery post zero COVID policy. And obviously, slowing economic growth and income growth would have a negative impact on household spending and households consumption, and housing as the largest ticket item for households. So against this backdrop, we're not optimistic that we'll see a notable or sustainable rebound of national contract sales from where we're standing at. We now expect it will continue to decline for the next 6 to 12 months, and driven largely by economic uncertainties and also home buyers sentiments on income and employment prospects, and all of these factors would weigh on households' spending appetite and housing demand.
Right. Kelly, David here. So that's one part of
Hi,
where some of these developers get their funding source. What about the other side? Some of the measures that the government's tried to introduce to plug some of the funding issues. What do you make? Where are we in that conversation?
Yes. Well, first of all, we think, the policies that we've seen in, recent policies, we think that is a significant policy shift from the government to boost property demand. This is very different from, what we've seen since end of last year. There were 16 measures, the so-called 16 measures, trying to ease the funding risks for the developers or alleviating their liquidity pressures, for the developers, but not so much on housing demand. And this round, it's about lowering funding costs for home buyers. So it's clearly more, focused on the demand side. And also, these policies to lower down payment ratios or to broaden the recognition of the, first-time home buyers so that, they would be eligible to have a lower down payment ratio, and then eventually, lower, funding cost. And, these are the policies that have been rolled out from the central government level, rather than, previously, I think in the majority, part of last year, what we've seen has been one city, city-specific policies, and, under the framework of one city, one policy. So it was not unified policy measures from top down, and this time it's different. So obviously, from these measures, we do expect that near-term contracted sales will be boosted. There will be a rebound because previously lease demands were suppressed, and now it's been released, and they will be met in the market. But the question always comes down to sustainability, and from our negative view, you can tell that our view is that we don't think this policy impact will last. We think it will fade away after a few months, because as I said, we think China's economy recovery still faces multiple challenges. So a sustained or rebound, would not happen until
so what
we
about
see
when it comes to default risks then, Kelly? I mean, is that much higher now despite the policy easing we've seen?
Well, I think that's there's a positive elements from the policy supports but there's also against that there's still declining contract sales from issuer or developers perspective, especially the weak ones, the privately owned ones. They continue to face declining contract sales. They continue to face very limited, very constrained funding access, and when they have a lot of debt fall due, and that will create mounting pressure on their liquidity, and therefore increase their liquidity risk or default risks. So we consider, we continue, we continue to expect, there will be more defaults coming this year, although it will not be, as much as we've seen last year.
Okay, and that's the good news, even if it's not too obvious. Kelly, thank you so much. Kelly Chen there, VP and Senior Analyst at Moody's Investor Service. Let's continue the conversation here. Still with us here on set, Joanna Chua, Chief APAC Economist at Citi, and Monica Xia, Founder and CIO at Triadic Capital. You have some really good insights, Monica, on where these policy support measures around the housing market, where they're probably most felt, which is in Tier 1 cities, which is a very small part, really, of the total housing market.
Right. So a lot of the recent policy easing for housing is really going to help Tier 1, which comprises only about 15% of the total. And I think that all these are also trying to ease on the demand side. But the reality is you can lower the ratio of down payment, you can reduce mortgage rates. But the reality is, sentiment-wise, are you going to step out and buy a house if you have no visibility on the prospects of your employment and the income stream? The other part I would say about property is that these measures are, just really, I think, trying to boost a bit of sales in order to help liquidity of the developers to finish projects. I don't really see these measures as big enough to help revive the developers. And in particular, one part that we talk less about is really on the supply side. On the supply side, the developers simply are so cash strapped that there's no real land purchases. And so we're looking at, so far, land sales has dropped by 20%, and any of the land sales that has been made mostly has been done by SOEs. It remains to be seen that the SOEs can pick up the slack of the POEs, the private-owned enterprises.
Anything to add there, Joanna?
Yeah, so exactly. I think there's three things we're watching for to see to what extent this will have some impact. And I agree. I think the sentiment that I think there's a lot of skepticism how enduring it's going to be.
Yeah.
I mean, we may have a bit of a pickup of property sales just because we had very weak July, August. There's still some pent-up real demand. But again, the question is three things I think are continuing to hamper sustained recovery. One is, as Monica said, I mean, we haven't really had a lot of policy support to boost people's expectations about their job and income prospects. So that really is missing. The second is, again, I think it's also expectation about prices. Even if we get a pickup of transactions, as long as people don't think prices are going to go up, and in fact, there's still pressure that as transactions pick up, there could be a lot of people unloading market property in the secondary market and also inventory of unsold homes, etc., that if prices may continue to kind of hover and may even decline, people may still wait. And then the third thing that I think is also going to hamper this is people are still going to be concerned about the health of the developers, including private sector developers, and their ability to deliver on property. And that in itself is also going to be a kind of a potential drag. So again, a bit of a pickup of transactions in the top tier cities, but I think without further supportive countercyclical policy response, there's a real risk this may kind of be really temporary.
What does that mean for the data coming to maybe not this year, but next year? Because you're not going to get the same sort of base effects that really was supporting the data this year, right? What happens in 2024?
So that is the real challenge. I mean, our assumption is we've got a 4.6% growth forecast next year, versus 4.7 this year. So that's assuming you're going to get more additional policy support. That it's just taking a little bit of time.
Yeah.
This year, it seems like they're just going to lean more on the base effect from last year. And as I said, you may have a little bit of traction in infrastructure. But going into next year, we got to do more. And either central government has to do more. We haven't really deployed the PSL, pledge supplemental lending facilities, to help the policy banks more for infrastructure. I'm really hoping they do something more on consumption, because if you have consumption support that targets, for example, lower income households, you can generate higher multiplier effect on people with higher propensity to consume if you have a more well-targeted fiscal support. But for some reason or the other, I think they're preserving their bullets and not using that yet for this year. That's a possibility where hope could resurface going into next year. But you're absolutely right. There is a risk to that growth risk next year, especially if we get a U.S. recession, and especially if the fact that they've been kind of slow to respond, that the collective trauma of the private sector just accumulates, and the more they become more even hesitant going into next year.
All right, Joanna, Monica, we have to leave it there. We could do this all day, I feel like, just hear you guys talk. But what a star-studded lineup here this morning on Bloomberg Markets trying to open. Thank you so much. My Woman Crush Monday all satisfied already here today.
Me excluded, obviously.
Yeah, you can go away for a day. Joanna Chua there. Also, Monica Xiao from Triada. We want to have some lines coming through from Logan. You want to do that one?
Yeah, I can do that. All right, so this winding up hearing has now been adjourned. This is the Logan Group Units has been adjourned to October 30th. There we go. So that's all we have to say about that at the moment. So I guess that's been pushed back to that point. No more details so far. But yeah, they're just kicking the can, I guess, at some point.
We'll continue to watch that one. Still, we're seeing quite a bit of downside when it comes to Evergrande shares. I think we were down as much as 20% just now. Coming up, U.S. and Chinese officials discuss a possible meeting between their leaders after both sides met over the weekend. We have details of that next. This is Bloomberg.
With Barclays, every change leads to a bold possibility. You have the vision, we have the insights, financial solutions, and global perspectives to help you make it real. Barclays Corporate and Investment Bank, powering possible.
And so being a partner in climate issues, being a competitor, obviously, with China with new technology, but also seeing that we are systematic rivals and we have to protect our own vulnerability. And this is where von der Leyen comes in, the Commission President, to strengthen our critical infrastructure in Europe, but also looking at outbound investment screenings.
German Foreign Minister Annalena Baerbock there sharing her views of Europe's relationship with China. We got to focus on this geopolitics over what happened over the weekend. There was a now possible November meeting between Presidents Biden and Xi was on the agenda when senior U.S. and Chinese officials met over the weekend in Malta. For more, let's bring in our chief North Asia correspondent, Stephen Engel, joining us. How significant was this meeting?
It's significant in the sense that they're laying out the channels for communication ahead of any potential meeting. They have to really resolve a lot of differences, a lot of protocols to get a Biden-Xi face-to-face meeting on the sidelines of the APEC summit in San Francisco in November. So that's really the goal, probably for both sides. But we're also hearing the State Department just put out a note saying Antony Blinken, the Secretary of State, will later today, Monday, 2:30 p.m. Eastern Standard Time, will be meeting with Chinese Vice President Han Zheng. So that's a good sign. I guess that's ahead of the UN General Assembly that's going to be held in New York. Then, of course, Blinken's also going to meet with the Japanese foreign minister at 7:35 p.m. as well. So there's going to be a lot of geopolitics being discussed on the sidelines of the UNGA. But again, this meeting between Jake Sullivan and Wang Yi is important. They didn't necessarily move the dial on contentious issues like Beijing's support of Moscow amid a war in Ukraine or Taiwan, other than Wang Yi simply reiterated that that is a red line issue in relationship with the United States. But again, there was some concern expressed by Jake Sullivan that Wang Yi today, right after their meeting in Malta in the middle of the Mediterranean, is heading to Moscow, and he's going to be meeting with his counterpart there, Sergei Lavrov, the foreign minister of Russia, at a time when neither Xi Jinping nor Wang Yi are going to New York for the UN General Assembly. Xi Jinping obviously did not go to G20 in India. So, one could see the optics that there's a geopolitical bifurcation happening, obviously. So that's why that potential meeting between Biden and Xi is critical for San Francisco in November.
The other issue is the defense minister. Do we have any more clarity?
Not a lot of
what's happened.
Not a lot of clarity, a lot of speculation. Okay. He has not been seen, Li Shangfu has not been seen in public for more than 2 weeks. It comes after Qin Gang, of course, was removed from his post for disciplinary reasons. He was the former foreign minister. Now this man seems to be in the crosshairs. And there have been reports that there is an investigation going on to perhaps corrupt military procurement practices. And this man is at the top of the pyramid of the PLA. He's also a state counselor. And Chinese spokespeople are not saying anything about it. That's why it kind of smells like it's a similar situation as to when Qin Gang kind of went missing from the public eye. What did this guy potentially, possibly, allegedly do wrong? Well, you know how the Chinese government works. They don't necessarily come out and say right off the bat that he's being investigated. They say he didn't go to Vietnam for some meetings. He was unwell. So that's usually the narrative ahead of eventually announcing he's either been removed, he's under investigation, some sort of disciplinary action. But that's speculation right now.
Steve, thank you so much. Stephen Engel, our Chief North Asia correspondent. Brief check across these markets, 21 minutes into the session here. CSI 300 now trading at the lowest levels, thereabouts here for the year. 3.7 right about is that handle. The other thing is the PBOC auctioning on 50 billion renminbi there of MOF, 1 month MOF deposits. Plenty more ahead. This is Bloomberg.
The Mariah is just an unbelievable place. It's a cultural oasis, and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
All right, it is not a good start to your Monday morning here. If you take a look at how Chinese assets are doing, it's really seeing more downside when it comes to offshore. We're down close to 1% in Hong Kong. Of course, we talked about the CSI 300. We are hovering around those year-to-date lows right now. In terms of where we are seeing most of the pain, it is still today property prices. But even iron ore, you take a look at that, we are seeing now a bit of consolidation, given that we have seen a bit of that bottoming out when it comes to ore prices. But yes, today it's the news on Evergrande. It's the news of Country Garden as well, where we're seeing major tests for the property developer here when it comes to some bond repayments or even extending those bond repayments. And Evergrande, one or more employees that we're hearing at least have been detained in the wealth unit. That's certainly sending some shockwaves to the stock here. Although Evergrande, we're off the lows, right? We were low as much as 19-20%. We're still down about 10% here right now. Dave.
Yeah, still, well, there we go, double digits as we just speak there.
Yeah.
Right, coming up here on shows, analysis ahead, very extremely busy week on central bank decisions, lots of that conversations, plus, of course, we have a big telcos theme in the next hour. Keep it here. This is Bloomberg. Good morning.
There's a place where global markets are always open, where you can explore and discover innovative new offerings and hundreds of trading products right at your fingertips. That's Cboe, the exchange for the world stage.
This is Bloomberg Markets Today. I'm Anna Edwards, live in London with Tom Mackenzie. Mark Cudmore, our Markets Live managing editor, also joins us here in London to take us through all of the market action this hour.
The cash trade then just less than an hour away. Here are your top headlines. Asian stocks fall in the wake of big tech declines on Wall Street as traders gear up for a week of policy decisions from the Fed, the BOE, the BOJ and more. The United Auto Workers Union rejects a 21% pay raise from Stellantis as a no-go. The strike against the big three US car makers enters another day. Plus, watch Naspers and Prosus shares at the open as Tencent's biggest shareholder sees its CEO step down after almost a decade in charge.
Welcome to Markets Today, everybody. It's Monday morning, just gone 7 o'clock here in London. Mark is with us here in London, which is brilliant. So we can go straight to him and get his thoughts on the markets this morning. Mark, your thinking on the markets this morning then. I know you're here for the show, but also mostly for the rugby.
Yeah, absolutely. Completely the rugby. I can't believe you're asking me thoughts on markets. Good morning, Anna. Good morning, Tom. I am so excited to be here. I haven't really thought about markets, which is fortunate because they've been pretty quiet this morning. We had some initial risk aversion, a bad day on Friday for stocks. Started off pretty badly in Greater China this morning, but they've pared some of those losses a little bit. So it's quite a mixed and quiet session, waiting for the big events later on in the week.
Okay, yes, it's the only quiet day, it seems,
yes,
of the
very big week.
Of the week, and what is going to be a really big week. Just under an hour away until from the start of cash equities trading. Let's have a look at the futures picture, Tom.
Yeah, let's check in then as the drumbeat echoes around those big events, of course, later this week with the Fed, the BOE, the BOJ and other central banks, of course, weighing in, and expectations, of course, that maybe rates will have to be held higher for longer. We keep across inflationary dynamics as well, of course, with Brent closing in on $95 a barrel. The futures here in Europe pointing to losses of 0.3%. You've had 2 days of gains across European equities, but then, of course, the sell-off stateside. And we'll unpack that story in a little bit more detail shortly. FTSE 100 futures pointing lower by 30 points. And over in Germany, the DAX just holding above that 16,000 level, but nonetheless still pointing lower by about 0.2%. Let's flip the board and look at the futures in the US then. It was a tech-led sell-off on Friday, particularly the likes of Nvidia and Meta. Nvidia was down a little over 3% as well. So that dragged the Nasdaq lower. The futures now, though, pointing to some very modest gains, looking to pare some of those heavier losses just by about 0.1% on the Nasdaq 100 futures. S&P futures pointing to add about 6 points, holding above that 4,500 level, and again of about 0.1%. Dow Jones futures looking to add about 42 points, upside of about 0.1%. Mark, across the GMM, what is singing to you this morning?
Well, first of all, Tom, I didn't realise we'd be doing the GMM from the other side. It's completely confusing to me. The GMM has also got confused. Because look at this, it's nearly the opposite of last week. We got risk aversion in the equities column, but China's the one gainer. That's the exact opposite dynamic we had Thursday, Friday, where it was generally risk on, but China was the exception. So the GMM is as confused as I am with the opposite directions today. In the FX column, it is mixed, but note the dollar, well, it was there just 1 second ago. It was a little bit softer today, and the yuan is also a little bit weaker. And that is kind of generally helping some other currencies. It's a little bit of an easing of financial conditions out there. Yields are higher. Mainly it's a follow-through from what we saw in the US on Friday. Note the 10-year yields up another tiny bit in the US. It was cash treasuries were closed in Japan, so we're just getting the cash market open now. But futures, we knew yields would be a little bit higher. We're also seeing steepening in the curve in Australia. Note the commodities, despite oil prices heading higher again, commodities are a little bit weaker. And that kind of ties into this idea that, hey, the yuan is weakening a little bit of negativity on China. And like last week, when we were getting positivity on China, but weaker stocks, today we're getting negativity on China, but stronger Chinese stocks. So China is a very confused market out there at the moment.
Yeah, the CSI at the lowest this year to that point. Mark, let's talk about the markets in 3 minutes. And let me start with Friday's session, because it was a really fascinating one. We talked a lot about the strike activity around the auto sector, and you were pointing out that was going to weigh on sentiment. And it has been cited by many people as something that did weigh broadly on sentiment, but it was the Nasdaq that took the biggest falls. It was a tech-led theme, as well as being hit by what was coming through from the auto sector. What's our latest thinking on the role that this is going to play on the US outlook from here?
Yeah, and that's a really good point, Anna, because I think that the stress recently has been around the tech. We've obviously seen some of Apple's been in focus the last couple of weeks. The ARM IPO seemed to go pretty well, but there's been concern around several of the big tech names and a bit, have they got a bit too frothy? Have they gone a little bit too far? But I do think that the macro driver I'm concerned about at the moment is the United Auto Workers strike. I think this will be, it looks like the two sides are very far apart. Now, obviously in negotiations, that can seem the place where they are until right when before they reach a resolution. But at the moment, the sound bites are not good over the weekend. And if this is a prolonged striking problem, it is seriously problematic as a blow to the US economy, but also for what it says for the idea of US being able to home shore its manufacturing process. That may not be able to work if labour proves too expensive in the longer term. So this might be a real undermining to the whole US exceptionalism story.
Yeah, and what does it do to supply chains that supply that sector and therefore inflation expectations? More on that, I know, later on in the programme. Let's talk about commodities, another asset that has an impact sometimes on where inflation heads. You pointed out on the GMM then, Mark, we see commodities generally weaker today. That's not the case with oil, as you said, up by another 0.75% today, 94.64 on Brent, heading, it seems, towards that 95 mark. Commodities have had a really strong run, or oil has had a strong run, up 11% in the last 3 weeks. Doesn't look like it's changing its mind.
No, and as we've kind of talked about the last week or two, I think the problem with higher oil prices from here is that it's just seen as a real growth negative. We know that the consumer is kind of at the edge of their ability to spend, and that means as we get higher oil prices from here, it is about a substitution effect, and they're moving the spending away from more productive spending and having to spend it on their gasoline prices, and that is severely problematic. So I think that oil prices from here are a real negative for the stock markets, and obviously it's an inflation impulse, but I think we play that less severely, and I'll talk about that later on in the show as well.
Yeah, absolutely. We've got lots more when it comes to inflation expectations later. We've got so many central banks reporting this week, deciding, all within a 48-hour window, 10 of the G20, I think, or roughly half of the G20 giving us their decisions. But to focus in on one, the Bank of England story, interesting angle on it around real estate. We'll have more on this in the second hour of the programme. We talk to Rightmove. But the MLive Pulse survey is really interesting in its expectations for the fall in prices in UK housing. The expectation is a drop of 10 to 20%. We've had 5 of that so far.
Yeah, I think what the problem with the Bank of England is there is no good move here. They are the closest to stagflation in a world where that is the kind of theme or the word that's been bandied about for all economies going into next year. Bank of England really do have it. They are seeing a sluggish economy this year, meant to be bad again next year, and yet they continue to see high inflation. And that means the Bank of England will make a so-called mistake no matter what they do. It's not really their choice here, but ultimately they have to get on top of this inflation problem and probably hike too much.
OK, remember you can get up-to-date analysis and insight from Mark and the rest of the Markets Live team. MLive Go is the function to use on your Bloomberg terminal if you want to get across that Markets Live block. Tom, a busy week.
Well, look, we flagged it. Yeah, a hectic week, certainly, on the central bank front, with decisions, of course, and politics front and centre. The UN General Assembly is going to be meeting, and that kicks off in New York. That's today. We're going to be bringing you important conversations with business and political leaders throughout the day, of course, and throughout the week. On Wednesday morning, we're going to get an update then on UK inflation. Mark there just touching on the conundrum for the BOE, closely watched, of course, by the Bank of England as it announces its rate decision later this week. Also on Wednesday, the Fed's FOMC rate decision due at 7 p.m. UK time, 2 p.m. Wall Street time, with expectations they'll hold but maybe leave the door open for another hike later this year. And on Friday, there is no rest for the wicked. Traders will be looking out for the BOJ decision. And we wrap out the week, of course, with a slew of flash European PMI data with, of course, deep concerns about whether or not we're in a stagflationary environment in the Eurozone, the weakness coming through. And interesting, the pushback last week from the Italians and others within the Eurozone to that decision by President Lagarde, the ECB, to push ahead with another hike.
Yeah, the politics.
Yeah, absolutely. I think that, this is squeezing some economies. And one of the real problems we've seen in every prior crisis over the last 20 years is that all the cycles, the economic cycles in Europe, aren't coordinated. And so we consistently see this, that some countries really have hot inflation when other ones are struggling from the growth side. And so every point at the end of a hiking cycle, we're going to see this real divergence in response. Ultimately, though, the ECB has to care about the big three, and a lot of the peripheral ones suffer because of that.
That's interesting. The divergence within the Eurozone is interesting. Another factor, though, I think is interesting, Tom, is when we look at where we're going to go on the central banking conversation this week, and there are so many of them giving us their decisions, the overall global vibe might not be for lots more hikes, but the European expectation is that we get that from the Bank of England, the Riksbank, the Norges Bank, the SNB. We are expecting more hikes to come through here in Europe, even as other global central banks, such as the Fed and the BOJ, may be seen more on hold.
Well, is that a catch-up function, Mark, or is it?
I think it is. I think it's because the ECB.
It's a catch-up function. But also, the whole discussion around, and the communication, arguably, from the Bank of England that had been flagged early on in the start of this cycle. Do you remember Mohamed El-Erian saying, actually, the BOE is doing one of the best jobs in terms of communicating around this? Now the consensus is the Fed is doing the best job, and the BOE is walking this very fine line with this table-mounting analogy at the time when inflation remains relatively sticky here.
Yeah, I mean, I'm surprised that anyone would think the Bank of England have nailed this hiking cycle, given their communication flip-flops along the whole way. I actually think the Fed has done quite a good job. I think it's been a really, really tough situation we've had for central banks. It has not been easy, so I think it's very easy to kind of criticise them. I think overall, Fed have managed the translation away from explicit forward guidance, and really aggressive forward guidance, much better than the others. And I don't think the ECB have done too badly either. I think the Bank of England, unfortunately, have lost credibility with everyone, and I feel sorry for them.
OK, well, it's interesting to think about the read across then from the ECB into those other European decisions, but also the fact that all of these other central banks will, many of them at least, are coming after the Fed, aren't they, this week? And we'll see. And for the BOJ, that could be an important factor to watch. So we'll look at the sort of schedule of central bank decisions. Plenty to come on that. Also coming up on the programme, UK rents surge at a record pace while home sellers push up asking prices for the first time in 4 months. We will speak to the Director of Property Science Innovation at the property portal Rightmove. Plus, UAW chief Sean Fain rejects a 21% pay increase offer from Stellantis as car workers in the US continue to strike against the big three automakers.
Up next, as world leaders gather for the United Nations General Assembly this week, German Foreign Minister Annalena Baerbock tells us the EU must reduce its reliance on China. We'll get more from that interview next. If you have any questions of your own for our guests or for Mark, please send them to us on IB Plus TV Go. You can also get more from the Markets Today team on the front page of the Bloomberg UK website or by tapping T Live Go on the terminal. This is Bloomberg.
Welcome back to Markets Today. We have 45 minutes to go until the start of cash equities trading. European equity markets expecting to feel some of the downdraft from Friday's session over in New York. Interestingly, though, US futures pointing a little bit higher this morning, up around 0.2% on E-minis and Nasdaq futures. Let's talk about the US. The Fed's updated dot plot projections due this week are looming large over the bond market. US Treasuries are at risk of a third straight year of losses, something that would be unprecedented in the past half-century. The Fed's new forecast for the benchmark US interest rate are seen as vital to a turnaround in the market. Joining us now with analysis, April LaRousse, Head of Investment Specialists at Insight Investment. April, very good morning to you. Great to speak to you and get your fixed income expertise on a busy week for central banks, and we'll start with the Fed. So in terms of the dots, a lot of people focusing on whether they keep that wiggle room for another 25 basis points by the end of the year, even if they don't do anything this week, even if they hold this week. but also a lot of focus on the cuts priced in for or the cuts suggested by the dots, I should say, for next year in 2024. 1% of cuts in the recent iteration of the dots. What should we be looking for?
I think there would be no reason for the Fed or any of the other central banks to give much away in the way of sort of forward guidance. I think they'll leave as much wiggle room on the table as they need to. I mean, we ultimately expect they've done enough, but they will continue to say they're data dependent. They're going to watch what happens. In terms of sort of cuts next year, honestly, we're thinking, why rush? Unless the economy is actually contracting, there would be no reason to start normalizing policy until you get to really the second half of next year, probably Q4.
April, good morning. I am very excited. Well, excited is the wrong word. I'm a lot of tension on the United Auto Workers strike. Do you think, assuming there's no progress made in negotiations by the Fed this week, do you think that gets mentioned by the Fed or factors into their thinking, or is it just too early? It's a very tough situation for them because they've got to give guidance. But if there's no resolution for the strike for next month, that's going to kill the jobs number in October already. So how do you think the Fed plays around that this week?
I don't think they would be that specific in discussing it. There are a lot of headwinds to the economy, but there are also great tailwinds. Think of all the fiscal expansion going on. So they're going to be concerned about where energy prices go. They're going to be concerned about the strike. They're going to be concerned about students restarting loan payments. All of that's going to factor in, but I think they'll be quite high level in their comments to the extent they say anything.
Well, there's the inflationary impact, of course, of these wage negotiations, and then there's the energy factor that you just touched on there. Should we be concerned, and are markets overly complacent about the risks of a resurgence in at least headline inflation?
I think there is a bit of complacency. There does seem to be a desire to look at the improving headline numbers and say, okay, job done. You know, we just need to sort of sit back and watch the headline and eventually core inflation come down. But the wage data is a concern. It's a concern everywhere. And if you look back at history, you do need to see an increase in unemployment, quite a big increase, to get wage increases to stop.
So to be clear, the wage data is more of a concern than what we're seeing in terms of Brent, $95 a barrel, the energy price uptick.
Yeah, I mean, the thing about oil is, of course, central banks will try to look through that and say it's beyond their control.
Can I clarify that you then think that there must be a hard landing to resolve the inflation issue for the longer term? Like, we can obviously prolong it, we can put the recession off, but do I interpret that correctly? If you're saying ultimately the wage data drives this, it keeps core inflation high, the only way you solve that is get a massive spike in unemployment, kill the labour markets, therefore it must be a hard landing, is that correct?
It depends on how you define hard. So we don't think...
How do you define hard?
Well, we're expecting to see growth, first of all, stagnate, and then maybe you get the odd quarter of contraction. But it's not a sort of 2008 type slowdown or, you know, anything like the COVID.
You know, this is Mark just trying to get you to agree with his view.
Okay.
So well done.
Excellent. You stick to your guns, April. You mentioned fiscal, and I want to pick up on that, actually, because there's been some calls around Europe, some policymakers talking about how the fiscal side, well, European central bank policymakers in particular, they're talking about how they don't want the fiscal to interfere with the monetary.
Yes.
And that's the focus. Over in the States, a lot of people talk about the fiscal and the amount of supply we're going to get in bond markets as a result and what that's going to do to the curve. How are you thinking about this fiscal push at this point, either in the US or Europe?
I think it's the main reason that the economy is so strong. I mean, you can't spend, almost $2 trillion, admittedly over 10 years, and have no impact on economic growth. So it's definitely keeping things, shall we say, more buoyant in U.S. economic growth than perhaps we would have expected after so much in the way of interest rate hikes. But it seems to me that there are two very different agendas. We have the Federal Reserve trying to tighten monetary policy, hoping to squeeze out the undesirable elements of inflation. And we've got the administration wanting to keep, the plate spinning. So they are going in different directions. It will mean there will be an enormous amount of supply to digest.
And is that going to be the factor that shapes the curve?
Well, it has been shaping the curve. But we do think that at a certain yield level, things get attractive. And so, we do worry, of course, how does every auction go? Is there enough demand? But if the price is attractive enough, they will find buyers.
Is it looking attractive now at the long end, the 10-year?
Long end, not so much. And I think because there are so many concerns around what does the inflation picture look like. But the short end, as you probably know, very attractive. Everyone, even money markets, for the first time in forever, clients want to talk about cash funds because levels are so attractive.
So that translates into a steepening move. But do you think that's actually a bull steepening as we really see the front end now has and yields come lower while the back end stays anchored? Or do you think there's still more upward pressure in the back end just because there's so much supply to come into the market and maybe a rising term premium if we're going to keep on having those big fiscal deficits next year?
I think it's probably the latter.
Okay.
So you'll see the long end come under a bit of pressure.
We've got a really busy week in terms of central banks, April. I don't know if this is a thing you relish or a thing that fills us with horror. But we've got plenty of central banks, 10 out of 20 of the G20, I think, giving us. Where do you think we might be surprised? Anywhere? Is there a chance we're surprised by any of these central banks this week?
I mean, the Bank of England's expected to hike again, and then obviously we think, well, not obviously necessarily, but they'll be on hold for some time. We don't really think you'll see any activity from the Bank of Japan in this meeting. So it'll be kind of a quiet, business as usual type meeting until the October meeting.
Okay, no surprises. We'll put our feet up.
Yes, I think you can relax. Yeah.
OK, we might revisit this and reflect on this at the end of the week, April. Thank you very much indeed for joining us this Monday morning to kick off the conversation, of course, about these central banks looking ahead to all of these major decisions, of course. April LaRousse, Head of Investment Specialists at Insight Investment, thinking the Fed is probably done, but will keep the door open to the opportunity, at least, or the potential to come through with another hike, just to keep markets on their toes. Now, the German Foreign Minister says the European Union must reduce its reliance on China. Annalena Baerbock tells Bloomberg's Anne-Marie Hordern about how the region's strategy has changed amid the global fallout from the war in Ukraine.
We have learned our lessons from our Russian dependencies. And again, I believe it's a strength if you can be also in politics self-reflective of saying, okay, this was obviously not the right way to go. We had such a high dependence on Russian gas and oil, but especially gas that obviously in the past former governments took decisions which weren't the right one. Speaking about the gas pipeline Nord Stream 1 as a purely economic thing, nothing to do with geopolitics. And I was in opposition back then, and I was also at the Yamal Peninsula, for example, where there was a source of this pipeline coming through. I spoke to many people there, and I could not only feel from our partners in Poland and the Baltics, but also there that this has obviously a geopolitical dimension. So before election, I was always arguing we have to not only trust on words, but we have to see the action. And now, when we came in government, we said already in our coalition treaty that we have to rephrase our dependencies. We formulated also before the Russian war that we will do a new China strategy, and after the invasion, the full invasion, we not only wrote the strategy, but we prepared for the things we should change in the future. And this is like limiting.
Are you worried about Chinese retaliation?
Yes. So first of all, understanding that if you're bound too closely, it can endanger yourself, especially if you are having such a high dependency of a regime like in Russia, which is in the end attacking your own peace order. So therefore, cutting down our dependency from Russia, but also now with regard to China, de-risking is our total understanding of the strategy. No decoupling, because you cannot decouple in an interconnected world, and a connected world is also way to peace. But we should be able to defend ourselves, not being naive, and so being a partner in climate issues, being a competitor, obviously with China with new technology, but also seeing that we are systematic rivals. And we have to protect our own vulnerability, and this is where von der Leyen comes in, the Commission President, to strengthen our critical infrastructure in Europe, but also looking at outbound investment screenings.
The German Foreign Minister Annalena Baerbock speaking to our colleague Anne-Marie Hordern over in Washington. Tomorrow, I'll be speaking to the German Finance Minister Christian Lindner at the Future of Finance conference in Frankfurt, and keeping the focus then on Germany this week, which is always really interesting from a data perspective, from a macro perspective, isn't it, where Germany is going. There'll be things away from the macro that we want to talk about, the future of capital markets. We've seen, some names deciding to list over in the US instead of listing in Germany, for example. But interestingly, of course, this is a a country that is not protesting about the ECB's rate hikes. This is, playing true to type, I suppose, for German hawks.
Yeah, absolutely. But I have to say, I'm very upset. I fly all the way from Singapore to London.
I know.
And you go to Frankfurt.
Well, you told me you're only here for the rugby, so
I know, it is true. It is true. I was first to offend. No, look, I think, as we know, deep in culture in Germany, they're very anti-inflation. And I think they'd love a good recession rather than a hint of inflation. And that's very much problematic for the rest of the zone. But Germany's already in a very problematic growth place. So even though they're not complaining, they're the ones who probably should be saying, look, this is enough. But they're just so panicked by inflation that they're not doing that yet.
Well, that's the question. Does that leave the ECB hiking into recession once again? Historically, they've done that before, and that is a question for the Eurozone, of course. Right, we are focusing back on one of Mark's favourite topics, getting the details, the implications. The president of the United Auto Workers says he's unmoved by an offer of a 21% pay raise from Stellantis. More on the strikes next. This is Bloomberg. Welcome back to Markets Today. We are a little under 30 minutes from the cash equities open.
Here are your top stories. Asian stocks fall in the wake of big tech declines on Wall Street as traders gear up for a week of policy decisions from the Fed, the Bank of England, the BOJ and plenty more. The United Auto Workers Union rejects a 21% pay rise from Stellantis as a no-go. The strike against the big three US car makers enters another day. Plus, watch Naspers and Prosus shares at the open as Tencent's biggest shareholder sees its CEO step down after almost a decade in charge. Tom, it's going to be a really busy week, of course, but I guess the futures picture for Europe looks a little backward-looking, actually, reflecting on Wall Street from Friday.
Yeah, the here and now is the downdraft coming through from the sell-off, particularly pronounced, of course, on the Nasdaq. You saw losses of about 3.5% for Nvidia, for Meta as well. So it was a tech-led sell-off on Wall Street on Friday, and that seems to be playing in, certainly, to the futures in Europe as we square up to the start of trading this Monday. DAX futures pointing lower by about 31 points. Here in the UK, the FTSE 100 is pointing lower by about 26 points, down 0.3%. By the way, basic resources, just reflect on that, in the last week or so has really lifted the FTSE 100, which has been a laggard year to date. Will that trend continue? Not today, at least. A pause, it seems, when it comes to the gains that come through for the UK index. Over in France, the CAC 40 off by 26 points, lower by about 0.4%. Anna.
OK, so the futures picture looks a little weaker for the start of European trade this Monday morning. Mark, we'll pick up on a theme that we threw around last week, and that is the link between commodities and inflation expectations, I think, have caught your eye.
Yeah, absolutely. We did talk about this a lot last week, and I think this is a great chart done by my colleague Garfield Reynolds, kind of showing that divergence between the oil impact on rates this time around. So this blue line here is WTI crude, and then the white line is the two-year break-evens. And you can see that over the last couple of years, there's been a fairly good trend because obviously oil prices are one of the big drivers of inflation. But what's happened recently is we've seen the sustained rise in oil prices, and yet break-evens have barely nudged higher. And that's this idea that oil prices higher from here are going to be such a negative growth impact that longer term, they're probably going to hurt inflation. So we might, yes, see a short run, we're going to see higher inflation prints because there's higher gas prices, but the two-year inflation print is barely picking up because people are worried about that over a two-year horizon, will this be actually inflationary or will it be cause such a bad growth impact that it might ultimately be deflationary? And that's the real dynamic we're getting at the moment, and I expect that to continue into year-end if oil prices continue to rise from here. And the one final point is, this kind of emphasises that this is an oil price rise entirely driven by supply-side concerns, not about stronger demand.
Mark, I want to pick up on the inflation theme because energy, and this was interesting, wasn't it? April LaRousse telling us just a couple of minutes ago that for her it's the wage story more than the energy story, arguably, that is going to have that inflationary impact. And I know you're obsessed by this story as well, around the United Auto Workers in the US. So if you're starting to think that maybe that energy price increase isn't going to have the inflationary impact because it's going to be more of a recession play or at least weight on growth, then maybe wages comes to the fore. I just want to break this down because it gives a bit of context in terms of where we're coming from the UAW and their members, 151,000 or so. They're asking for, what, 36% increase in wages? paced out over about 4 years. They've been offered 21% by Stellantis. But here's the context then, and these are average hourly earnings from the Bureau of Labour Statistics going back to 2006. You've got the white line, which is all employees in the US. So around 68, close to 69% gain in terms of average hourly earnings from 2006 up until now. Blue line is manufacturing employees, 57.5, but the bottom line, 38, is yellow, and that is motor vehicles and parts. So the automakers, the auto workers themselves, they are at the bottom of the list in terms of the wage increases that come through certainly across manufacturing more broadly as well. So there's that huge gap. That is what they're hoping to close, but in doing so, do they add to those inflationary impulses?
I think that's absolutely brilliant chart, Tom, and it shows why there's such heated tension around this strike, because, you know, I read a report this morning saying that 2 in 3 people in the US who were surveyed actually support the strikers in this, and they do think they need a proper kind of bump up in wages. As you just highlighted there very well, they have been underperforming on the wage increases for some period of time. The problem is they're looking for such a large jump up now. There's such a large gap that it's essentially shock and awe, and that is very, very hard for a company to bring into their whole pricing and supply chain all at once. And that's why it's almost impossible for the car companies to agree to the extreme demands that are still being made. And this is why I think it's going to stay in a deadlock for another little while yet.
Yeah, and the competition that these car companies face globally is clear to see from the European story of last week, where we saw the Europeans taking aim at cheaper EVs from China. And, you know, some of that might be to do with subsidies. Some of that, though, might be to do with a cheaper supply chain and lower labour costs. We'll have to wait and see what the results are of the European review of that. But that's all in the mix. Interesting also in the US case, the way that this is about wages, yes, but it is also about hours worked. And that, I think, is quite fascinating, the way they actually are pushing for a 32-hour work week, something which we haven't seen much from the auto sector or indeed from many parts of the US. Now, let's focus in on the US auto space. The United Auto Workers president has rejected a pay offer from Stellantis as the strike at the big 3 US car makers enters its 4th day. Workers at plants in Michigan, Ohio and Missouri walked off the job on Friday in a partial strike that's threatening billions in losses if it spreads to more plants. For more, we're joined now by Bloomberg's Oliver Crook in Berlin, who's, of course, across the auto sector for us regularly. Ollie, good morning. So where do things stand now with the strike?
Yeah, so let's just remind people where we are and where are the negotiating positions. The union is asking for a 36% increase. That was down from 46%. And GM and Ford have offered 20%. Stellantis going into the weekend was 17.5%. And then we had Biden come out on Friday also saying that basically the profits of these companies that have enjoyed record profits have not been adequately distributed to the rest of the unions and to the workers. So Stellantis came out with 21%. That was an improvement, not very much more than Ford and GM. Here's what the president of the union, though, had to say to that.
So 21% is a no-go for you?
It's definitely a no-go, and we've made that very clear to the companies.
So a no-go there. They had apparently reasonably productive conversation with Ford through the weekend, and there were a conversation with GM on Sunday. But really, there is still a huge void between these two parties, and as Mark is saying, there's a good chance that this will drag on for a while.
So, Ollie, what are we watching for next in terms of how this story and how this negotiation evolves and develops?
Yeah, so as we look at this Monday morning today, we have Stellantis and Ford back at the negotiating table today. We also have the White House that has deployed a team to Detroit to help support the talks led by Gene Sterling and Julie Su. In terms of what comes next for the strike, we don't know, and that is by design. The president of the union has said, listen, we are going to keep everybody guessing on this. They want to keep a maximum sort of negotiating position throughout all of this. They have, as we can see, done a wide strike, but a shallow strike. Only 13,000 people. We're talking about a union of 150,000. So they've targeted some higher margin products. However, they've not hit the real profit centers. If they want to really ramp this up and escalate things, they're going to target the Ford F-150s, the Chevy Silverados, and the Dodge Ram pickup trucks. And that is really where all these companies make a lot of their money, where there's that huge appetite for American pickup trucks. So that powder is still dry, and we don't know if and when it will be deployed.
OK, Bloomberg's Oliver Crook on the developments, the changes, what to look for as well in terms of this auto workers strike. I should also flag that the big take today is really great on this in terms of how the auto companies have underestimated just how combative the union leadership was planning to be on all of these issues. Coming up, your stocks to watch. Prosus is in focus. as its longtime CEO steps down. That company, of course, via Napsters, with a almost 25% stake in Tencent. Stay with us. This is Bloomberg.
Welcome back to Markets Today. We are 20 minutes then from the start of cash equities trading for another week. European equity market futures point a little lower. Interestingly, though, US futures point higher, but only just. Actually, US futures just worsening a little bit as we've gone through the last half hour of the programme, heading back towards the flat line, perhaps. Tom, let's pause thinking about that to think about, once again, yes, commodities. We talked a lot about Brent, haven't we? And Brent is still tracking higher. That is going higher, 94.74, perhaps heading towards the $95 a barrel mark. But you're thinking about other commodities this morning.
So a lot of us, obviously, and for the right reasons, laser focused on whether or not you get to $100 a barrel of Brent or even WTI by the end of this year. But I'm really obsessed with breaking out some of the other components within the energy mix that we should also be looking at. And that's my must read of the today. It's a great piece on the Bloomberg pointing to the upside in terms of prices come through for diesel. And there's a few reasons for this. It's all about the refiners ultimately. But diesel prices, just reflect on this, in the US, getting above $140 last week. You've seen a 60% gain in the European equivalent since the summer. This chart illustrates how diesel prices are reflected in terms of the increase versus the underlying, which is Brent. Now, part of the reason for this is that refiners, they had to shelve a lot of capacity during COVID. A lot of the less efficient refiners were just closed down during that period. You've also got this focus on the refiners of producing jet fuel because there's such a demand there, that pickup in demand for jet fuel. So they sidelined some of the production of diesel. And also over the summer months, the extreme heat in some countries just forced the closure of these refineries. So for a number of reasons, refineries are just playing catch up in terms of producing the diesel that we need. And if we flip it on to the next quote, which just illustrates how this is the work engine for so much of this global economy, it's just worth bearing this in mind as we think about the potential drag on growth that Mark has been very much analytical on, and what it could mean as well for those inflationary impulses. So here's the quote: diesel is the fuel of the 18-wheeler truck that moves products from factory to market. When prices spike, those higher transportation costs get passed on. So just a little bit of detail in terms of the diesel pricing and what it could mean for this global economy.
Yeah, absolutely. Really important to underline why diesel prices matter, I suppose, isn't it? But also to think about other commodities other than just oil. And Mark, this is interesting, isn't it? Because we do focus a lot on oil. You take us to the commodities column in the GMM often, though, so we do focus on other things. But in terms of diesel, it does have a sort of outsized influence when it comes to the shipping costs and the cost of transporting stuff around. Interesting, though, the reason for this spike in diesel prices. And I wonder if the US consumer, if it does start to fall back, if we see the US consumer under more pressure, whether that then means that these refiners who have been not producing diesel but producing jet fuel are able to go back to producing diesel. So perhaps as the US consumer tracks backwards, perhaps we get a little relief on this story.
I mean, that is definitely the optimistic view, and I think that's the case. I think that the long-term supply here is concerned. I have to say, I'm so glad Tom highlighted this, because I think it absolutely is a must-read, and I would have missed it otherwise. And I think we all know it's not a one-for-one translation from oil prices into diesel, but I didn't quite realise how beta the recent moves have been. But I think what that article highlighted was the idea that, you know, longer term, there is the supply, some of the supply support has to come from Russia and China. It's not just refineries changing what they're producing, but there is genuine long-term concerns about who is in control of that supply issue. So, yeah, this kind of really talks my book again. So I like the story.
I'm just trying to serve it all up.
I know,
for
you're
you,
trying to make me feel
it's a special
welcome
day.
when I arrive in London. I appreciate
Anna may have booked her flights to Frankfurt the moment she heard you were landing in London.
Yes.
But here I am trying to serve you up.
This is a one-day service, though. We provide the news that suits your view of the world
and
for
then
today.
Tomorrow it's going to be all the opposite.
All
I
change.
get it. I'm ready to debate tomorrow.
All change.
I'm getting ready.
Yeah, no turn in 2-year yields tomorrow. That'll be all the research. OK, that's what we're seeing on the commodities side of things. Let's get to some of the other top stories that we're focused on across the Bloomberg terminal this morning. Elon Musk has visited Turkish President Recep Tayyip Erdogan in New York, spending about 45 minutes discussing artificial intelligence and a potential Tesla factory in the region. SpaceX has also been working with Turkey's space program to launch communication satellites. The meeting comes as world leaders began to gather for the annual meeting of the United Nations General Assembly. The death toll from devastating floods in eastern Libya has surged past 11,000 in the city of Derna alone. The United Nations estimates that more than 10,000 people remain unaccounted for in the city after a rare hurricane-like storm slammed into the North African nation last week. Almost a quarter of Derna's entire population are currently either missing or confirmed dead. US National Security Advisor Jake Sullivan and Chinese Foreign Minister Wang Yi have met over the weekend in Malta. Among the the agenda items, possible talks between Presidents Biden and Xi at the APEC summit in November. The Malta meeting comes at a critical time in US-China relations, with Wang scheduled for discussions with Russian officials in Moscow this week. Apple partner Foxconn plans to double its investments and employment in India, highlighting an accelerating manufacturing shift away from China. In a LinkedIn post, the Taiwanese company said it plans to double the size of its business in the South Asian country. Foxconn's Bengaluru plant is likely to assemble iPhones and is expected to create about 100,000 jobs.
OK, to the banking sector now. SocGen has announced plans this morning to increase efficiency and capital strength. The Paris-based lender says it will bring its cost-to-income ratio below 60% by 2026. It's also targeting a CET1 capital ratio of 13%. Let's go to Bloomberg's Caroline Connor, then in Paris. Caroline, what are the top lines of this morning's release?
Tom, we're just 4 months in with the new CEO, Slawomir Krupa, who took over from Frédéric Oudéa, who had stayed at the helm of SocGen for 15 years. So quite a big change today. This big day with this Capital Markets Day in London. And clearly the mandate he's got from the chairman of SocGen, Lorenzo Binismaghi, is to rein in costs, improve efficiency. So a lot of the new targets actually means more cost control. The CET1 ratio up to 13%. Then the average revenue growth, actually not very ambitious targets, between 0 and 2% by 2026. However, he wants to lower the cost-to-income ratio, and there is no change in the dividend policy. In fact, previously under Frédéric Oudéa, the payout ratio was at 50%, and his new target is actually between 40 and 50%, because last year SocGen actually missed on that payout target after they had a €3 billion hit in Russia. Remember, SocGen was one of the most exposed lenders to Russia. So clearly, Krupa's mandate is to increase the valuation of SocGen. If you look at this graphic, you can see that SocGen has got the lowest price-to-book ratio among the big European lenders. We'll see if this is enough to convince investors whether this actually marks a turning point for the stock.
Caroline, good morning. This focus on costs rather than necessarily aggressive revenue growth, what does this mean in practical terms for the bank and its employees going forward?
Mark, if you look at today's release, actually, there is no wow effect. The targets don't look so ambitious, some slight changes, but no wow, big change. In fact, the main focus is really on cost. Overall, they want to cut costs by €1.7 billion by 2026. So this is clearly a change from Frédéric Oudéa, the previous CEO. Clearly, SocGen has underperformed the peers, BNP Paribas and Crédit Agricole. In fact, it's lost more than 40% of its value under Frédéric Oudéa under the 15 years between 2008 and 2023, even if it's recovered some of its value since the low point in March. They're going to get rid of some assets. They've already disposed of 4 units in Africa. They're also reviewing more asset sales, possibly their asset custodian unit. So really a focus on cost control, disposing some assets, improving efficiency, simplifying the business model. One thing also to mention is that they announced €100 million to reduce the gender pay gap. So quite a focus here on diversity. They want to increase the number of women in senior leadership roles to more than a third by 2026. So this is also a focus for the new CEO, Slawomir Krupa.
Caroline, thank you very much. Caroline Conan from Paris for us with that latest report on SocGen. And interestingly, Bloomberg Intelligence saying that there could be some disappointment disappointment in what Caroline was setting out there, the fact that there is no major plan to restructure or refocus struggling parts of the business. Let us get to the stocks to watch. We'll keep an eye on SocGen. Also, other stocks could be on the move. Bloomberg's Lizzie Burden has a briefing. Lizzie.
Thanks, Anna. Let's kick off in Amsterdam with Prosus and Naspers because the CEO, Bob van Dijk, has stepped down this morning. He's been at the helm for over a decade, and in the interim, the CIO, Irvin Tu, is going to take over. He's ex-Goldman, he's ex-SoftBank, he's known as a deal maker, so let's see what the market makes of him at the open. Next up, UBS. We know that back in last month, when the second quarter earnings were announced, the CEO, Sergio Ermotti, told us that the issuance of AT1 bonds for the first time since taking over Credit Suisse would come at the appropriate time. Well, it looks like that might be imminent. The FT reports that UBS has been consulting about investors over it. So again, we watch UBS as well at the open. And finally, I've just thrown in the UK home builders. It's a big week for them. We're going to watch them all week. This is on Wednesday. We've got the CPI results for the UK. We're expecting to see a tick up in the headline level, in fact, because of the contribution of fuel. And those numbers will be seen in advance by the Bank of England's Monetary Policy Committee. They're making a decision on Thursday. The expectation is for another quarter-point hike. But the question is, will the guidance around that decision signal that this is the last, that we're at the peak of Table Mountain, that this is where rates will stay high for a while? That would give some relief to the UK home builders. We've also overnight had the latest Rightmove data showing that there's been a rise in house prices for the first time since May. A contrast to that doom and gloom that we've had recently from Rix, from Halifax, from Nationwide, but it is only asking prices at the same time. So we keep an eye on Persimmon and Berkeley, a big week for them.
OK, Lizzie, thanks very much. Bloomberg's Lizzie Burden with the latest on some of the stocks in focus. And a nice segue into the last conversation of the hour then, Mark, because we should pick up on the results of the Markets Live survey, survey of readers of the Markets Live blog. And this week, you took a laser focus on the UK economy. Really interesting conclusions coming out here. One is that market participants don't fear a Labour government, which is in contrast to 2019. Interesting calls on the housing market, as Lizzie was talking us through there. We'll get more on that next hour of the programme. But interesting also on 10-year gilt yields versus the US. What was the conclusion here?
Yeah, this is fascinating because the movement since we started doing the survey. So when we were doing the survey questions, there was about a 20 basis point gap. And what's happened is UK yields have been above US yields for most of the period since the kind of trust blow up last year. I mean, there's a few months of relief after that, and then the last kind of 5-6 months they've been higher. And we asked viewers, how long do you think UK yields will be above US yields? And 59% said 10-year UK yields will be above US 10-year yields for years. Now, during the survey period, 10-year UK yields have collapsed because that's stagflationary data, and US yields continue to go higher because of the fiscal deficit, as April LaRousse was saying at the start of the show, and we've seen that higher term premium and steepening. So actually, they're now already at the same level. 2-year yields, 10-year UK yields are only 1.5 basis points above US 10-year yields. So so much for most of the group thinking it'll happen for yields. This risk premium, it's already closed.
Do you think longer term though the fundamentals do argue for a higher premium in the UK still? I mean, I think just reversing to what we found from this, it is remarkable that the Labour Party have managed to go from Corbyn to this faith now from markets, according to our survey. So that work that's been done by the Labour Party is pretty impressive on one level. But in terms of the yield premium, do you think longer term the fundamentals do suggest that that is justified?
I'm not going to endear myself on my temporary stay here, but I do think, people talk about UK being a submerging market. It probably does need a real premium in there. Absolutely still, I'm afraid.
Thanks very much to Mark for spending the past hour with us, despite those last views. He's very welcome on our set here. Tom's not sure. Thanks to Mark for spending the past hour with us. The Open is up next. European futures then just losing steam a little bit. US futures lose steam. We will get you the market open. That's coming up next. This is Bloomberg.
There's a place where global markets are always open, where you can explore and discover innovative new offerings and hundreds of trading products right at your fingertips. That's CBOE, the exchange for the world stage.
few minutes to go until the start of cash equities trading. Welcome back to Markets Today. I'm Anna Edwards in London with Tom Mackenzie.
And here are your top stories. Asian stocks fall in the wake of big tech declines on Wall Street as traders gear up for a week of policy decisions from the Fed, the BOE, the BOJ, and more. The United Auto Workers Union rejects a 21% pay raise from Stellantis as a no-go. The strike against the big three US car makers enters another day. Plus, watch Naspers and Prosus shares out of the open as Tencent's biggest shareholder sees its CEO step down after almost a decade in charge. So, Anna, it was the tech-led sell-off on Friday that really stood out, but this week, the focus shifting again to the central bank.
It feels as if the start of the European trading day might have some feet in last week, but actually, in terms of thematics, we'll move on pretty quickly, won't we, in terms of the number of central banks telling us their rate decisions this week, some 10 out of the G20. This is the picture across a number of cross-assets then, excluding Japan, MSCI Asia Pacific, because Japan is closed, down by 0.75%. Weakness in Australia, weakness in Korea, Japan closed. The Chinese market not actually the area of weakness today. S&P futures up just 0.1%. I put that in because it's just faded a little. We were expecting a bit more of a bounce from Friday's session. Friday, as you say, Tom, dragged down by tech sentiment, also by sentiment surrounding the auto sector, even if the autos players themselves didn't necessarily move in line with that story. This is the Brent crude price, up another 0.9%. We're getting awfully close to $95 a barrel on Brent, so that's what markets might focus in on soon. And the euro at 106.60, just in the wake of the ECB last week, and as we move into a crucial week of rate decisions here in Europe. Tom, what do you see in futures?
Futures pointing lower by between 0.2 on the DAX and 0.4 on the CAC 40, pointing lower by 31 points. It looks like we're set for a relatively down session.
OK, so a down session then, at least at the start of the trading day, is the expectation. Futures suggesting we have a little bit more negativity to price in. As Tom was pointing out, a lot of that really Friday story from the United States, where we saw sentiment weighing on markets around the auto space and around technology shares. The Nasdaq was the area of most intense selling pressure. That has spread through into the Asia session then and is expected to come through into Europe, but also we are focusing our eyes on the future and all of the central bank decisions to come. The FTSE 100 then pretty flat, so pretty unmoved. The Spanish IBEX just down 0.1%. A lot of grey on the Forex column as well, so not seeing very many outsized moves. The Bloomberg dollar index pretty flat. We will hear from the Bank of England, of course. We'll also hear from the SNB. So the pound and the Swiss franc will both be in focus this week in terms of European central banks reporting. A mixed bag on sovereign credit. One thing we can be sure of, though, oil prices are going higher this morning, Tom, up by 0.8% on Brent crude, 94.72 right now. What do we see on sectors?
Despite that, the sector, energy sector as a whole, is currently down about 0.1%, despite, as you said, Brent getting close to that $95 a barrel level. The consumer sector is down by 0.5. This was the leading sector in the gains that we saw coming through from European equities on Friday. So pairing some of the gains that saw coming through at the end of the week. Autos is currently flat. There's also one of the biggest gainers on the Friday session. Basic resources gaining 0.2%. Media is taking a bit of a hit, down 0.6%, and a couple of other sectors standing out. Construction off by 0.2%, and utilities often a safe haven, but currently down around 0.2%. That's a shakeout across these sectors in the first minute or so of trading.
OK, yeah, a slow start to a Monday. I know how they feel, but we are a positive on around a third of the sectors, I suppose, 2/3 in negative territory then at this early stage of the trading day. Now, it is a big week for central banks. The Fed will take centre stage with the FOMC rate decision on Wednesday. The BOE is in focus on Thursday and the BOJ on Friday, of course. Eddie van der Veld joins us from the Markets Live team, and he can talk us through his thinking on central banks. Eddie, very good morning to you. So it's going to be a busy week for central bank decisions. The Fed, of course, looms large. What are you going to be looking out for then from these central banks?
Absolutely, Anna. It's a really big week, as you say. We're going to have this rush of meetings. The Fed is key, Japan is key, you know, the Bank of England's key, but we also have things like, you know, Zimbabwe and Egypt and Norway and Sweden. Not that I basket those together, but you know, we've got some really key and a whole host of them. Now, central banks have been raising rates. The rates are high. How high can they keep them there? That is the next question. And, you know, I think they will want to say, hang on, we're going to keep the fight on inflation. I think, though, that the central bankers feel pretty good about themselves mostly right now. They're seeing inflation coming down. They feel like they've done most of the job, and they want to sit tight for a little bit. The question is whether the data is going to allow them to do so.
Well, on the data front, the PMIs then out later this week. How important do you think they'll be in terms of the guidance for the central banks, but also for the markets?
Yeah, because in many parts of the world, we're starting to see that stagflationary narrative coming through, right? We're seeing those PMI numbers particularly weak, particularly on the manufacturing side. And then, you know, services starting to dip into the red as well. And if you continue to see that, then it really undermines this idea that they can keep rates high for long. And you know, if they're going to have to start being forced into cutting at a time when inflation is still above target, that is not a good place for central bankers to be in.
We could really end with a bang, couldn't we, with those flash PMIs out of Europe, I'm thinking, on Friday. So just as we think it's nearly all over with the central banks, we will get that data, and that'll be a nice reminder, as you say, of some of the stagflationary forces, perhaps, if that's what we see. What about higher oil prices then, Eddie? Because Mark has been giving us his views over the last few days about, yes, watch commodities, watch higher oil prices, that can be inflationary, but he thinks actually it's going to have less of an impact on inflation and be more a downdraft on growth, actually, when we start to see some of this. But what are your thoughts around the higher oil prices? I mean, we go ever higher.
I mean, look, that's a really good and interesting view, but I do think we shouldn't forget just how important it is for the inflationary narrative, because I think, you know, the lower oil prices this year compared with a year ago has been a disinflationary force for much of the year so far. Now it's starting to move in the opposite direction. So a lot of the headline figures that we're seeing, you know, we're pricing those things out, and it's even going to feed into core, because, you know, just about everything is affected by oil prices at some point.
Eddie, I love how diplomatic you were there about Mark Cudmore's view. Well, it's an important point, but says Eddie. Eddie, thank you very much indeed for walking through some of the key market themes and pushing back against his boss on the energy and inflation. Very diplomatic. Eddie van der Volt, of course, from our Markets Today blog. Thank you. You can get more from the team on the front page of the Bloomberg UK website by typing TLive Go on the terminal.
It is a hectic week. Have we said that enough times? It's going to be really busy on the central banking front, central bank decisions and politics front and centre. The UN General Assembly meeting kicks off in New York today. We'll be bringing you important conversations with business and political leaders throughout the week. On Wednesday morning, we'll get an update on UK inflation, closely watched by the Bank of England, of course, as it announces its rate decision later this week. So it's inflation on Wednesday, decision on Thursday. Also on Wednesday, the Fed's FOMC rate decision comes out. That's due at 7 p.m. at UK time, 2 p.m. Wall Street time. On Friday, there's no rest for the wicked. Traders will be looking out for the BOJ's decision, and we wrap up the week with that slew of flash European PMI data that we were just discussing there with Eddie. I am really fascinated then by the way that we'll sort of work our way through all of these central bank decisions and then get flash PMIs. So just as you think you know the state of the world, you get another look at the most recent high-frequency data about how weak and how stagflationary Europe looks.
Well, at what point do we cement that view that this is stagflation that they're looking at in the Eurozone, and will this week and that data be the cause for that, is a question. The Bank of England rate decision and the commentary from the BOE arguably more important, more interesting, because the challenge seems to be a little bit more acute in terms of the impact on the housing market. We'll be unpacking the impact of these higher rates on the real estate market and the housing market here in the UK. But given the commentary we've heard from Andrew Bailey and Hugh Pill in recent weeks, I think the BOE is the standout, maybe, in terms of where the interest is going to be.
Yeah, absolutely. Really interesting the way that this shapes up, whether we get reference to that Table Mountain shape to rates to come, whether that still remains the course of things from here, or whether... interesting to get their take on the housing market, and when we get to that peak patent point, when those 2-year and 5-year mortgage roll-offs really hit the UK consumer, because that, I think, is getting a date, nailing down a date on that seems to be crucial to any view on the UK economy.
Yeah, absolutely, as people look to refinance, of course, their mortgages. Worth highlighting what is happening across SocGen, because, of course, this is a company that is going through some efficiency changes. Caroline Conard has been on the ground in Paris for us with the news on this, and the stock is currently down close to 6% after unveiling that strategic plan. So it seems investors are less than impressed, at least for now, around the strategic plan after, of course, new leadership at the top of SocGen. Again, that stock down around 5.8%. We'll get an update from Caroline later in the hour.
The view from Bloomberg Intelligence on this one: disappointingly, there are no major plans to restructure or refocus the struggling investment bank, which is compounded by a lack of a boost to share buybacks. So some cautionary words, I suppose, there.
OK, coming up, if you didn't know, a big week for central banks. Consensus is building that the Fed peak rate may be approaching But what are the markets pricing in, and are they getting it right? We'll get analysis next. This is Bloomberg.
I think that we are at the right level of interest rates in the EU to stop inflation and to reduce inflation. And this is the goal of these interest rates, to reduce inflation. We are on the right track. And I think, as Christine Lagarde said, that we should stick to that level of interest rates. It is the right level to reduce inflation.
OK, French Finance Minister Bruno Le Maire saying that rates are at the right level to reduce inflation across the Eurozone, speaking to Bloomberg exclusively then, as increasingly you see leaders across Italy, Spain and France coming out with their views on that rate hike from the ECB. Let's bring in some analysis now, market analysis, with George Barbaros, Managing Director at K2 Asset Management, on the ground in London for us. A great pleasure. George, thanks for joining us in the studio. Let's start with the Eurozone then. You're underweight European assets, European equities. Yeah. What would change your view? What would be the catalyst to make you more positive on European equities? Because some strategies we have come on, some guests will say, look, there's the valuation appeal and then there's the cash returns, the dividends and the buybacks. But you're not compelled by that at this point.
Yeah, well, we maintain underweights to mainland Europe. There's less predictability. We like North America, more predictability with policy, more predictability with the earnings profile.
Multiples are stretched.
They are. That's what more predictability equals, is you've got to pay a high multiple in return for that.
But at least you know you do.
You know you do. So that's where that overweight's been working quite well. Do the rotation, and then if you're going to price in a rate cut, which won't happen, but the market will, and that create volatility, but you'd be preempted. That's a Russell 2000. Take it back to Europe. It's just very complicated. So we know the hard landing's in Germany. Finance ministers doing what French finance ministers always should say, don't keep rates too high, let's just keep it nice and low. So there's just a lot of uncertainty and it's a bit piecemeal over there. We would rather even come over to somewhere where there's a bit more pain in Europe, in the UK, and probably look at this market, even though there would be odds on to do another rate hike here to address whatever they've got to address their stubborn inflation.
I was going to ask about the US, but that's just too tempting. So coming over here for some pain then, George, I mean, what are you looking at then in the UK in terms of UK assets?
Yeah, so the UK assets, unfortunately, it's industrials, and then when we're looking at the opportunities, it's energy to go overweight. And we've got some overweights in other parts of the world, looking at energy to go overweight again, and underweight financials, unfortunately. So that's, in the UK, there's some value play in there.
Underweight financials because the rate hikes have stopped, or stopping soon?
Yeah, financials that can benefit from margins, obviously, on lending. Some American banks are the big ones, more predictive again, overusing that word. So we like those, but we can't find that same case in the UK and Europe. Cost-income ratios, yes, they're improving, but they've got a long way to go to be matching the major financials in North America, which are looking much better. And again, it's easier to have a look at that profile of the earnings going forward 1 year. It's a bit more messy here, so we still like the energy play. And once again, rate cuts won't happen. It's high for longer, high discount rate, big headwind. But when people start pricing in rate cuts every second month for the next 12 to 24 months, it'll create that rally mechanism in there and that volatility, and then it'll just unwind itself as well. So people need to be cognizant of that.
Do you think we're closer to the risk premium here in the UK starting to fade, or do you see that being a prolonged...
High for longer here. You have some interesting issues that Australia do as well. You can compare the two different economies, but we're on top of inflation here. But the annual inflation rates, unfortunately, in developed markets on the year-on-year basis, they're going to worsen again by the end of the year. What's happening on the headline, and there's some stubborn services components. But nevertheless, if the UK goes through the pain earlier, the UK comes out looking better earlier as well for the developed markets. It's one way to look at it.
Thinking about US stocks then, you say we are in line for a soft landing in the US.
Only the US, yeah.
Only the US, right. Yeah. And because some people are worried about the US consumer. They've worked their way through those post-pandemic savings up to this point, and things get tougher from here. Yeah. Do you worry about that?
It is tougher. We're always concerned, but we have to have a call. So I think most people say it's consensus now, where 3 months ago it wasn't, that the weekly data says soft landing on the cards. There are complications. Demand destruction equals pain. Consumers are feeling that pain. And there are some uncertainties in there, but it's the one economy, and it happens to be the largest in the world, that has odds on to get that soft landing. And once you get that high for longer rate into the system, Russell 2000, mid-cap stocks, small-cap stocks are very sensitive. There'll be a big rotation through there, just like in the UK. With your FTSE small-cap index, they're very sensitive, and a lot of them just drop out and the new ones come in, and you've got your new growth structural cycle for the next 10 years with a higher discount rate, and that's a headwind, but it's not good for every company, but those high cash spending companies will benefit from that.
I think it would be remiss of us not to get your views on China, given the linkages between the Australian economy, where you're based, of course, predominantly, and that economy. You're very bearish still. I mean, there's an argument that maybe a lot of this negativity has been priced in. You saw the CSI 300 falling to a new year low earlier today. It's come back a little bit, but nonetheless, foreign money outflows, foreign outflows have continued. Isn't all of that bad news priced in? Isn't there a valuation play in China?
There is a valuation play, but more bad news, I'm afraid, very quickly. We've been overweight China up until March 2021 for 20 years on a structural basis. We're a structural decline in China after what Beijing did in March quarter 2021. It's very difficult to have long duration exposure there. So structural decline, PE, we wouldn't touch that. Tactically, though, yes, you can come in and out tactically on the equities, play that going forward, but they need finite capital from the rest of the world's savings. They've got issues that are beyond belief on the consumer and business sentiment. It just maintains those lows. The PMIs are repairing themselves just in the last 4 weeks or so, but structurally underweight. Tactically, overweight's where you can play it, but be very careful.
Right, and sticking with that theme, I remember hearing from Mohamed El-Erian, speaking to our colleagues in Italy recently, talking about China and the data and, the policy initiatives. And he was talking about how China is sort of tinkering with short-term policy when really what is needed is structural reform. Do you think other investors see the world the same? George, do you think others are also concerned structurally over a very long time horizon about China, rather than the sort of, yes, you can play it short term?
Yeah, we believe as active managers, we're not the only ones that have gone underweight since March 21, after being overweight for multi-decades on the structural. Have a look at German economy, the highest correlation, high R-squared with that economy in China, they're suffering the most pain. So there's your evidence for the pain. It will proceed and it will be there structurally for longer. Again, no private equity investments. We can't, that long duration for China, but we can see tactically short-term equity exposure, and again, underweight structurally for China. And they're going into the new trading brick economy anyway, 2 operating platforms. Price pressures aren't going to go down globally, but it's just a different operating platform for the next 10 years. Be very careful with these headwinds for higher for longer rates and some stubborn regulatory frameworks around different regions of the world.
OK, George, really nice to see you as you pass through London. Thank you so much for coming to talk to us. George Bubaras, Managing Director at K2 Asset Management, with his views on rates higher for longer and the rest. Coming up on the programme, we'll dive into the Prosus and Naspers story. The CEO, Bob van Dijk, is stepping down. We'll discuss the implications of that for the investment firm and also for Tencent, because, of course, this business owns a big chunk of Tencent. This is Bloomberg.
This is Markets Today. Happy Monday, 21 minutes into the European trading session. You are lower across the European benchmark by 0.4%. Losses of close to 0.7 over in France and the CAC 40, and a drop of about 10 points here in the UK on the FTSE 100. Now, to a big corporate story and changes at the top. Prosus and Naspers CEO Bob van Dijk is stepping down as the head of the e-commerce investor and the board after almost a decade in charge. The group's CIO, Irvin Tu, has been named as the interim CEO. Prosus is the largest investor in Chinese tech giant Tencent. Let's go to Bloomberg's Lonnie Prince-Tu now in Joburg for the details. Lonnie, what has been then some of the key decisions taken under CEO Bob van Dijk? How consequential was he for this business?
Last 10 years, that's a decade of leading the company, and he's done quite a number of big shifts. One of them being spinning off the Africa Pay TV company called MultiChoice. They moved on, they spin out all the internet assets into what we now know as Prosus, which is a very big sort of e-tailer in Europe, listed in Amsterdam. They've started selling down their stake in Tencent and slowly buying back their own shares. And then this is all quite significant moves to try and also get the value for the sum of their parts outside of their Tencent stake.
OK, Lonnie, so that's some of the impact that he's had. And, of course, putting some of these businesses into the Dutch listing, a key part of what was going on here. Who is the new CEO or the interim CEO, and what have we learned about his plans or plans for the business from here?
Okay, so Irvin Tu is taking over. He's from SoftBank, and before that, Goldman Sachs. Is known as a deal maker and a strategist. He's been with Prosus for the past 2 years. We've seen him also make some significant contributions in terms of the strategy, where the company is going. And the main point or the main focus of that strategy is to reach profitability by the first half of 2025. We've actually just spoken to Irvin. He said he's going to take quite a hard look at everything, but they are planning to be very disciplined when it comes to mergers and acquisitions. That is because of current market conditions and the cost of deploying capital at the moment.
OK, Lonnie, thanks very much. Bloomberg's Lonnie Prinsley joining us there from Johannesburg with the latest on Naspers and Prosus. Certainly some of the stocks we're watching this morning. Let's get a check on the other stocks on the move. Bloomberg's Lizzie Burden has a briefing. Lizzie.
Thanks, Anna. It's a pretty negative session here in Europe this morning, so let's kick off with the losers. SocGen, as expected, down this morning 6.4%. This is on the news from the CEO this morning that it's launching this cost-cutting drive. It's at the expense of revenue growth and profitability, and there are no major plans to restructure its struggling investment bank. So investors not liking that news this morning. Over to advertising, S4 Capital down 22.5% at the moment. This is after it's cut its full-year outlook, and it's the second time that it's lowered expectations in just 2 weeks. So really struggling that one this morning. Also, Lonza down over 7% this morning. This is, of course, the Swiss supplier to pharma and nutrition companies. Its CEO is to step down at the end of the month. No reason given for this unexpected departure, but we do know Lonza has been struggling. It's been challenging times for that company, and the chairman is going to take over from him. Finally, of the winners, and there aren't many this morning, I've picked out Mondi because it is the biggest gainer on the Stock 600 this morning, up 4.7%. This is after the sale of its last remaining Russian facility for 80 billion rubles. It's going to get that payment in 6 monthly instalments. So that clearly pleasing the market this morning.
OK, Lizzie Burden, thank you very much indeed, with some of the stocks on the move in this Monday session. It does stand out to me, S4 Capital, of course, founded by Sir Martin Sorrell, Anna, because of the slight litmus test it is in terms of the health of the economy. So recession concerns, they downgrade, as Lizzie said, second time that they've downgraded their forecasts. And the line coming through from the team on the London Rush who've been analysing this, then it was particularly evident, apparently, in terms of these recession fears for S4 Capital, the digital advertising firm. 1 or 2 tech clients feeling a lot more cautious and seems to be reining back their spend, their ad spend. And so as we think about the depths of a recession that we might be going to here in the UK, this is one example of some of the pressures.
Yeah, you always look at marketing spend, don't you, as an area of pressure where businesses will cut back if they have the flexibility to do so, if they're worried about tough times or tougher times ahead. So there's sort of legitimacy at looking at that. I wonder how representative it is of the broader economy when they cite that reliance on tech clients. You know, perhaps that makes them slightly more beta to the declining fortunes of the UK economy.
And that question will be key if there's a broader read across. Absolutely. Across the European markets, you're currently seeing losses of around 0.4%. In the US, S&P E-mini is actually turning up by about 0.1%. Similar picture for the Nasdaq after the losses of around 1.7% on Friday. Coming up, UK rents surge at the fastest pace in at least a decade, while home sellers increase asking prices for the first time in 4 months. We get a take from the Director of Property Science Innovation at Rightmove. That is next. This is Bloomberg.
This is Markets Today, 30 minutes into your European trading day. Here are your top stories. European stocks follow Asia lower as traders gear up for a week of policy decisions from the Fed, BOE, BOJ and more. The United Auto Workers Union rejects a 21% pay rise from Stellantis as a no-go. The strike against the big 3 US car makers enters another day. Plus, SocGen slumps as the French lender cuts its revenue target as its new CEO focuses on costs and building capital buffers. Lots of interesting individual stories then, Tom. SocGen is one of them. You pointed out some of the advertising news out of London. That's also really interesting. The overall mood in markets a little bit sluggish this morning.
Yeah, maybe that's the reason to focus on some of those individual stories. There's a bit of catch-up, as you've been reflecting on through the last hour or so, in terms of the downside we saw coming through from Wall Street and a soggy session, quite frankly, across Asia. More concerns once again around the property sector of China. Some key deadlines for Country Gardens. So you're seeing some downside across the benchmark of 0.3%. The banking sector does stand out for us, given the downside, the drops that we've seen, almost 7% at one point for SocGen on the cuts to its revenue forecast. That is certainly weighing on the CAC Cajon. Over in Germany, the DAX is down by 30 points, off by 0.2%. The FTSE 100 remains above that 7,700 level. It's had a good week or so, currently unchanged. The basic resources play has been significant in terms of reviving, at least around the edges, the sentiment for the FTSE 100, which continues year to date to underperform many of the other major markets. Across your main sectors then, the breakdown as we reflect on what's happening in energy. There's a really big focus now, given the grind higher in oil prices and expectations that we may not be that far away from $100 a barrel oil. Close to $95 a barrel in the session today. Trying to reflect on the energy sector. Currently, a little bit of green coming through on the back of that high oil prices. Chemicals, though, down 0.6%. Travel and leisure also off by about 0.4%. Similar picture for construction. Banks down 0.2%. Again, unpack that, lift the lid, and it's SocGen that is the most interesting at this point. Basic resources flat and autos down by about 0.2%, Anna.
OK, let's focus in on the UK property market then, Tom. According to a lettings index from the broker Hamptons, rental costs are growing at the fastest pace in at least a decade. Meanwhile, data on the sales market from property website Rightmove suggests asking prices rose in September for the first time in some 4 months. Let's talk to Director of Property Science Innovation at Rightmove, Tim Bannister, who's with us this morning for a take on the UK housing sector. Tim, very nice to have you with us. So in terms of the sales picture, you've seen this monthly price rise, 0.4%. Sounds, you know, at the margins as if this could be something more positive than the messaging we've been getting from the housing sector of late. But we usually see this in September, don't we? And this comes a little lower than the usual uptick in the month of in this particular report, in the month of September. What comfort do you take from this particular report?
Yeah, there are a few things. You're absolutely right there. So it's up a little bit on the month. It normally goes up at this time of year. This is a bit lower than it would normally we'd normally see, so 0.4 versus 0.65 or so. And I suppose year on year we're down 0.4%, which is the biggest fall we've seen since sort of March 2019. So I think what we're seeing here is it's been quite a subdued August. You know, we saw that in terms of the number of properties coming to the market. For example, that was down 6% or so versus the average, longer term average. And so we've seen people step away for holiday, and I think we've seen that reflected a little bit, people a bit more subdued in terms of pricing. I think perhaps sellers are, you know, they're taking heed from conversations with their agents. They're pricing competitively and starting to price more competitively, because we know that's what you need in order to get a sale at the moment. It's not the same market as we saw, you know, back in the early part of 2022 when it was incredibly frenetic and properties were selling super quickly. It's a different market now. It's still quicker than it was back in 2019, but it's certainly a different market compared to what we'd seen over the last sort of 3 or so years.
Tim, how much of a sense do you think, or how much more of a need needs to come through from sellers to be even more competitive in this environment of higher rates? Yet some mortgage rates have come off a little bit from recent months. Is there a need, do you think, there's an expectation that prices are going to have to come down that much further to keep the momentum going?
Yeah, I think when we speak with agents, they're telling us that, yeah, if you are coming to, you really need to really be thinking about being competitive. So that might mean if you've got a property on the market at the moment, about considering a reduction if it hasn't been selling, because those properties, as I say, that are priced correctly and are priced competitively, they are selling. So if your property hasn't been selling, it's probably worth considering a few aspects, one of them being price. So we have been seeing that with sellers doing that. They've been, you know, so the proportion of properties on the market at the moment which are reduced is about 36%. The long-term average is more like 31%. So we've been seeing a few more of those reductions coming through, and I think that is, you know, what we need to see in terms of being competitive, making sure you're pricing correctly so that these sales do occur. The demand is still there, so demand's about the same. It's about 1% down compared to 2019 levels. In the first-time buyer segment, it's actually up compared to 2019 levels. But we still need to see competitive pricing so that those trades occur. They're about 18% below in terms of sold subject to contract compared to where they were back in 2019 at the moment.
Okay, that in itself, though, I mean, that's not as bad as it could have been, I suppose. In some people, when you think about property prices falling, and that's what we've heard from many places, the fact that volumes are only 18% lower than 2019 levels. I mean, maybe it's my expectations were that it could have been worse. Let me ask you about where things get worse, I suppose, Tim, for the property sector, because a lot of people are trying to pinpoint when is peak pain for this story. And our own survey of Market Live readers here at Bloomberg suggests there is more to go in terms of the prices coming down. Rates look set to go higher from here, certainly this week. But also the other dynamic to watch is when mortgage customers roll off these 2-year fixed and 5-year fixed. What is your assessment of when the peak pain point is for the UK property sector?
Yeah, I suppose it's really difficult. Crystal balls haven't been worth much over the last sort of 3 or 4 years, I think, with so many different dynamics, so many, and it's also an emotional thing as well. This is about people's homes. It's not something you do on a whim. It's something you plan for many, many years before, and it normally coincides with a life event. So that really has to be brought into the thought process as well. We think there's we said at the beginning of the year we thought prices would be down. This is new seller asking prices. The number we publish and track would be down about 2% on the year. We're sticking with that. From where we are right now, that would mean a sort of 3 to 4%, 3 or so percent fall at this point. It normally falls probably about 2% between now and the end of the year because of the seasonality of pricing. So we think there's a bit more to come in terms of when we look at prices. But, you have mentioned a few more positive, tentative positives there. We are seeing, despite the fact Bank of England rate is likely to go up. We've been seeing lender rates come down 7 weeks in a row, albeit they're higher than they were a year ago. But that trend of them coming down and perhaps stabilising is positive. Obviously, we know it's difficult as well when you see when you consider wages, but they are we have seen sort of real wage growth as well. So there are some tentative positives there for people. I think they want stability. We know they want to move. And it's a question of sort of that demand side staying where it is or increasing, which I think we've started to see a little bit after the summer holidays, and making sure that those prices are competitive and some of those other metrics continue to move in a more positive way.
Tim, before we let you go, any kind of interesting regional differences that you're seeing bubbling up through the surface as a result of some of the changes in this UK property market? Yeah, there's some regional differences and sort of property segment differences. So in terms of the year-on-year picture, those prices which have been slowing down a little bit faster tend to be the south and sort of the eastern side of the country, perhaps where people are the affordability element is a little bit more stretched for people. And the segment-wise, it has been those larger properties. But I suppose it's worth bearing in mind if you think back over the last sort of 3.5 years, larger properties in Wales, they're up sort of 20-30% in terms of price. Smaller properties in London, first-time buyer type properties, they've only moved about 6% over the last 3.5 years. So if you look on the longer term, it's been quite a different performance by region and by sector. And I think that's what we're seeing reflected now and where things are going. OK, Tim Bannister, interesting deep dive on the UK property sector as prices just edge a little higher in the month, but we'll see if that can be sustained. It looks like there are still many challenges still for the sector. Director of Property Science Innovation at Rightmove. Now, SocGen is trading sharply lower this morning after announcing its strategy update. Investors are disappointed. We're going to have more on the French bank next. This is Bloomberg.
Unbelievable place. It's a cultural oasis, and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home. a reflection of Saudi's culture and beauty.
How's business in the UK doing?
Business in the UK, obviously it's our market. So we've just opened our fourth store in London. We just renovated our store in Bond Street, which is fantastic, super exciting. Yeah, we're very positive.
Your chairman has had a go at the government for actually not helping luxury companies or retail companies out more with VAT refunds. Are you missing out?
Well, we're not missing out. I mean, overall, globally, our tourist sales have obviously been increasing in the last couple of years, which is a positive. So that's a good trend. Unfortunately, there is a gap between our tourist spend growth in mainland Europe versus the UK, which is disappointing, especially as it's our home market. So we'll keep communicating that. We think probably post-Brexit, it would have been an opportunity. It would have been an opportunity to bring more tourists in. So we hope that sometime soon things will change.
Will the government listen?
I hope so. Well, we keep talking. It's not just us as well. I think there is a big movement to keep communicating about the frustration of it. But we're also concentrating on celebrating, our brand here in London Fashion Week as well. So still lots to do.
Jonathan, are you missing the Chinese tourists in London, or are they spending elsewhere, or is it really a loss of revenue?
I wouldn't say we're missing them. As I said, generally our tourist growth has been impressive globally, so it's just spreading around globally. So, even into the UK as well.
So, when you look at pockets of growth, where are you doing especially well, like regionally?
Regionally, well, our quarter one results that we communicated in May, we showed good growth in Europe. So Europe has been strong. Also very positive in Southeast Asia, APAC, and China.
That was the Burberry CEO, Jonathan Ackroyd, speaking to Bloomberg's Francine Lacroix, confusing tourists all over the place as renaming that Bond Street station as Burberry Station. Anyway, we'll move on because the chart on your screen is nothing to do with Burberry and fashion. It's all about banking. SocGen trading at its biggest discount to book value, compared to other peers in European banking, Tom. And what stands out on this chart really is the fact that, lots of them are trading at discounts to book value, which is interesting in itself. But, of course, SocGen taking a dip down on today's news flow.
Yeah, an interesting top of the list, the least badly performing is UBS after that takeover, of course, of Credit Suisse. The stock, by the way, for SocGen currently down about 6.5% on the back of this restructuring plan. The details around the shift there at the bank. Let's cross over now to Bloomberg's Caroline Connat in Paris, who's been covering this for us. Caroline, disappointment in terms of investors in SocGen on the back of these revised forecasts. What is kind of standing out for you around the changes at this bank?
Remember, Tom, just 1 hour ago, I was telling you I didn't see any wow effect in this press release. Well, clearly, investors did not see it either, and they are disappointed with the profitability target, with the revenue targets. Basically, the new CEO, Slavomir Krupa, is trying to cut costs at the expense of revenue growth. This was to be his big It's supposed to be his big day after 4 months at the helm of Société Générale, his big Capital Markets Day in London. Well, if you look at their revenue growth target, they're targeting between 0 and 2%, when under the previous CEO, Frédéric Oudéa, it was a 3% target. And also, investors are disappointed on the return on tangible equity, which is a key measure of profitability. Also they have been lowering their targets. Finally, of course, dividends a key measure for investors as well. They're lowering their payout to between 40 and 50%. It was 50% before. It is 60% at BNP Paribas. So clearly, investors are disappointed there. The BI analyst from Bloomberg Intelligence, for example, is saying that caution is outweighing growth hopes. He was also hoping for more details, more restructuring plan at the investment bank, which is where Slavomir Krupa is coming from. Frédéric Oudéa, the previous CEO, had put a lot of focus on the investment bank at a time when there was actually tougher regulations. He also miscalculated, for example, the importance of asset management by selling a stake in Amundi. Well, we were expecting some changes, some clarification there as well on the investment bank, and this did not come with this press release this morning.
So a bit of disappointment, perhaps, that there wasn't more detail there or any kind of revamp. What does that mean? What does all of this mean then for the French bank from here, Caroline?
Well, clearly another analyst was saying that this doesn't really solve the longer structural problems of the French bank. You were showing earlier this graphic showing that SocGen actually is trading at the lowest price-to-book ratio among the big European lenders. So clearly, this is not going to help. We will see, however, the Capital Markets Day in London today starts at 9 UK time, so in a few minutes. And we'll see actually if there is more details, for example, on asset disposals, because this is also something investors are looking at. How he's going to cut costs, how he's going to dispose of some assets. He's already said he's going to dispose of 4 units in Africa. He's reviewing another unit in Tunisia, also reviewing the asset custodian unit, which could bring 1 billion euros. So perhaps more clarity on this should perhaps throughout the day reassure investors, and we'll see whether the share price actually rebounds during the day with the comments of Sławomir Krupa.
OK, so we'll look for those details later today. Caroline Connor on the ground for us in Paris, outlining that story for us. Currently the stock, SocGen, down 6.7%. Coming up, our Treasury yields showing a structural shift in behaviour during this tightening cycle. We discuss next. This is Bloomberg.
Die Welt zu einem besseren Ort zu machen, das treibt uns Menschen an. Und genau das treibt uns auch bei Bayer an. Mit Hilfe der Wissenschaft verfolgen wir unser Ziel: Health for all and Hunger for none. Wir wollen, dass jeder Mensch die Chance auf ein besseres Leben hat. In einer Welt, die wir mit Stolz an nachfolgende Generationen weitergeben können. Bayer.
This is Bloomberg Markets Today. We are 51 minutes into the European trading day. You can see some modest losses coming through across most of these European equity markets. The FTSE 100 stands out to the upside, up 0.1%. And US futures just improving a little at the margin, up by 0.2% on E-minis and Nasdaq futures. Tom, we've spent quite a bit of time over recent days and weeks, in fact, thinking about higher commodity prices. Oil prices go higher today, up 0.8%, 94.68 on Brent. But we shouldn't only focus on oil.
Yeah, there's some divergence, at least when it comes to Brent and diesel. So we are, of course, absolutely focused on that Brent level, around $95 a barrel. It's one of the most read stories of the day, and rightly so, for inflation reasons and for those concerns around what it could mean for a drag on growth. But it is nothing compared to the price action you've seen in diesel, the upside that you've seen come through from diesel. This chart illustrates it, the blue line, and that encompasses diesel as a component. You're seeing that it actually got above $140 a barrel last week in the United States. The European equivalent is up about 60% just since the summer. Here's Brent sniffing the edges of $100 a barrel. Diesel, though, above $140. Why is that? That's because the refiners are absolutely squeezed in terms of the amount they can produce. They are just under huge amounts of pressure. They've got all this demand for jet fuel, so they're focused on that. A lot of the refiners had to kind of pause refining during the summer months because of heat in a number of countries, and they've just frankly shuttered a lot of the refiners during the COVID-19 pandemic, when demand, of course, for all these fuels dropped off a cliff. So there is this crunch point coming through for diesel, and if you flip it over to the quote, the impacts, of course, across this global economy, because diesel is the workhorse for so much of industry, is really important to remember. Diesel, the fuel of the 18-wheeler truck that moves products from factory to market, and when prices spike, those higher transportation costs get passed on. One of the quotes in this Bloomberg piece on the higher prices that are coming through for diesel, what it could mean, Anna, for inflation and for growth. OK,
let's pick up on that and think about what all of this means for Treasury markets. So there's the focus on commodity prices going a little higher, what that means for inflation. But let's take a longer-term view. Ven Ram joins us from our Markets Live team with views on the markets. And your interesting piece recently, Ven, really caught my eye. Sticky Treasury yields show structural shift in market behaviour. This is all to do with investor time preference. Tell us what's happening in Treasuries.
It's a very interesting phenomenon going on in Treasuries, Anna. As you know, Treasury long-dated yields have stayed pretty sticky. And why is that? You need to go back and look at the real rates, inflation-adjusted rates. We were deeply negative in inflation-adjusted rates a couple of years ago at the start of the pandemic. Now we are at 2% on the 10-year TIPS yield. So why is that happening? What is underpinning that increase? I think what may be at work is a shift in investor preference. What it simply means is that consumers are having to decide between consuming for today and saving for tomorrow. And after the uncertainty generated by the pandemic, the uncertainty around general life, investors are thinking, you know what, we are going to consume it right now, right here. Why leave it for tomorrow, which is uncertain anyway? And if they're going to do that, they're going to apply a higher discount rate on anything that they buy, including bonds, which is why real rates have shot up.
Ben, how much focus do you have on, and we look at the real end, we look at yields, I should say, on the back end, 10-year currently at 4.35, just heading up 2 basis points. Ben, we're thinking about the dot plots that are going to be released later this week with the Fed decision, of course, and they currently have expectations of another hike this year and I believe cuts of about 1% next year. How important are the dot plots? Do they take on more significance this week than maybe at previous meetings? What are you looking for?
Definitely, Tom. I think that the markets, I mean, the key signaling that the Fed will do will come from the dot plot. And they want to push back on this market's idea that the rate cuts are going to come fast and furious in the first half of 2024. They definitely do not want the markets to believe that narrative just yet. And what that means is that they can only signal that by pushing the dot plot higher for 2024. At the moment, in June, they predicted 1 percentage point of rate cuts in 2024. I do think that they are going to kind of narrow that margin, and they are going to say 75 basis points, or maybe even just 50 basis points of rate cuts coming in 2024. That will, of course, be pretty hawkish.
OK, yes, absolutely. We'll focus in on the dots, what they leave room for this year and the amount of cutting they expect to see next. Ben, thanks so much. Ben Ram from our Markets Live team, thanks for bringing us your thoughts. MN Live Ego is the function to use on the Bloomberg terminal if you want to keep across the Markets Live blog. Tomorrow, I'll be speaking with the German Finance Minister, Christian Lindner, at the Future of Finance conference. That's a Bloomberg event taking place in Frankfurt, so I'll be hot-footing it today.
We're going to miss you. That is one interview not to miss, though. That is it for Markets Today. You can get insights from us and the rest of the team, of course, on the website. Stay with us. This is Bloomberg.
So we've got this Fed meeting. All of a sudden, we now are trying to comprehend what higher for longer really means. Will that be manifested in the form of dots, or what does it mean for you as you look forward?
Well, of course, this week they're not going to hike rates, but whether this is going to be a skip or a pause is to be seen. Skip will be a case in which they don't hike, but then leave it open to hiking maybe in November or later. A pause will be a signal that, no, they are done. I don't think they can say they are done because the economy is still growing above potential. Headline inflation is going higher now that oil prices are going higher, and therefore, potentially, they have to leave the option open that there'll be another hike.
What is the most misconceived idea? A lot of people have lived through 5% rates before. You have, I have. I've lived through 15% rates, so have you. Is the greatest disconnect in markets that we are pricing 100 basis points of cuts next year, when the reality is inflation is malingering, core CPI is still tight and hot? What's the greatest misconception about inflation?
You're absolutely right. I think that the markets are still thinking the inflation is going to drop towards 2%, and therefore the Fed is going to cut rate and cut them aggressively. The Fed is pushing back against them. They're saying we're going to be essentially higher for longer, not just the Fed, but other central banks. There are structural forces that imply that inflation may be higher, from deglobalization to aging to geopolitics to other negative supply shocks. And therefore, I think markets are still a little bit too optimistic that the Fed is going to aggressively cut rates starting early next year. That's not going to be the case. At the earliest, the Fed is going to start cutting rates maybe towards the middle of the year. Yes.
Danny here in London. Great to speak with you, Nouriel. On that point, look, it's a world saddled with $300 trillion worth of debt. If the Fed isn't going to cut as soon as expected, what happens when we hit that maturity wall come next year?
Well, you're absolutely right. I mean, we live in a world in which there is too much private and public debt. In addition to the official public debt, there is also implicit liability coming from unfunded Social Security and healthcare liability coming with aging. And I think that one of the threats, of course, is not just the trade-off that central banks are facing between growth and inflation, but it's actually a trilemma. They have to worry about financial stability. And the more you raise interest rates, and the more they go higher on the short end and the long end of the yield curve, the more there are risks of financial instability. You saw it in what happened in the United Kingdom about a year ago. You saw what happened in the spring of this year with the stresses in the financial system. I don't think we are out of the woods. As rates have to stay higher for longer, the possibility of some degree of financial instability is still with us.
Well, I was going to say, to start the year, there'd been a lot of fear-mongering that QT would perhaps cause that financial instability, but it's gone off with minimal issues, Nouriel. Can the Fed continue on its progress of QT, or will something make them stop?
Well, for the time being, of course, QT has not had a huge impact. Even if long rates have gone higher, they've gone higher in part because growth has been stronger than expected, but that could be also implicitly the effect of having a quantitative tightening occurring, the fact that other central banks like the BOJ will have to phase out their easy monetary policy can put higher pressure on long-term interest rates as well. If inflation stays higher for longer, that's going to also put upward pressure on short and long end of the yield curve. And the higher long rates are, the more the potential for some degree of financial stresses in the system.
One of the mega threats that comes in at number 5 on your chart list is stagflation.
Yeah.
By any measure, Europe is already there. So my question to you is this. I mean, they can't even call the top of rates. Lagarde didn't, Kazakhs didn't over the weekend. How brutal a form of stagflation are we looking at in Europe, given history?
Well, you're absolutely right. I mean, in the US right now, growth is still positive and above potential. In the Eurozone has been either negative or close to zero for the last 3 quarters. And the latest signals coming from Germany and the rest of the Eurozone suggest that the economy is going to be stagnating. At the same time, inflation is still way above target, not just in the Eurozone, but the other case of stagflation, of course, is the United Kingdom, where right now inflation is even higher than the Eurozone and economic activity is slowing down very sharply. So what Europe is facing a situation in which on one side economic activity is contracting, on the other side is inflation is too high. That's what the stagflationary scenario it is. And that's a dilemma for both the ECB and the Bank of England. On one side, the contracting economic activity will lead them to maybe stop at this point. On the other side, if inflation remains much higher than the target, they may have to hike much more. That's a big dilemma, especially for the Bank of England.
Hey, Rubini, but before we get to break, I do want to bring up one point. Last year, you predicted a long and ugly recession for the U.S. That would start last year, continue for this year. We haven't seen that yet. Did you get something wrong there? Is it recession denied or delayed?
Well, you know, most forecasters, including even the staff of the Fed, were expecting a recession. The good news that it doesn't look like we're going to have a real hard landing. Then the question is whether we're going to have a soft landing or a bumpy landing. Bumpy landing being maybe a short and shallow recession. And on that debate, we don't know yet. There are long and variable lags of monetary policy. The Fed might have to hike more. The credit issues might emerge as there is tightening of financial condition. Oil prices higher imply, on one side, higher inflation and lower economic activity, even in the United States. So I would say that Whether we're going to have a true soft landing, rather a short and shallow recession, is still as an open question, even for the United States.
Nouriel, I'm trying to get the most underpriced risk out of you. From the tone of what you just said, the UK could be there. Confidence in the Bank of England is at a record low by their own survey. It's never been as low. How much are we underpricing what more Bailey and the Bank of England needs to do? How much more of a brutal stagflation scenario is it for the UK? Wrap it up.
Well, you're absolutely right. The problem is that the Bank of England right now is sending sort of dovish signal in a situation in which the policy rates are well above the Fed, but inflation is well above the United States. So what they should be doing is actually hiking rates all the way to at least 5.75. The signals are telling us right now is they're not sure whether they want even to hike more. If that happens, there could be a de-anchoring of inflation expectation. You could have a true stagflation.
OK, the stagflation calls from Nouriel Roubini comes in at number 5 on his charts. Nouriel, Hollywood's on strike. The auto workers are on strike. Europe has its form of angst. Is, again, going back to the underpriced risks, the tail risks, as it were, from mega threats over the next couple of years. For central banks, it's about wages. This is another example of where second-round effects are perhaps underpriced.
They're absolutely so. I mean, there's been a significant increase in income and wealth inequality. The share of labor in income has fallen. The share of capital has gone up. And now that unemployment rate is much lower in the United States, but also in Europe, workers have pricing power. And fiscal policies also during the COVID recession became pro-union, pro-workers, pro-wages, pro those who are left behind. So I think we're going to see a meaningful amount of labor strife because inequality has been rising and now labor has more power than the past. And that's going to be a source of wage inflation that's going to keep a unit labor cost rising more than otherwise. And that implies that most likely inflation is going to be higher than 2%.
Now, look, AI is again on your mega threats. AI and job destruction, it comes in at number 8. What went through my mind when I was preparing to sit down and talk to you was about universal income. How quickly will that begin to be much more of a conscious conversation as AI accelerates? Or is there a considerable lag between AI innovation, NVIDIA booming, and the chip stocks booming, and universal income, real job destruction?
Well, the real job disruption is going to occur over time. There'll be a significant amount of permanent technological employment, not just among blue collars because of robotic automation, but especially among cognitive workers that are white collar. And then there'll be a reaction on what to do about it. The problem with universal basic income is a good idea, but if today you had to give, say, $1,000 to every American per month, only $12,000 a year, that's not much money. It would cost us today, with the current GDP growth, about 20% of GDP, so we cannot afford it. Of course, if over time AI leads to much higher productivity growth and much higher potential growth, we eventually will be able to afford UBI. But from a fiscal point of view, UBI currently is mission impossible. So there's a lot of talk about it, but it's going to take a significant amount of time until we see significant amounts of permanent technological employment, until that idea becomes politically and economically viable.
Nouriel, in the meantime, in a world where labor has negotiating power for higher wages, what does it say about specifically the American project of home shoring? Is it possible, if we're in a world where labor in the U.S. is all of a sudden more expensive?
Yeah, you're absolutely right. You know, even if there was, unquote, reshoring or home shoring, the new factories are going to be capital intensive, skill bias, and labor savings. So we're going to have factories with lots of robots and machines, but not that many workers. I think that the benefits are going to go more to some of the emerging markets where the friendshoring is going to occur. Some of their friends are allies in Asia, Mexico, and other parts of the world, because in those countries the cost of labor is lower, and therefore any type of reshoring or friendshoring is going to be labor intensive as opposed to being capital intensive. But the impact, of course, of reshoring on the U.S. Job market is going to be only very modest.
Nouriel?
Okay, so then, Sir Manus, go ahead. You take it from here.
No, jump in.
Well, I wanted to know, Nouriel, about that 2% inflation call. You said we're going to be above there because of these prolonged labor strikes and then the pressure of the nearshoring. How long and how far above 2% do we stay? Is this a fundamental regime shift of inflation in what you're describing?
Yes, I've argued that the era of the great moderation of low inflation below 2% and stable growth is gone, and we're entering an area of what I call great stagflationary and financial instability. Higher inflation is going to be caused both by supply side factors, deglobalization, geopolitical conflict, aging of population, restriction of migration, reshoring, global climate change, pandemics, cyber warfare, backlash against inequality, partial deglobalization. Those are all supply side factors that reduce growth and increase the cost of production. And on the demand side, we live in a world in which there is so much private and public debt, and deficits are going to remain higher because we'll have to spend more against inequality, against climate change, to deal with pandemic, to deal with inequality coming from globalization and AI, and so on and so on. So spending will be higher, taxes are not going to rise as much, structural deficits will be higher. So either we crowd out growth or have debt crisis, or eventually we have to monetize it, and that's going to cause essentially inflation. So both on the supply side and the demand side, there are factors imply that 2% is at this point mission impossible, and the new normal may be somewhere between 3 and 4% for advanced economies. Over time, of course, not overnight. So there are structural factors rather than cyclical that imply that inflation is going to be much higher for the longer term.
Last time you were on Bloomberg TV, you talked about a 10% decline in equities. We're going to switch up the pace. Fast answer, rapid fire here. I want to get to that call. Tell me where you land on stocks at this moment. Would you want to be shorting or going long American stocks?
For the rest of the year, I will be shorting U.S. stocks.
All right. And is that a 10% decline? Is that still about where you think we could land?
It's highly possible, given what's happening in the U.S. and the global economy, and rising oil prices and inflation being still sticky, and the Fed and other central banks not being done yet.
All right. Is that a call just for American stocks, Nouriel, or globally, are you looking dour on equities?
Well, in the rest of the world, it's even worse than the United States. In the U.S., you might have a bumpy landing, but in the Eurozone and UK, we're talking about inflation and recession, stagflation. China is slowing down sharply. So the rest of the world is even worse than the United States, I would say, in relative terms.
I'm going to get a bullish call out of you. When do we hit $100 in oil? Will we?
I don't know if that's bullish. Might be bullish for the oil market. It's not bullish for inflation. It's not bullish for growth. It'll be pretty bad. It's another stagflationary shock. You know, when oil prices go higher because there is stronger demand, that's consistent with economic activity being stronger. But if it's a negative supply shock because Saudi and others are cutting supply, that causes a greater inflation, lower growth throughout the world. So that's actually bad for the global economy.
Where do you see oil going to, Nouriel? Where's the upside on it?
Well, it depends. It depends on what happens on the supply side. If the OPEC Plus keeps on restricting supply, oil prices can go higher. But I would say that if global demand is going to soften because you have Europe in a recession, China slowing down, even the US are going to slow down, eventually probably there'll be some correction to these oil prices on the demand side.
Nouriel, I'm going to try again for a bullish call. I know Manus was trying to do it. It's our first show. We got to be positive about something, Nouriel. Yeah. Take me to the FX world. What currency pair would you want to be long right now?
Well, for the time being, I would say the dollar, because in relative growth terms, the US is going to do better than Europe and rest of the world. But I would say that because of that growth differential and because inflation might be falling in the US, probably the Fed might be the first central bank to eventually fully pause and then start cutting rates. And that's going to imply that, say, by next year, the dollar might weaken because of the relative interest rate differential expectation between United States, Europe, and what's going to happen in Japan, where they have to phase out the YCC and normalize policy rate. So in the short run is a bullish dollar call, but over the medium term, actually, there are factors that are going to lead to a weakening of the US dollar.
And then in that longer term, too, then, is it a long yen call? What do you need to see also from the BOJ to get to that place?
Well, I would say that by the end of the year, they might fully phase out the yield curve control. They are already talking also about phasing out the negative interest rate policies. It's the only advanced economies right now is still negative policy rates, and as gradually short rates go higher, long rates go higher, that should be strengthening the yen that has been quite weak, of course, because of the differential in monetary policy between the BOJ and the rest of the advanced economies.
Let's just pivot briefly to the Chinese market. Some people are saying we've hit peak pessimism on China from an economic point of view. That's got a consequence for the yuan. Your call on China and yuan?
Well, the problems of China are not cyclical. They're more structural. Potential growth used to be 10% and down to 5%. Today probably is no better than between 3 to 4% because you have massive aging of population. You have huge amounts of private and public debt. You have an overhang of real estate. You have a state capitalism galore under Xi Jinping. The sentiment of the private sector, households, and the private corporate sector is really foul because of the policies of China. You have geopolitics going to restrict both inflows of FDI and exports by China, and they're doing everything wrong in terms of policy. So I would say they'll be lucky if they have 4% growth over the medium term. 3% is more likely. Therefore, the issue of China is not just cyclically that the economy is weak, but structurally is weak.
We're going to spend tomorrow on private equity and credit and debt. So let's get your call in terms of, do you want to be longer of bonds and duration relative to debt and credit, let's say?
Well, I would say that high yield spreads are too low in a world in which there's going to be a slowdown of growth, a bumpy landing, stagflation. Eventually, credit risk is going to rise given amounts of private and public debt. So spreads are so low that they can widen from current levels. And on bonds, I would say right now people expect central banks to cut rate aggressively. I don't think that's going to happen. Inflation may surprise on this upside, both in the short term and long term. And there are structural reasons why the risk premia for bonds should be higher, high levels of private and public debt. So I think markets are again too optimistic on credit and also on bond markets.
Fascinating to see who's not there. I mean, the real power, apart from the United States of America, the UK is not there, Xi's not there, Putin's not there, Modi is not there. How disemboweled is multilateralism, or is that a misconception?
No, we live in a world in which, because of the geopolitical divide between, on one side, China and other revisionist powers like Russia, Iran, and North Korea, and on the other side, the US and the West, we have a world in which there is a geopolitical depression that's leading to a fragmentation of the global economy, de-risking, if not decoupling. There is protectionism. There are going to be restrictions to trade in goods, in services, in the movement of capital, labor, data, information, technology. And that's going to be also stagflationary. We're going to have just in case rather than just in time, global supply chains, emphasis on security rather than economic efficiency, reshoring and friendshoring rather than offshoring. All these things tend to reduce potential growth, increase the cost of production, and there are stagflationary forces. We're going to have balkanization of global supply chain. So it's a very different world where geopolitics has economic and financial consequences.
We already have war waged by Russia on Ukraine. I want to bring you a Bloomberg opinion piece which talks about the coalescing of Putin and Kim Jong-un, and this is what they had to say. This is about North Korea is a dangerous thing. The idea of a nuclear conflict between the countries that are united against the US and its allies isn't some distant possibility. It's a more real and plausible scenario seen in decades. Of course, we've just seen Kim Jong-un and Putin meet over the past couple of days. I'm not asking you to call nuclear war. What I am asking you is about how much more disruptive our geopolitical landscape is with Taiwan, with China, with the US, with this coalescing of powers against the US.
Well, the geopolitical depression is going to get worse. As you pointed out, there is already a hot war with the brutal Russian invasion of Ukraine. This war is going to continue, could get uglier, could eventually, potentially even involve NATO, could become non-conventional. The Cold War between US and China is becoming colder, and now people are saying it's only a matter of when, not whether, there's going to be eventually a conflict on the issue of Taiwan. Iran has reached the point in which they are enriching uranium, and they may decide to go and build a bomb. That's going to be essentially a red flag for Israel. There could be an attack against Iran. And the little dictator in Pyongyang keeps on sending rockets on the sea of Japan and South Korea, and that's also a source of tension. So all these revisionist powers, either they're nuclear powers, or like in the case of Iran, they become nuclear, and therefore these tensions are going to imply at least economic fragmentation, and eventually could be even more dangerous scenarios.
Nouriel, I want to be clear. Are all those things you laid out inevitable, or is there any hope, again, for any of the risks that you just laid out, that it can be avoided?
Well, in my book about mega threats, I talk about these threats and also the solution for each and one of them. But the solution always implies cost and short-term sacrifices for the common good domestically and globally over the medium and long term. And whether you are in a democracy where, because of election, we tend to essentially kick the can down the road, but even in essentially authoritarian regimes, look what's happening in China, where you have essentially policies that are wrong because even autocrats are not able to do the right thing. We live in a world in which there is lack of global leadership at the national and the global level, and therefore these festering problems that are mega threats probably going to get worse rather than getting better. We need actually more governance at the global level because all these problems are global. Climate change, pandemic, financial economic stability, trade liberalization, and even global security. But in a world of geopolitical division, the ability and willingness to cooperate on these things is less than the past, and therefore that geopolitical fragmentation and economic and financial consequences become over time more severe and more difficult. So we need cooperation, but we're not going to have global cooperation, unfortunately.
I want to take one of your other mega threats, Nouriel, AI, and apply it to this too. We're about to enter an election cycle for many nations, for America, likely where I am here in the UK too. Have we fully grasped what AI and the age of misinformation will do, the impact it will have in this election cycle?
That's one of the very serious risks of AI. It's going to be much more easy to do deep fake, misinformation, disinformation. That was already quite easy in 2016 and 2020, but in 2024 it's going to become much worse. And the enemies of the United States, or the rivals, whether it's Russia, North Korea, China, Iran, are going to use these tools and other ones as a way of spreading actually doubt and sow divisions in a world where already the United States is very partisan. They're going to try to create more partisanship because from a military point of view, they cannot challenge the US yet with the strongest military power, so they have to use asymmetric warfare that implies cyber warfare as a way of dividing US and fragmenting us in a way that's going to be weakening the United States and the ability of the US to project power around the world. So it's a huge risk for next year.
Okay, Nouriel, thank you very much. Uplifting thought to end the 50-minute conversation, but well done. I think we almost got a smile out of Nouriel there this morning. Nouriel, thank you very much. Great to have you with us on our inaugural show. Your contribution, as always, great to have.
With Barclays, every change leads to a bold possibility. You have the vision, we have the insights, financial solutions, and global perspectives to help you make it real. Barclays Corporate and Investment Bank, powering possible.
Good morning. Welcome to Daybreak Europe. I'm Kriti Gupta in London. Let's get to the top stories that set your agenda. Asian stocks fall in the wake of big tech declines on Wall Street. Traders stand by for a big week of central bank decisions from the U.S., the U.K., Japan, really all around the world. We're bringing you, of course, the best analysis on Bloomberg Television and radio. Across the Atlantic, the United Auto Workers Union rejects a 21% pay raise from Stellantis as, quote, definitely a no-go. The strike against the big three U.S. car makers enters another day as the team from the White House moves to Detroit. Plus, as world leaders gather for the UN General Assembly this week, German Foreign Minister Annalena Baerbock tells Bloomberg Europe needs to end its reliance on China. Let's get a quick check on these markets here because, of course, all investors really bracing for what we're going to hear out of the central bank decisions. The ECB already kind of rocking everyone's world last week and really pulling back on a lot of pushback from across the continent. That's going to be significant when we talk about just how people are positioned going into this central week of central bank decisions, I should say. Let's start from the bottom up here because, of course, the Fed is going to be the highlight this week followed by a lot of the moves from, of course, the BOE, but then all around the world. You have Brazil, for example, reporting of the BOJ at the end of the week. What does, by Friday, the central bank rhythm really tell us about whether or not we're ending this period of heightening? And that's really going to be crucial, again, when we talk about the equity market. How much of that is going to have an effect on the lags that are priced into the market and the ripple effects into the equity market? Right now, a little bit of sour sentiment coming off in Europe at the moment. You are seeing the brunt of it being taken by the FTSE 100 futures. Not that much reaction in Euro Stoxx 50, but a lot of that might simply be sentiment coming from Asia. We're going to dive into what's going on in that part of the world in a second. Right now, green on the screen in the U.S. session, though, and that is interesting because a little bit of a defensive trade at play there. Another big piece of the picture to keep in mind is the inflationary measures, specifically when we talk about Brent crude, for example. That's where you're going to see a lot of green on the screen, higher by 0.6%, almost $95 a barrel for that commodity. That's going to be crucial. And already you're seeing a little bit of a ripple effect into the commodity exposed currencies. Take a look at the Kiwi, the Aussie, all weighing your biggest contributors, by the way, on the Bloomberg Dollar Index. Even the Swissy now paring back some of that earlier weakness. That's, of course, something we're going to keep a lot of eyes on at the moment. Right now, we are getting some breaking news, specifically from SocGen. They are starting to really talk about revisiting some of their strategy. Remember, they are right now trading at their lowest price-to-book ratio, lagging all of their European competitors right now. Now, really talking about what that strategy actually looks like. They're saying that they're phasing in their CET1 ratio to about 13% by the end of 2025 in the 26 and under Basel IV program. Now, of course, we're going to keep you apprised of all those developments. Caroline Conan is going to join us from Paris to dive into what this all actually means. Right now, let's get to our stories from around the world. We are joined by our all-star reporting team from right here in London, Singapore, and Berlin as well. Valerie Teitel, Avril Hong, and Oliver Crook join us. Valerie, I want to start with you because really the market story is going to be the crucial driver this morning, specifically when we talk about the Federal Reserve. Let's start there. Thorsten Slock over at Apollo came out with some analysis this weekend saying that, look, the lags are not priced into the economy. We're still going to see a lot of that. To me, that is front of mind. What's front of mind for you?
It's how far they shift those dots, Critty. A lot of speculation on a possible shift higher in the 2024 dots. Remember, those dot plots is the way that those Fed members communicate where they think the terminal rate is by the end of the year. They could possibly shift those 2024 dots higher in a bid to convince markets that higher for longer is here. However, there are some speculation that we could also see the shift in this threat of additional hike move from this year into next year, which would be a very interesting way for the Fed to communicate that threat of additional hike is on the cards, but maybe not until 2024. Those are the dynamics at play for the Fed.
What kind of precedent does that set then for the Bank of England, for the BOJ? Is Jerry Powell central banker to the world right now?
Well, if the Fed goes on extended pause from here and we have the ECB already signaling quite the same, maybe we do get the same lines from the Bank of England. However, it could be too early for here in the UK. We do get that CPI print on the eve of this Bank of England decision. Possibly a reacceleration and core inflation would prevent the Bank of England from signaling that the rates have peaked here in the UK, but I think the market is expecting Bailey to sound dovish as he did 2 weeks ago in the Treasury Select Committee, and very much hint that the peak of rates is here.
Well, I think what's so interesting about that is just even over the weekend, you heard some people saying, from some European leaders really pushing back on Lagarde's strategy. I think one leader, I can't remember, I believe from Italy, saying she's living on Mars. So some really big fighting words, again, coming out of the European leaders. That divergence you're going to see between the monetary policy and the fiscal policy really escalating, for lack of a better term. It's pretty interesting to watch. Valerie Teitel all over that story. We thank you as always. Let's, of course, get a quick check on how Asian markets are faring as well. Remember, the Fed, the central bank anxiety, is going to have ripple effects on what the Asian markets are going to be doing, specifically when we get closer and closer to the BOJ on Friday. Avril Hong is standing by in Singapore. Avril, walk us through it.
Yeah, Christy, you talk about the central bank anxiety, but it's not just the Fed or the BOJ. We're watching here in Asia. We're also keeping a close watch on the Chinese real estate sector. The pessimism surrounding the health or lack thereof of that really offsetting any signs of optimism that we're seeing. Stabilization coming out from the Chinese economy, at least based on some of the data that we got out of the Asian giant last week. And then we have also today the tech sector dragging the benchmark in the region. The TAIEX, for one, is also underperforming, dragged also buy tech after the declines in big tech on Wall Street last week. So perhaps unsurprising, the kind of moves we're seeing. But I want to focus also on the CSI 300 because we pulled to the lowest level that we've seen this year. Earlier on in the session, it's pulled into the green now, but the focus really is on the Chinese property stocks. So let's take a look at how some of them are faring. In focus, Country Garden, we have a key event coming up later today. There is among them a vote that is due for its yuan bond extension. Evergrande, another stock to watch, and this is on the back of developments over the weekend where we got those police arrests or detaining some of the members of its wealth management unit. So we saw it dropping 25% early on in the session. It's pulled into positive territory now, but really the concern is that this could be a sign that it is a new phase for the property developer and whether this is going to mean more problems to come for Chinese real estate as we look ahead to some of these central bank decisions this week. Kriti.
And of course, at the core of it is going to be that inflationary story. But April, something we're not just talking about is the wage piece of that equation. That's where we go next. April Hong in Singapore with how the Asian markets are faring right now. Again, at the core of it comes to the stickiness of inflation. Again, a big part of that is going to be the wage story. It is going to be, at the end of the day, how a lot of these unions, specifically in the United States, are setting prices for around the world and the ripple effects there. Take a listen to what Mary Barra, the CEO of General Motors, had to say in response to one of the biggest strike stories in the world right now.
I will say we're ready for this, as we've dealt with COVID and dealt with the semiconductor shortage, as well as other supply chain challenges that have, continued to persist from COVID. Our team knows how to manage these situations. They're staying agile, and we're going to do what's right for the company. We're going to make sure everyone stays safe.
Mary Barra there, of course, the CEO of GM, responding to some of the fighting words coming out of the United Auto Workers, representing about 150,000 workers in the heart of Detroit, representing Ford, GM, and Stellantis. Bloomberg's Oliver Crook in Berlin is, of course, monitoring the international impact there. Ollie, walk us through the updates over the weekend.
Right, so let's remind us where we were going into this weekend, where we had GM and Ford going with 20% wage increases as an offer, Stellantis at 17.5%. The union was asking for 36%, the cost of living adjustment, and the 32-hour week. And then on Friday, we heard from Biden really coming out on the side of the union, saying that really that the record profits need to be shared in the form of record contracts. So what did we get from that? Stellantis this weekend up to 21%. We heard from the president of the union there, not impressed.
And that's going to be...
So 21% is a no-go for you?
It's definitely a no-go, and we've made that very clear to the companies.
No-go. There were reasonably productive conversations, they were saying, over the weekend with Ford. GM was at the table on Sunday, but really there still is a very massive void here between where these two parties are, and it's really hard to see how there's going to be a resolution really anytime soon.
Ollie, I had to jump in. It was so interesting. The strike story is fascinating. What is the White House going to do about this? I believe a team going to Detroit over the weekend.
Yeah, so they're deploying a team led by Gene Sperling and Julie Su, which is going to be in Detroit at some point, they said, early in the week to help sort of facilitate negotiations, to really sort of be there as a sort of mediator, moderator, not really to be actively involved, but to help facilitate the conversation. But listen, the union has very deliberately said that they're going to be strategically ambiguous about how they deploy the strikes. As we know, they've had a wide strike in the sense that it's hit 3 states, 3 companies, but it's been a shallow strike, only 13,000 people. This is a union, as I think you mentioned, of 150,000 people potentially. And what they're contending with is this strike fund that they have of $852 or $25 million that will be slowly eroded as people go on strike. So as they amplify that strike, it'll bear on how long they can go. If every single worker were to strike, it could last only 11 days. But the way that they're rolling it out, this is really could last for quite some time.
That's going to be something, of course, we're watching very, very crucially. Bloomberg's Oliver Crook in Berlin all over all of those updates. And speaking of updates, we've got 2 more for you. We'll start with Naspers, of course, the internet company based in Johannesburg, South Africa. Well, look, their CEO is stepping down. Bob Van Dijk is, of course, their current CEO, is going to be stepping down both Naspers and Prosus. Instead, they have reinstituted an interim chief executive. Irvin Tu is the person to be watching there. Right now, it's unclear what the reasoning is there, how long the interim chief will be in charge. But for now, it is something that we're going to be watching at, of course, the market open for Naspers right now. Those shares year to date higher by 15%. Another major corporate story that we are watching comes right back to the banking sector. SocGen, of course, talking about just how much they're going to be revisiting their strategy after saying, well, look, it's been a pretty dismal summer when it comes to some of the kind of recovery that they were expecting. Remember, from a price to book ratio perspective, SocGen has been lagging. Now it looks like they're saying their CET1 ratio will be at about 13% in their 26 and under Basel IV program. So, of course, we're going to dive more into that throughout the rest of the show. For now, you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can very easily type in DAYB GO on your Bloomberg terminal. Coming up, we head to the U.S. House Speaker Kevin McCarthy demands an 8% spending cut for domestic agencies to avoid a U.S. government shutdown. More on that next. This is Bloomberg.
Powering financial solutions that transform industries. Powering seamless execution in evolving markets. We deliver our entire global bank to power new possibilities for you. Barclays Corporate and Investment Bank. Powering possible.
Welcome back. This is Daybreak Europe. I'm Kriti Gupta in London. Germany's foreign minister says the European Union must reduce its reliance on China. Annalena Baerbock tells Bloomberg's Anne-Marie Hordern about how the region's strategy has changed thanks to the global fallout from the war in Ukraine. Take a listen.
We have learned our lessons from our Russian dependencies. And again, I believe it's a strength if you can be also in politics self-reflective, of saying, okay, this was obviously not the right way to go. We had such a high dependence on Russian gas and oil, but especially gas, that obviously in the past former governments took decisions which weren't the right one. Speaking about the gas pipeline Nord Stream 1 as a purely economic thing, nothing to do with geopolitics. And I was in a position back then, and I was also at the Yamal Peninsula, for example, where there was a source of this pipeline coming through. I spoke to many people there, and I could not only feel from our partners in Poland and the Baltics, but also there, that this has obviously a geopolitical dimension. So before election, I was always arguing we have to not only trust on words, but we have to see the action. And now, when we came in government, we said already in our coalition treaty that we have to rephrase our dependencies. We formulated also before the Russian war that we will do a new China strategy. And after the invasion, the full invasion, we not only wrote the strategy, but we prepared for the things we should change in the future. And this is like limiting.
Are you worried about Chinese retaliation?
Yes. So first of all, understanding that if you're bound too closely, it can endanger yourself, especially if you are having such a high dependency of a regime like in Russia, which is in the end attacking your own peace order. So therefore, cutting down our dependency from Russia, but also now with regard to China, de-risking is our total understanding of the strategy. No decoupling, because you cannot decouple in an interconnected world. And a connected world is also way to peace. But we should be able to defend ourselves, not being naive. And so being a partner in climate issues, being a competitor, obviously, with China with new technology, but also seeing that we are systematic rivals and we have to protect our own vulnerability. And this is where von der Leyen comes in, the Commission President, to strengthen our critical infrastructure in Europe, but also looking at outbound investment screenings.
The German Foreign Minister Annalena Baerbock speaking there to Bloomberg's Anne-Marie Hordern. Let's take a look at some of the other stories we are tracking from around the world. Over in Africa, the death toll from devastating floods in eastern Libya has surged past 11,000 in the city of Derna alone. The United Nations estimates that more than 10,000 people remain unaccounted for in the city after a rare hurricane-like storm slammed into the North African nation last week. Almost a quarter of Derna's entire population are either missing or confirmed dead. U.S. National Security Advisor Jake Sullivan and Chinese Foreign Minister Wang Yi have met over the weekend in Malta. Among the agenda items, a possible meeting between President Biden and Xi at the APEC summit in November. The Malta meeting comes at a critical time in U.S.-China relations, with Wang scheduled for talks with Russian officials in Moscow this week. And Elon Musk has visited Turkish President Recep Tayyip Erdogan in New York, spending about 45 minutes discussing artificial intelligence and a potential Tesla factory in the region. SpaceX has also been working with Turkey's space program to launch communication satellites. The meeting comes as world leaders begin to gather for the annual meeting of the United Nations General Assembly. And now to some news overnight from the United States. House Speaker Kevin McCarthy has made demands to hold off a government shutdown for a month, presenting the plan to Republican lawmakers in a conference call. For more insight, we're joined by Bloomberg's Derek Wallbank. Derek, look, you're reading these stories and the same buzzwords come back over and over again. Kevin McCarthy, cuts to social programs, a really tight deadline, and fiscal calamity. Derek, walk us through for our international audience the difference between this government shutdown and the debt ceiling debate we just had a couple of months ago.
Well, Critty, you're right to notice a lot of the similarities. It's sort of like if you have a Hollywood movie and then you get a sequel. The sequel's not quite as good, but it hits some of the same notes. That's somewhat of how I would look for an international audience at this fight here. It's not as serious as the debt limit fight, candidly. The debt limit fight was something that could have, had it gone spectacularly wrong, upended the very basis by which international markets find their foundation. This one is more annoying initially, although it's quite severe if you happen to be quite in the middle of the crosshairs. What you're talking about specifically is a funding lapse, a government funding lapse. The U.S. government runs on an October to September calendar. October 1 is the fiscal new year, so happy fiscal new year to everyone out there who's going to be celebrating. But it won't be a very celebratory mood in Washington, specifically in all of these places in the U.S. that have real connection to federal dollars, because a lot of those dry up very quickly. The government has to go through, say what's essential, what's not essential, and all the non-essential stuff, the money stops. The essential stuff, some of the money continues, but sometimes in reduced form. So it's a complicated sort of situation, but basically October 1, midnight Washington time, that's the deadline.
And Kevin McCarthy, of course, loves to really hammer on to the austerity of it all. Derek, talk to us a little bit about what can actually be done. It feels like the one thing that perhaps both sides can agree on at its core is some sort of short-term funding response. What could that actually look like?
Well, you would think so, but the math isn't actually quite so easy. Kevin McCarthy right now is trying to figure out what he can get through the House to give him a little bit of a leveraging edge. It's literally the same playbook as the debt limit. So Republicans are trying to figure that out. The current offer seems like it's going to be about a 1-month stopgap spending bill, and attached to it border security money. The problem is the White House doesn't really want to do that, and the Senate doesn't either. They don't want the Republican border security bill because it contains a whole bunch of things that they don't like. The Senate also wants to include, and the White House does too, some money for Ukraine. There's some disaster aid money that could ride along with this as well. So it's a little bit more complex there. McCarthy's got a math problem in that he can lose at most 4 Republican votes. And I counted, just based on statements on X, the former Twitter, just since this plan came out, and now more than 4 people who said that they don't like this plan from within the House Republican Conference. So it's not quite clear how the math goes here, how you get to the number that gets you across the line. I'm sure as a fundamental baseline that there are the votes to fund the government in some form if you get Democrats and Republicans working together. But right now, that isn't really on the cards as an opening play. So I think, remember when we were talking the last time about the debt thing, and I said at that point, sometimes in this you go, no, 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 yes. we're in the first one or two no's here in that cycle.
You know, I love that you say Kevin McCarthy has a math problem because naturally, Derek, Americans are known for their math skills, aren't they? Certainly something we're going to be watching very, very closely from around the world. Derek Wallbank there joining us from Singapore to walk us through what's really a crucial story for the U.S. government, but maybe it doesn't feel like that. Maybe it feels like a little bit of deja vu, at least coming up later. Perhaps a little bit of a different approach from Australia, a new boss for the RBA. We're going to bring you all the details on Michelle Bullock, the new governor of the Reserve Bank of Australia, what that actually looks like. We're going to dive into it next. This is Bloomberg.
The Mariah is just an unbelievable place. It's a cultural oasis, and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
Welcome back. This is Daybreak Europe. I'm Kriti Gupta in London. Let's get to some corporate stories from around the world. Apple partner Foxconn plans to double its investment and employment in India, highlighting an accelerating manufacturing shift away from China. In a LinkedIn post, the Taiwanese company said it plans to double the size of its business in the South Asian country. Foxconn's Bengaluru plant is likely to assemble iPhones and is expected to create about 100,000 jobs. Now from Foxconn over to Burberry. The chief executive of Burberry Group says tourists are spending more on luxury goods in mainland Europe than in the UK. That comes after the loss of tax-free shopping for visitors to Britain. Speaking to Bloomberg ahead of London Fashion Week, Jonathan Akeroyd says a gap has opened up between the markets.
Overall, globally, our tourist sales have obviously been increasing in the last couple of years, which is a positive. So that's a good trend. Unfortunately, there is a gap between our tourist spend growth in mainland Europe versus the UK, which is disappointing, especially as it's our home market. So we'll keep communicating that. We think probably post-Brexit, it would have been an opportunity. It would have been an opportunity to bring more tourists in. So we hope that sometime soon things will change.
Jonathan Akeroyd there, the Burberry CEO, talking about the changing landscape in front of the fashion dynamic. Of course, he will be there for London Fashion Week this week. Let's get a quick check on the markets here because you're already seeing some movement, but I wouldn't say a ton of movement. Let's walk through it here. When you look at the futures trading, specifically in European futures, you are seeing an accelerated selling in FTSE 100. Euro Stoxx 50 futures down as well, about, we'll call it 0.1%, but not really seeing that kind of pressure that perhaps a lot of people would expect after really the pain that you saw this weekend, or at least the pushback from European leaders when it comes to Madame Lagarde, President Lagarde, I should say, and the ECB's policy there. Nevertheless, the FTSE 100 really taking it on the nose. And I think that red on the screen is really coming from the Asian session. On the other hand, perhaps a little bit of a defensive tilt. Take a look at what U.S. futures doing are by comparison. S&P futures higher by 0.2%. Tech underperforming this time around. That is an interesting dynamic, given that Asian stocks and European stocks are actually lower at the moment. That's going to be a dynamic we explore in the rest of the show. Coming up, Michelle Bullock becomes the new governor of the Reserve Bank of Australia and its first female chief. More on that next. Stick with us. This is Bloomberg. Good morning. This is Daybreak Europe. I'm Kriti Gupta in London. Let's get to the stories that set your agenda. Asian equities dragging lower thanks to the tech sector largely. Traders standing by for a big week of central bank decisions, including the United States, UK, Japan, and a slew of others from around the world. in the U.S., the United Auto Workers Union rejects a 21% pay raise from Stellantis as, quote, definitely a no-go. The strike against the big three U.S. car makers enters another day as a team from the White House heads to Detroit. Plus, as world leaders gather for the UN General Assembly this week, German Foreign Minister Annalena Baerbock tells Bloomberg Europe needs to end its reliance on China. Let's get a quick check on the markets here because already you are seeing some red on the screen, perhaps a result of what you're seeing in Asia. We're going to dive into the Asian markets in just a moment. But right now, a lot of pressure on FTSE 100 futures, down about 0.3%. By comparison, Euro stocks futures seem to have it easy. But is that going to sour more as perhaps in the U.S. session it catches up to the souring sentiment you are seeing around the world? By comparison, though, U.S. futures are higher. S&P futures higher by 0.2%. NASDAQ futures dragging a little bit. And I think what's interesting here is the dynamics that tech is actually lagging, similar to what you did see in the Asian session. Going cross-asset, Brent crude getting closer and closer to $100 a barrel, higher by 0.6%. We'll call it $95 a barrel there. Really having a ripple effect into the currency market. The Kiwi, the Aussie, those commodity-exposed currencies actually strengthening against the dollar right now. The dollar the weakest in the G10 currencies. Let's get a quick check on how Asian markets are faring. Avril Hong standing by in Singapore. Avril, walk us through it.
Yeah, Kriti, we're seeing those Asia stocks slipping into negative territory, staying there for much of the session. This has to do with that tech decline on Wall Street last Friday, which filtered through into the Asia session, and the TAIEX is underperforming in the region, dragged by tech. We're also in a week of big central bank decisions, the Fed, the BOJ. Japan markets are shut today, but we do have some important numbers out of the CSI 300. Just looking at the benchmark in the mainland, where it slipped into its lowest level this year because the concern really is on the property sector. The sentiment is turning tail there. And this is despite some signs of stabilization in the Chinese economy from data last week. So let's take a look at some of these property stocks because Country Garden is a key focus here. There is a deadline that is due later today on a yuan bond extension. So it is actually in negative territory now. We're also keeping our focus on Evergrande after police detained some members of its wealth management unit. So some observers point that this could be a new phase in the defaulted developer, the saga surrounding it. Are we going to see more troubles for the real estate developer? And it actually slipped 25% earlier on in the session. It recouped some losses earlier, but is still in negative territory as it comes back from the lunch break. Kriti.
Avril Hong in Singapore tracking the Asian markets. We thank you as always. Right now, the Asian markets are driving the trade, but hold your horses because at the end of this week, all bets are off. A massive week for central banks this week. The Fed will take center stage with the FOMC rate decision on Wednesday, the BOE on Thursday, and the BOJ on Friday. For more acronyms, I hope, Bloomberg's Valerie Teitel is standing by. Valerie, let's start with the Federal Reserve here. We're not expecting a hike. What kind of signals should the markets be watching? What kind of precedent does it set?
The Fed pause is finally here, Kriti. That's the big message. But the markets will be watching what exactly they try to message with their updated economic projections in that SEP, which does include their dot plot. Will they shift the dots higher into 2024 in a bid to convince markets that higher for longer is really here to stay? Or perhaps will Powell sound a bit dovish? Will he mention the auto strike that's currently ongoing? Will he also mention other risks on the horizon and maybe move that threat of additional hike out to next year? The dot plot is going to be the key thing markets are watching for. They are expected to go on hold.
And perhaps taking a completely different approach to the Bank of England, as you just pointed out. Talk to us about the BOE here. Are we nearing a peak? Is that a positive in theory for British assets?
That could be the surprise that Bailey has in store when the Bank of England meets on Thursday. Does he actually acknowledge that these are peak rates? Does he follow a bit of the ECB's playbook of last week and somehow tell the market, signal to the market in that statement that we have hit peak rates? But this decision on Thursday from the Bank of England is made ever more complicated by the fact we get a CPI print tomorrow. And core inflation, Kriti, is not expected to moderate very much. Bloomberg consensus has it ticking down only by 0.1%. Finally, we get the Bank of Japan on Friday, widely expected to hold interest rates at that negative level that they can continue to sit on. However, will UEDA push back on the market speculation that a tightening cycle could come possibly at the end of this year or the beginning of next?
I mean, you just mentioned it, the BOJ. We keep waiting for that to really be the surprise, and it hasn't yet. Bloomberg's Valerie Teitel, I wonder if you've jinxed it. We thank you, as always, for walking us through that story. Let's go to another major central bank around the world. We're monitoring very closely. The Reserve Bank of Australia has a new governor, and for the first time, it's a woman in the top job. Michelle Bullock takes over from Philip Lowe and becomes the bank's 9th leader. That all starts today. Joining us from more is Bloomberg's Swati Pandey, joining us from Sydney. Swati, we kind of knew Michelle Bullock was going to be joining the helm of the RBA. How different will it be in practice?
Look, Kriti, in the near term, it's not going to be a lot different. By near term, I mean the rest of this year. But come 2024, we are going to see a different central bank with a separate monetary policy board, fewer interest rate meetings, so 8 instead of 11, press conferences after each meeting. There are none at the moment, and probably better messaging, better communication. And Michelle Bullock has also talked about improving the culture inside the Reserve Bank, which was one of the criticisms that it had received. So definitely in terms of the composition, it will be a different institution, but also in terms of how it communicates.
Well, interesting to see that those are going to be some of the top priorities. But I have to ask, when the current is kind of all going one way for central banks around the world, I mean, at the core, this is really what we're talking about with the Fed, with the BOJ, with the BOE. How much do they diverge? At the core, everyone is trying to tackle inflation. How much flexibility does she really have if you are kind of dealing with this global current?
That's right. Inflation is one of the RBA's top priorities as well, and it's going to be Michelle Bullock's key priority too. And this is something that she said not too long back in one of her communications, in one of her Q&A sessions after a speech. So she described inflation as still too high in Australia. It's closer to 5% right now, and the Reserve Bank's mandate is 2 to 3%. So she really has this task still to bring inflation down. And we have seen 4 percentage points of interest rate hikes by the RBA since May 2022, which is less compared to what the Fed has done, which is 5.25, what the Reserve Bank of New Zealand has done, which is also 5.25. So the RBA has moved more cautiously, and it looks like Michelle Bullock will continue to be cautious about raising interest rates by a lot more from here.
For me, I think the big question, though, is, all right, we're talking about raising interest rates, and my producer actually just pointed out the fact that 5% no longer seems that high, which I think is a very, very valid point. Let's talk a little bit about turning the boat, though. I mean, if you do look at central bank decisions around the world, the Central Bank of Brazil, I should say, is actually going to be one of the very first to cut. Again, shout out to another producer who pointed that out to me. If we start to see this kind of turning the boat, if you will, turning the ship, can the Australian economy really deal with something as volatile as that? What do you think?
Yes, look, when the Reserve Bank started raising interest rates, it looked like under 3% would be where the peak would be. And that was largely because Australia's economy is heavily indebted. Households have really high debt. So we have a household debt to income ratio of close to 200%. So that was one of the reasons why it was believed that the RBA will not go very far. And when the RBA started taking interest rates to above 3%, people started talking about recession, and now the cash rate is at 4.1%, and people are not talking about recession anymore, because you kind of see that you kind of get some optimism from the US, which is tracking well, and domestic data in Australia has also been all right. The labor market continues to be strong. The property market has rebounded strongly. So it does look like an economy that has absorbed these 4 basis points of interest rate hikes, and inflation is coming down as well. So it kind of feels like the strategy so far has worked for the RBA.
Well, let's see how long it does. As of course, we see commodity prices get higher and higher. $100 oil could be a positive for Australia. It could also be a pretty big negative. Bloomberg Swati Pandey in Sydney all over that story. We thank you as always. Coming up, we go to the micro. SocGen announcing plans to help revive its long-time underperforming stock. We're going to bring you the details next. This is Bloomberg.
Die Welt zu einem besseren Ort zu machen, das treibt uns Menschen an. Und genau das treibt uns auch bei Bayer an. Mit Hilfe der Wissenschaft verfolgen wir unser Ziel: Health for all and Hunger for none. Wir wollen, dass jeder Mensch die Chance auf ein besseres Leben hat. In einer Welt, die wir mit Stolz an nachfolgende Generationen weitergeben können. Bayer.
I think that we are at the right level of interest rates in the EU to stop inflation and to reduce inflation. And this is the goal of these interest rates, to reduce inflation. We are on the right track. And I think, as Christine Lagarde said, that we should stick to that level of interest rates. It is the right level to reduce inflation.
French Finance Minister Bruno Le Maire there speaking with Bloomberg's European correspondent Maria Tadeo. And really within the last hour, France has been in focus. SocGen, one of its largest banks, has announced plans to increase efficiency and capital strength. Let's go to Bloomberg's Caroline Conan in Paris. Caroline, walk us through the top line of this morning's announcement.
Increased efficiency is really the key word here when you look at this strategic plan unveiled by Krupa. The new CEO of SocGen this morning, they're going to hold their Capital Markets Day in London today. We're just 4 months after Krupa took over from Frédéric Oudéa, who had been the CEO at SocGen for 15 years. And in fact, the SocGen stock has been underperforming its peers, BNP Paribas and Crédit Agricole, for years. So today, this could be a major driver for the stock. The CET1 ratio, which is a key measure of financial strength, will be lifted to 13% from 12%. They're targeting actually quite conservative targets when it comes to revenue growth between 0 and 2%, when the previous target was actually around 3%. And also very important, the CEO wants to rein in costs. So a cost-to-income ratio will actually be below 60% in 2026. Finally, no increase in dividends. Krupa is maintaining the payout ratio of SocGen between 40 and 50%. For example, it's around 60% at BNP Paribas. So quite conservative targets here from the CEO Krupa. We'll see how investors react. But some analysts say this could be hopefully a turning point for SocGen in the years going forward.
You say a turning point. I mean, I think to your point, some of these changes are very conservative. They seem very limited. How much of a difference is this really going to make? What does it mean for the bank going forward?
Yeah, and you're totally right. In fact, when you look at these changes, you could say these are only slight changes in terms of targets. And some analysts actually said even before this press release this morning that Krupa's margin of maneuver was quite limited because their capital cushion is quite low compared to some peers. We'll see how this changes the stock's valuation. This is clearly the mandate that Krupa has got from the chairman, Lorenzo Bini Smaghi, who said, we want to rein in costs, we want to boost the shares valuation. So the key word here is efficiency. They've already gotten rid of some African units. They might get rid of some more. They're also looking at options for their asset custodian units. So we'll see going forward if they dispose of more assets. Clearly, Krupa wants to tighten the belt at the French bank. For example, for employees, the new rule that if you do a business travel, it's 3 days maximum with a minimum of 4 clients meetings. So quite a high, ambitious target here to get some return on investment for this business travel. However, we do not know yet whether there will be some job cuts going forward. At the moment, SocGen is saying no big wave of job cuts going forward.
And that is probably music to a lot of people's ears, just given that a lot of these European banks, and the UK included, are seeing a lot of those jobs cuts. Caroline Conan reporting from Paris. We thank you, as always. To the broader European story, Ukraine is defying Russia's de facto blockade of its Black Sea ports by sending empty ships to collect grain. It's the first time this has happened since a safe passage deal collapsed almost 2 months ago. Joining me now is Bloomberg's Ben Sharples, all over both the commodity picture and energy, and of course soft commodities as well. Ben, talk to us a little bit about what this actually means for grain. We've seen all this volatility kind of priced into the soft commodity space. This particular move from these Ukrainian ships, how much of an effect is it having?
Well, the big question here is, how is Russia going to respond to this? Russia has said repeatedly that it'll treat any ship sailing to Ukrainian ports as possibly carrying weapons. And last month they fired on a cargo vessel, forcing it to stop for checks. So it's Russia's response that we're looking out for now. Now, for Ukraine to move its crops, it's had to resort to complicated and more expensive ways to get that out, and that's road, river and rail. And since Russia exited the grain deal in July, which allowed for the safe passage of Ukrainian grain out of the Black Sea, it's repeatedly attacked facilities through the Black Sea, including on the Danube. So if the ships manage to get grains out, it'd be a win for Ukraine, but I doubt that Russia is going to make this very smooth for them.
Talk to us a little bit about how this is actually traded, though, because, of course, you just mentioned we are waiting for Russia's response. At the time, we are also talking about whether some sort of new grain deal will be negotiated. Turkey at the core of that conversation. Ben, in terms of the appetite to actually trade this stuff, is there any?
Well, at the moment, if you look at the wheat futures market, prices have been sort of bobbling around $6 a bushel. But if you look at over the year, prices are about 25% lower at the moment, and that's primarily because of bumper harvests in the Northern Hemisphere, including Russia. So there is grain going into the market, and that's weighing on prices and taking a little bit of heat out of the tension that we're seeing in the Black Sea. Looking forward, we're going to look at the harvests out of Canada, Argentina and Australia, and there's a bit of concern there about dry weather and what that might mean for crops. But at the moment, there is enough grain in the market, especially for wheat, that it's keeping prices suppressed.
I mean, it's a really interesting dynamic. Something that I'm waiting for to kind of show up in the soft commodity space is simply this idea that you saw this in the oil space when the oil got very complicated to trade. When Russia first invaded Ukraine, you had this concept of where open interest has completely collapsed. I'm waiting to see if that happens in the soft commodities market as well. Bloomberg's Ben Sharples all over that story. I want to get a quick check on the commodity space broadly, though, because this is a really, really important story as we talk about inflation, as we talk about the stickiness of oil. There's a chart I want to bring to your attention because you are, of course, seeing oil inch closer and closer to $100 a barrel, something that's creating a lot more pressure on refined products, things like diesel, for example, where you're starting to see a real worldwide shortage. This chart on your screen shows you that the oil price and the bond price are not actually in tandem. Right now, you're seeing a real split between the two. All you need to know is that those two lines really work together. Higher oil means higher inflation, means higher yields. That is no longer the case, which tells you that the bond market is not really pricing in the fact that an oil rally will lead to a sustainable inflationary story. That's going to be a theme we dive into for the rest of the show, the rest of the day, and likely the rest of the year. Coming up on the show, public confidence in the Bank of England plunges to a record low. More on that story next. This is Bloomberg.
The big change we've had is a lot more fiscal discipline from the government. So that's a real plus. And I think I'd almost put that, ahead of the rest of the globe in that way.
What I see, and what I hope markets and businesses see, is a UK government that recognises the importance of sound public finance.
I think for every 100 days, maybe there's 5 to 10 days when the UK and the Eurozone can pull the US around.
Wonderful entrepreneurial spirit, great education. So I think in the long term, you would still have to put UK at the top of the list.
Guests on Bloomberg Television speaking about the UK's economic outlook. And let's just stay with the United Kingdom for a second. Public confidence in the Bank of England has plunged to a record low thanks to soaring interest rates and elevated inflation. That's according to the central bank's own survey of household attitudes. Bloomberg's Lizzie Burden, our UK correspondent, is all over that story. Lizzie, let's start with the political response to this specifically, because when you're looking at Labour, they've been trying to win over the business community. Is it working?
Yeah, so there are two surveys to look at. There's the inflation attitude survey, as you mentioned, from the Bank of England, and then there's our latest MLive Pulse survey, which shows that 2 in 3 finance professionals who answered our call reckon that the opposition Labour leader Keir Starmer would actually be better for the pound and the FTSE than Rishi Sunak. It makes you think about what a hard job Keir Starmer's had to get to this point. He's been on his smoked salmon and scrambled eggs offensive, the modern version, of course, of Tony Blair's prawn cocktail offensive to woo the city. But he's had to row back on those nationalisation plans of his predecessor, Jeremy Corbyn. He's put his shadow Chancellor, Rachel Reeves, right at the forefront. And of course, she's got an ex-Bank of England background. At the same time, it makes you think about what a difficult job Rishi Sunak's having of healing those reputational scars left by Liz Truss and left by Boris Johnson.
Well, let's go to another key figure then. Keir Starmer making some headlines over the weekend with a little bit of a controversial policy. What do we know?
Yes, so he's been talking about tax rises for the rich. In fact, he refused to guarantee that that's not something he's going to do, which contrasts with what his shadow Chancellor Rachel Reeves was saying, that Labour won't raise capital gains tax or introduce a mansion tax. She also said that Labour no longer plans to raise the top rate of tax, which Starmer had pledged back in 2020. Starmer says that his plan is to grow the economy out of this public spending hole that we're in at the moment. But that sounds to me a lot like what Jeremy Hunt, the Chancellor, was saying in New Delhi at the G20 to Bloomberg. Yeah. But we know that he's also meeting Emmanuel Macron, the French president, this week, so really on that international charm offensive as well. I've got to wonder whether, on the Bloomberg UK Politics podcast on Friday, we were speaking to the CEO of the Northern Powerhouse Partnership. He says that businesses in the north of the UK are looking through the next 15 months or so of Tory rule and assuming that it's going to be Labour that's the next government. That's what they're assuming and planning for. Our international leaders doing the same.
Yeah, competition really kicking into high gear, both internally and externally. Bloomberg's Lizzie Burden all over that story. We thank you, as always. Let's get a quick check on these markets here as we head to the next hour of programming, because, again, souring risk sentiment. It's worth remembering that, of course, the Japanese markets were closed today, so some of this is simply going to be light liquidity. FTSE 100 futures really where all the pain is, down about 0.3%. Euro Stoxx 50 futures down as well. Look at the U.S. side, though. That's where you're seeing a little bit of green on the screen. Up next, markets today. Anna Edwards, Mark Cudmore, and Tom McKenzie will take you through the rest of the morning. This is Bloomberg.
There's a place where global markets are always open, where you can explore and discover innovative new offerings and hundreds of trading products right at your fingertips. That's CBOE, the exchange for the world stage.
You're watching Daybreak Asia, coming to you live from New York, Sydney, and Hong Kong.
Asia's major market opens.
The top stories this hour. Risk-off start ahead to a week with a rush of central bank decisions in focus, including, of course, the Fed, the BOJ. The dollar is slightly weaker in early Monday trade. Michelle Bullock taking charge at the RBA as the Aussie Central Bank embarks on its biggest overhaul in decades. And fresh tests ahead for Ambassador developer Country Garden. Deadlines are looming for both yuan and dollar bonds.
Take a look at how U.S. futures are trading early in the Asian session. We are seeing a little bit of upside after stocks fell in New York on Friday. We had the S&P 500, in fact, seeing a weekly loss. We had the Nasdaq 100 also falling about 2%. Of course, we're watching many different things, including triple witching options expiration date, not to mention anxiety over the fact that we don't know how long that strike in the auto sector will continue for. We also had data showing that New York manufacturing unexpectedly expanded. So we had Treasury yields gaining across the board, with a 2-year yield, in fact, topping 5% and holding at around the highest level in 16 years. And you can see oil prices also continuing to extend those gains above $90 a barrel. After 3 weeks of gains already, of course, is the supply outlook and those reports that we got last week, including from OPEC Plus, that we might see a deficit for the rest of the year. And of course, we also had data showing inflation expectations surprisingly actually falling to the lowest level in about 2 years or so. This is the University of Michigan data. We also had consumer sentiment rising a little bit, actually a little bit of a fall as well. Of course, higher prices really not helping consumer sentiment, and we're seeing those inflation expectations finally sort of rolling over and falling last month, Belle.
Yeah, Sherry, the question, of course, when it comes to commodity prices with that rising oil, how much it starts to build into price pressures later this year. But today, for the open, for equities, we are guiding for a weaker start around much of the region. Here you can see Sydney futures pointing to a drop of 0.5%. Kiwi stocks already online in the red. Japan, of course, it is shut today for a public holiday, but still keeping a very close watch on what's happening with the Japanese yen, because we're trading around a fresh year-to-date low against the greenback now, and really not much to stop it from pushing past that 150 before we approach the BOJ meeting later this week. We'll have more with Richard Yetsenga in just a moment, so that's all I'll say. But focusing in on China futures, of course, because that weakness continuing to come through. The outlook there very different, facing the PBOC, but still woes around the property sector that are continuing to build, and geopolitical issues, a host of other reasons of why, if a change on now, foreign investors rather are continuing to leave this market. So this chart here takes a look at connect flows out of China or into China, but essentially what we're tracking here is the amount that investors are leaving the market. So if you were to take a look at how much money has been put in over the course of this year with that expectation around reopening, it was out the $32 billion mark. How much has been taken out, though, is around 50% at this stage. We can see here this chart taking us back to August, and only a handful of days where we've actually seen inflows into this market, Heidi. Well, as you alluded to, this 36-hour rush of monetary decisions, Belle, later this week may set the tone for the rest of the year, or I should say the remainder of the year. The world continuing to adjust to the US keeping rates high. The Fed will kick things off on Wednesday. J.J. Powell has acknowledged the economic backdrop is more favourable now than it was a year ago, but he's made it pretty clear that policymakers are ready to raise rates further if needed. Investors will also be watching the next policy steps in Brazil and Paraguay, which began their easing cycles in August. On Thursday, the monetary policy train rolls into Asia, on to Europe. The BOJ centre stage on Friday. Our next guest expects no moves from the Fed this week, but also sees no easing on the horizon that could take the pressure off Asian currencies. Joining us now in the Sydney studios, Richard Yetsenga, Chief Economist at ANZ. Richard, great to have you with us. So a little bit of respite for the currency volatility we've seen would, be welcome. But Belle mentioned it. We have oil prices about 30% off the lows. We have other commodities being affected by everything from climate to weather to labour market unrest. How much does that potentially complicate the picture for policymakers?
Oh, no, I think it does. The dollar's stronger, their own currencies are weaker, and commodities are a little bit all over the place. Although the fact that we've been getting supply reductions in oil and that's keeping the oil price up, I suspect policymakers are still generally on that. Well, if we need to do something, it's probably going to need to be to tighten. And so they're, the RBA, for instance, on hold, but still sounding like if they do anything in the short term, it would be to have to hike rates.
What about the PBOC? Or I should say, what is the rest of the world looking for out of China? Because we've had this piecemeal, policy support. I guess we'll see if the property market has truly stabilised. But it seems like structurally there's a lot more pain ahead for this economy that has, for so long, been, the engine of global growth.
Absolutely. I think what you're looking for depends on your perspective. For me, if we can get some stability in the economy and China's growing in a more stable fashion, I think that will be a very strong outcome. Some people are arguing you can get actually a renewed upswing in China that extends off into the horizon. I don't think that's the case. I think there are some serious structural challenges which are going to keep Chinese growth much weaker. But the data last week does say that actually the easing steps that have been delivered, and there have been probably more than 200 individual easing measures, they just haven't been the traditional cutting interest rates and spending more fiscal money. There've been a different style of easing. There's some evidence we're starting to see that actually the economy is starting to stabilise, and look, I think that would be a good outcome and help rebalance the currency story, because of course it's been hurt by this weaker China and stronger US side, and I think on the China side we're at least starting to see some stabilisation.
Yeah, I mean, as an economist, would you be doing something else? There certainly is an argument for direct household payments, given that we know that households have been so affected by the downturn in property.
Look, I think the first position is kind of what can you realistically achieve, and as I said, there is a school of thought that a lot of what bedevils China can be resolved by policy. I don't think that's right. The population is now...
You think it's structural, not...
The population's now shrinking. GDP per capita is nearly $20,000. It's a middle-income economy. Debt is 297% of GDP on the BIS's numbers. The combination of those three things we should expect is going to result in structurally slower growth. So policy, I think, can make a difference at the margin. If China tries to grow really quickly, I'm sure it could do that for 6, 12, 18 months, but then I suspect it would fall back to that slower baseline.
Not surprising, given the structural issues, we have been really hearing much more about the potential Japanification of China, right? When it comes to Japan itself, how are those structural issues working out with the BOJ's ultra-easy policy, and will that change?
Well, in fact, you don't have to... Of course, there's the Japanification story, but even the US in the last 100 years, as it's become wealthier, the rate of economic growth has slowed. So we don't need to, I guess, raise the spectre of Japan. But for the BOJ, I suppose the outstanding policy statement at the moment really is this commitment from them to deliver further easing if it's required. I mean, that seems increasingly redundant. I don't know that anybody expects that there's risk of, or meaningful risk of, further easing in Japan. Obviously, the question is, when will they start to tighten policy, if in fact they will? And I suspect it's not this year.
Will they take into account the weakness of the yen that we've been seeing?
I think so. I think they'll view the weakness in the yen as something which is perhaps helping inflation but is not necessarily a permanent influence. Obviously, there's been a global inflation pulse which has been helping inflation in Japan rise, but again is not necessarily a permanent influence. I think they really want to see that inflation, the economy is operating on a different pulse, and there's more domestically generated inflation in Japan.
When it comes to Australia, Michelle Bullock at the helm, is it sort of more of the same? Obviously, it's a challenging time, but you get the feeling that Phil Lowe kind of, fell on his sword and the hard work has been done.
Well, look, I've always focused on the policy task rather than the individual and the institution. I think the RBA, whoever's leading it, is doing its best to try and deal into its mandate, a big part of which is keeping inflation between 2 and 3%, and when it's not there, trying to deliver policy that gets it back to 2 to 3%. The economy has clearly slowed, domestic demand has clearly slowed, investment intentions are being pulled back. We've got a New South Wales budget tomorrow. We're likely to see some reprioritisation of spending because of a lack of resources and the cost around some of the infrastructure spend. They're all the things you want to see if you're heading towards a soft landing, and so far I think the central case is a soft landing in Australia.
And Richard, going back to where we started, what are we expecting from the Fed in terms of the dot plot? Because I think nobody's expecting any hikes at this meeting, but what will we expect from November or December?
Well, I think the main part of the dot plots I'm focused on is this medium-term expectation that the neutral interest rate is well below current levels. I think eventually we will get some Fed easing, but so far I think the Fed's probably going to find that as the longer it goes on with interest rates high, and while growth is slowing, it's certainly not slowing particularly sharply. I think that evidence from the current cycle is going to see them gradually bring that estimate of neutral up, and that's going to validate what's in the market, and it's going to validate the way the dollar has been trading.
Richard Yetsenga, Chief Economist at ANZ, here with us. Well, still ahead on Daybreak, we'll take a look at the BOJ meeting in Tokyo this week. The former Assistant Governor of the Bank of Japan will be along with us and tells us why he thinks they'll soon revise that inflation forecast for the year. But before that, industrial action against the big three US automakers enter day 3. Both sides are far from a resolution. We'll get the latest next. This is Bloomberg.
Die Welt zu einem besseren Ort zu machen, das treibt uns Menschen an. Und genau das treibt uns auch bei Bayer an. Mit Hilfe der Wissenschaft verfolgen wir unser Ziel: Health for all and Hunger for none. Wir wollen, dass jeder Mensch die Chance auf ein besseres Leben hat. In einer Welt, die wir mit Stolz an nachfolgende Generationen weitergeben können. Bayer.
Wall Street is waking up. Europe is already trading. And starting today, Manus Cranny and Danny Berger will make sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, premiering today only on Bloomberg.
Auto workers in the U.S. continue their strike against Ford, General Motors, and Stellantis as the UAW union pushes for a dramatic reset of wage scales and working conditions. Let's get more details from our auto reporter Keith Naughton, who joins us from Detroit. Keith, so how far apart are the two sides?
They are still very far apart. Over the weekend, Stellantis, the maker of Chrysler, Jeep, and Dodge vehicles, increased its offer to a 21% raise. GM and Ford are at a 20% raise, but the union is requesting a 36% raise. So there's quite a wide gulf between them at this point.
Does that mean we don't really have an end in sight in terms of how long this could last?
Yeah, we talked to one analyst who thought that this could last to the end of October. It's really hard to know at this early juncture. The companies are making some movement. The union, not quite as much. There seems to be a fair amount of disagreement. The UAW yesterday said it was making some progress with Ford. Today it just said it negotiated with GM. It didn't characterize it in any way.
So how are we calculating then at this point the costs for both sides?
Yeah, you know, there's one analysis out there that if there had been a full-blown strike of all 150,000 workers, we would see $9.5 billion in costs in just the first 10 days. We don't have that. We have about 13,000 workers striking at 3 plants, one at each company. But the autos do make up 3% of the U.S. gross domestic product. So any prolonged work stoppage is going to have an impact on the economy.
What are we hearing from President Biden?
So he has come out pretty strongly in favor of the union. He said the company should share their record profits with them. He says that is owed the union because they did a lot of concessions for GM and Chrysler when they went bankrupt back in 2009. Joe Biden really needs the labor vote here in Michigan in particular, where a lot of these UAW workers are at. He took the state in 2020, but he only leads by 1 percentage point in polling right now against Donald Trump.
So, Keith, at a time when we're fast shifting to electric vehicles, where would the breakthrough come from? What's next?
Yeah, so each of the companies, or I should say collectively, the companies have spent more than $100 billion on their electric vehicle programs. They have a lot invested into EVs. They say that's why they can't afford to Rich a contract. From the union perspective, they could ratchet up this strike. Right now, as I said, they've taken down one plant at each company. They could go next to the big pickup truck plants, which are the source of major amounts of profit for each of the companies.
Our Bloomberg Auto reporter Keith Norton there in Detroit with the latest. And we'll stay on the UAW strikes. And General Motors CEO and Chair Mary Barra says the company was ready for the impact of those strikes. She told Bloomberg that their offer to the union was strong and the plant shutdowns could have been avoided.
I'm extremely disappointed and frustrated that we're even on a strike. We didn't need to get here. General Motors has an exceptionally strong offer on the table. It's historic. It's the largest increase from a wages perspective in our 115-year history, along with world-class health care benefits and many other provisions, job security, et cetera, and a COLA adjustment. So when you look at the strength of the agreement we have on the table, we really don't need to be here. Yes, they have one plant down right now, and it'll impact three very important products. Two brand new, our Chevrolet Colorado and our GMC Canyon, both mid-size pickups that are in strong demand, as well as our Chevrolet cargo van that does exceptionally well in the market. So this is having an impact, and we'll have to see where they go next. I will say we're ready for this. As we've dealt with COVID and dealt with the semiconductor shortage, as well as other supply chain challenges that have, continued to persist from COVID. Our team knows how to manage these situations. They're staying agile, and we're going to do what's right for the company. We're going to make sure everyone stays safe. But this is a strike that didn't need to happen.
Mary, as you say, you've made an offer already for a rather substantial increase in wages. It's not what the UAW wants. Implicitly, you've agreed that they do need and deserve some increase in wages. But is this about more than that? Is this existential in a sense for the auto companies in terms of your need to move into electric vehicles, and from the UAW's point of view, that they believe that, in fact, moving to EVs will actually cut the workforce by as much as 40%?
Well, you're absolutely right. This is a once-in-a-century transformation we're in the middle of moving from internal combustion engine vehicles to electric vehicles. And at GM, we're at a very pivotal point because we have so many electric vehicles ready to launch, in the process of launching. And this is important to securing all of our futures. We need to get these vehicles out. We need to, they're wonderful vehicles. We've got waiting lists for most of them, or orders already in place. So it's important that we meet that demand. And one thing from a General Motors perspective, from job security, we have jobs for all of our people as we make this transformation. More than 2 years ago, we started planning for this. And one of the reasons General Motors invested in doing our own power units, which is a component that's very important on an electric vehicle, we designed them internally, and we are now allocating that production to the plants that build internal combustion vehicle engines right now. So we have worked very carefully to have a job for everyone so we can make this transformation together.
General Motors Chair and CEO Mary Barra there. And you can get a roundup of all of the stories that you need to know to get your day going in today's edition of Daybreak. Terminal subscribers go to DayB Go, also available on mobile in the Bloomberg Anywhere app. You can customize your settings so you only get the news on the industries and the assets that you care about. This is Bloomberg.
There's a place where global markets are always open, where you can explore and discover innovative new offerings and hundreds of trading products right at your fingertips. That's CBOE, the exchange for the world stage.
We do have some breaking news on Singtel. KKR has bought a 20% stake in Singtel's data center unit for up to 1.1 billion Sing dollars. Singtel is saying that Stellar, this is the fund managed by the global investment firm KKR, will have the option to raise that stake to 25% by 2027, saying that the fund will commit up to $1.1 billion for a 20% stake initially into Singtel's data center business. The investment is subject to certain conditions, including, of course, regulatory approval and filing. This is a transaction not expected to have any impact when it comes to the numbers for Singtel for the year ending March 2024. This, as we have seen, really telecom assets being in focus for KKR, particularly in some of the markets outside the US, including that in Italy as well. We're now hearing that KKR has bought a 20% stake with an option to further increase that up to 25% by the year 2027 in Singtel's data centre unit. Well, here in Australia, Michelle Bullock takes over as the country's first female central bank governor today. The RBA is also embarking on its biggest overhaul in decades. Let's bring our economics reporter Swati Pandey here in Sydney. So is the RBA likely to look different under Michelle Bullock?
Yes. So in the near term, there's not going to be a lot of changes, but come 2024, we are going to see a different Reserve Bank. They are going to be implementing the recommendations of an independent review, which suggested 2 monetary policy boards. So we will have two separate boards, one for monetary policy and the other for governance. So we'll have 18 members on the board from 9, the 2 boards included. So we are going to see a lot more people being appointed on the board. The deputy governor is yet to be appointed, so that's going to happen soon. We are going to have fewer interest rate meetings, more press conferences, and hopefully better messaging and communication as well.
Is that basically her focus, the revamp? What are her top priorities in office?
Yes, so Michelle Bullock was asked recently what her top priorities were, and she mentioned 2 biggest ones. The first is the fight against inflation. She described inflation as still too high, and interest rates are at 4.1%. Economists are predicting another 25 basis point hike later this year, but it does look like we are near peak. And her second priority is this whole revamp and implementing the review's recommendations. So also bringing about a change in culture, encouraging an atmosphere where debate or respectful challenge is encouraged as well.
What's the outlook when it comes to rates and the economy?
The economy is actually tracking all right. We have had 4 percentage points of interest rate hikes since May 2022, and it looks like the economy is absorbing those well. There were some fears initially that Australia may slip into recession because of these hikes, and that is largely because how indebted Australians are. We are amongst the most indebted in the world, with close to 200% debt to GDP ratio. And that it does look like people are taking it in their stride. Consumption has fallen off a cliff, but it's not dire. And job market continues to be strong. Unemployment is still very low. So it does look like we will avoid recession, and economic growth will continue through 2024 as well.
Our economics reporter Swati Pandey there joining us from Sydney. And here's a quick check at the top corporate stories. Bloomberg has learned that UBS cut 12 jobs in its U.S. investment bank last week as part of its integration of Credit Suisse. Sources say those impacted included UBS's co-head of consumer products and retail. Earlier, we reported that the firm is also expected to cut hundreds of jobs in Asia and could slash more than half of Credit Suisse's overall workforce. Bond deals arranged by Credit Suisse and Bank of America and connected to debt swaps for emerging market issuers are under renewed scrutiny. This is after the global standard setter, ICMA, issued new labeling guidelines. At the heart of the issue are so-called blue bonds using debt for nature swaps to further marine conservation. South Korea has asked Apple to report on electromagnetic waves emitting from its iPhone 12 models. That's after French regulators raised the issue last week on finding the devices release more radiation than permitted under European standards. Apple plans to update the iPhone 12, which is already being phased out, but says the issue is not a safety concern. Coming up next, senior U.S. and Chinese officials discuss a possible meeting of their 2 presidents later in the year. This, of course, as tensions continue to simmer between the 2 sides after a series of high-level meetings. Details of the talks in Malta are next. This is Bloomberg.
what we have observed is that larger asset management firms, but also private banks or just general financial institutions have established themselves here in ADGM.
Abu Dhabi gives us capital access, but it also gives us talent access and market access.
So we have access to the private sector, to the public sector, to the policy makers.
This is Daybreak Asia. I'm Annabelle Drulis here with the check on markets. We're 30 minutes out now from the opens for Seoul and Sydney. Tokyo shut today for a public holiday. But ahead of that, we're taking a look at how futures are coming online. And broadly, we are looking set for weaker trading throughout the session today. Sydney futures pointing to a drop of 0.6% and Kiwi stocks already online in the red. That does follow the lead-in that we had from the Wall Street session on Friday, where we saw stocks ending on a downbeat note, but also ahead of what is going to be a very pivotal week for central bank action over the coming days, and focus really very much on the Fed, leading that with most economists predicting it to stay on hold. But let's change on because, yes, the equity moves are one, but also taking a look at what's happening in the currency space this morning. So Japan, as I said, is shut for a public holiday, but keeping an eye still on the Japanese yen, trading around a fresh year-to-date low against the greenback this morning. The BOJ, another central bank in focus. And again, we had seen a lot of agitation that perhaps policymakers would look to signal a possible shift out of negative rates. Policymakers now pushing back on that, but little to say why we won't see 150 toward the end of this week ahead of that meeting. Otherwise, the big focus on the offshore yuan as well as we get the session underway. Given that we don't have a lot of data today coming out, more focus looking to be on the yuan fix. And we have seen policymakers in China as well really pushing back on that currency weakness there with those stronger than expected fixings coming through. And so if we do see that again today in the session, it could be a positive factor for its larger trading partners, Korea, Taiwan. We'll see how those currencies trade throughout the session, but also there's more commodity-linked ones like the Aussie, Sherry and the Kiwi dollar.
Right, Belle, let's now turn to the latest geopolitical headlines. A possible November meeting between Presidents Biden and Xi Jinping was on the agenda when senior U.S. and Chinese officials met over the weekend in Malta. For more, let's bring in our chief North Asia correspondent, Stephen Engel, in Hong Kong. Stephen, of course, this was a meeting between Jake Sullivan and Wang Yi. How significant was the meeting?
Well, they hadn't met in person since May, so it was significant in that sense. And obviously, they have a lot of issues to discuss, whether it is the war in Ukraine as well as Taiwan, and also that potential meeting in San Francisco in November that both sides, I believe, are working behind the scenes to lay the groundwork for. And that means having channels of communication open between the likes of the National Security Advisor, Jake Sullivan, as well as the foreign minister and top Chinese diplomat, obviously, Wang Yi, as you see on the right of your screen here. They did meet over the weekend and talks wrapped up yesterday. No definitive answer on whether Xi and Biden will meet in San Francisco on the sidelines of the APEC meeting. But again, they're talking and they're meeting face to face in, of all places, Malta in the Mediterranean. But still, it comes as Wang Yi is on his way to Moscow as well. He's going to have talks in Moscow with his counterpart, Sergei Lavrov. That is something Jake Sullivan expressed to Wang Yi, concern, obviously, given Beijing's support of Moscow amid the war in Ukraine. This at a time when other world leaders are heading to New York for the United Nations General Assembly, obviously a meeting that both Wang Yi and President Xi Jinping will skip. So this was an important halfway point, I guess, if you will, between that May meeting between Sullivan and Wang Yi and a potential Xi-Biden meeting at APEC in San Francisco. So not a lot was, I guess, achieved. They both reiterated their stances on Taiwan. Obviously, the United States reiterated its concern about Beijing's support of Moscow amid that war in Ukraine. But again, they're talking, and that is always a good thing.
Meanwhile, back in China, Premier Li Qiang met with the visiting Malaysian Prime Minister Anwar Ibrahim. Did we get anything from that meeting?
You know, it was hard to say that there was a lot that came out of that. This is on the sidelines of the China-ASEAN summit in Nanning in southwestern China. Anwar Ibrahim, the Prime Minister of Malaysia, is there. And no doubt Li Qiang, the Premier of China, tried to sell him more on the Belt and Road Initiative as we come up on the anniversary of that as well, coming up in the autumn, where they're going to have the big conference in Beijing on the Belt and Road Initiative. And of course, it's had some fits and starts and allegations of debt diplomacy by the West, obviously. But again, according to the Chinese readout, the Li Qiang, the premier, sold and said basically to Anwar Ibrahim that Malaysia is a good partner for the Belt and Road, and also says there's other areas of cooperation, including in the digital economy as well as energy and automobiles. So not a lot, really, that came out of that readouts from either side.
Bloomberg's chief North Asia correspondent Stephen Angle there with the latest. Well, German Foreign Minister Annalena Baerbock says that the European Union must reduce its reliance on China. She told Bloomberg's Anne-Marie Hordern about how the region's strategy has changed amid the global fallout from the war in Ukraine.
We have learned our lessons from our Russian dependencies. And again, I believe it's a strength if you can be also in politics self-reflective of saying, okay, this was obviously not the right way to go. We had such a high dependence on Russian gas and oil, but especially gas, that obviously in the past former governments took decisions which weren't the right one. Speaking about the gas pipeline Nord Stream 1 as a purely economic thing, nothing to do with geopolitics, and I was in opposition back then, and I was also at the Yamal Peninsula, for example, where there was a source of this pipeline coming through. I spoke to many people there, and I could not only feel from our partners in Poland and the Baltics, but also there that this has obviously a geopolitical dimension. So before election, I was always arguing we have to not only trust on words, but we have to see the action. And now, when we came in government, we said already in our coalition treaty that we have to rephrase our dependencies. We formulated also before the Russian war that we will do a new China strategy, and after the invasion, the full invasion, we not only wrote the strategy, but we prepared for the things we should change in the future. And this is like limiting.
Are you worried about Chinese retaliation?
Yes. So first of all, understanding that if you're bound too closely, it can endanger yourself, especially if you are having such a high dependency of a regime like in Russia, which is in the end attacking your own peace order. So therefore, cutting down our dependency from Russia, but also now with regard to China, de-risking is our total understanding of the strategy. No decoupling, because you cannot decouple in an interconnected world, and a connected world is also way to peace. But we should be able to defend ourselves, not being naive, and so being a partner in climate issues, being a competitor, obviously, with China with new technology, but also seeing that we are systematic rivals, and we have to protect our own vulnerability. And this is where von der Leyen comes in, the Commission President, to strengthen our critical infrastructure in Europe, but also looking at outbound investment screenings.
German Foreign Minister Annalena Baerbock speaking to Bloomberg's Anne-Marie Hordern. Now, Chinese property developer Country Garden is facing two key debt tests on Monday. One released a dollar bond and the other to a yuan note. Let's get more from Bloomberg's Shanghai Bureau Chief Charlie Zhu. Charlie, so walk us through the latest on this developer.
Yeah, Country Garden, as mentioned, is dealing with a snowballing financial crisis. The company's creditors are going to vote on a company proposal to delay a yuan note by 3 years, and the deadline is today. They've delayed it like twice, and today will be the third time. And at the same time, they are also facing the deadline to pay interest coupon, on a dollar dollar bond. So the company is sitting on a massive pile of debts, totaling more than 1 trillion yuan, and a lot of them are maturing over the next 6 months. So we don't know whether how creditors will respond to the proposal of the yuan note. If it defaults, it will be more ugly probably than Evergrande, which is is already has already defaulted. Country Garden has like 4 times as many projects as the Evergrande. So a default will be definitely sending shockwaves through the whole industry.
Speaking of Evergrande, things are getting quite interesting there too. Are there criminal implications involved?
Yeah, so that's just another twist in the saga involving Evergrande. What we heard is Shenzhen police put out a statement over the weekend saying they have detained several employees of Evergrande Wealth, which is a unit of the developer. We don't know how many people were detained or the reasons behind it. What we know is one of the detainees is surnamed Du, and that's also the family name of the head of the unit. The company is facing a liquidity crunch. Back on August 31st, Evergrande said they have problem repaying investment products maturing this month. And back in 2021, Evergrande unit, we know they have defaulted on like 40 billion yuan worth of investment products, triggering a nationwide protest. The company, has said that 70,000 people have bought into the products, and many of them are employees.
Of course, Evergrande has been really at the center of this property crisis. What's going on in the real estate sector right now? As we have talked about Country Garden, we continue to see these challenges with Evergrande. What's next? Yeah, the government recently have taken a series of measures to prop up demand, including lower, the purchase threshold in major cities, and there are some evidence that investor interest has picking up a little bit. Project sales are improving, but however, we don't know how sustainable this ongoing rally will be. All eyes are on the next 2 months of sales. Traditionally a good season for property sales. Having said that, China's property industry is facing some serious structural issues, including a falling demographic birth rate, a shrinking population, and also facing a lot of uncertainties about household income. And on the other hand, supply is huge. According to a recent Goldman Sachs report, there is like 27 trillion yuan worth of inventories, and it would take 5 years to clear the excess stockpile.
Bloomberg's Charlie Zhu there. Well, coming up next, we get a preview of BOJ's policy meeting this week as investors try to read these signals from Governor Ueda. The former Assistant Governor Kazuo Moma joins us next. This is Bloomberg.
Die Welt zu einem besseren Ort zu machen, das treibt uns Menschen an. Ob im Beruf, in unserem Zuhause, dem Auto oder auch beim Kaffee am Morgen. Wir möchten unser Leben verbessern. Es geht dabei nicht nur um uns selbst, sondern um alle, die uns wichtig sind. Und genau das treibt uns bei Bayer an. Unser Ziel? Health for all and hunger for none. Mit Hilfe der Wissenschaft kämpfen wir gegen lebensbedrohende Krankheiten. Wir wollen, dass alle in eigener Verantwortung mit ihrer Gesundheit umgehen können. Wir wollen eine Landwirtschaft, die alle ernährt und dennoch die Erde schützt. Wir wollen, dass jeder Mensch die Chance auf ein besseres Leben hat. In einer Welt, die wir mit Stolz an nachfolgende Generationen weitergeben können.
3 major central banks are in focus this week as they chart the course of their monetary policy. Starting with the Fed on Wednesday, policymakers are expected to keep rates on hold while keeping further tightening on the table. still. The BOE is seen raising rates by a quarter percentage point the next day, and the Bank of Japan takes centre stage on Friday. Investors watching policy signals from Governor Kazuo Ueda. Sherry.
In fact, we're watching the comments from the governor last week because traders seized that as a potential end to negative rates if certain conditions were met. And within a day, we actually saw pricing in the bond markets indicating expectations of a hike by January. Our next guest thinks that the BOJ will keep policy on hold this week, but is watching comments around the inflation very closely. Kazuo Moma is a former assistant governor at the Bank of Japan and now executive economist at Mizuho Research and Technologies. Kazuo, great to have you with us. So if we're not expecting a change, what sort of comments are we expecting around price pressures in the country?
Well, thank you very much for having me in the first place. Actually, Mr. Ueda, about 10 days ago, alluded to the possibility that if data and information have been accumulated enough, he will not rule out the possibility that he will raise interest rates from negative territory to somewhere in the policy to be zero. But at the same time, whether that condition is met is a very big if. What the BOJ is still paying attention to is the wage negotiation next spring, because the internal dynamics between price and wages will be increasingly important in terms of assessing the formulation of monetary policy going forward. So the next spring will be very important. So continued price pressures and also encouraging profitability and also very good sanguine mood in the business leaders. I think those conditions will be very important going forward for the rest of this year to judge that whether BOJ will really go ahead with the some major shift in the policies by the end of this year or early next year. So I'm looking forward to any indication or any policy information change, communication change from the government, from the BOJ at the conference with the Ueda after the meeting on Friday.
What are the risks for the Japanese yen depending on that communication?
Well, I think the BOJ will be extremely careful not to invite any unnecessary momentum for the weaker yen, because the government obviously is not comfortable with the current level of the yen, and they are very careful about not to create any further momentum toward the weaker yen. So I think the BOJ, including, of course, Mr. Ueda, governor, will be very careful in terms of the communication about the yen exchange rate going forward.
How fragile is reflationary sentiment given the sluggish growth we've seen on wages and some of the disappointing data when it comes to household spending?
Yes, actually, price are rising. Inflation is actually 40-year high, running at a pace even faster than what the BOJ predicted earlier this year. But actually, because of that, household expenditure are very constrained. Even after the reopening of the economy, after the COVID-19 is over, still the consumers are relatively cautious about spending more. So still the level of consumption is still below the COVID-19 level, pre-COVID-19 level. So I think that is one area that BOJ is concerned about, how to create more vigorous domestic demand to overcome any uncertainty from the global economy is the key issue to judge sustainability of the economic recovery and therefore more favorable inflation environment.
You talk about the uncertainties with the global economy. How much of that impact is obviously going to be the divergence with what the Fed does, but also how much of that comes from the growing uncertainty over China from the demand side for economies like Japan's?
Well, both elements are very important in terms of the uncertainty posed to Japan's economy. First of all, United States is the largest economy, and we are still very close relationship in terms of economy. So once the U.S. gets into recession, that will certainly affect export environment and profitability of major corporations in Japan. And on the other hand, if the U.S. economy continue to expand rapidly, that could create an environment where the yen could be weakening further. So in either case, I think there are a lot of uncertainty about the environment surrounding Japan's economic policy and particularly monetary policy. And China, as you mentioned, is also another major element of uncertainty. The actually export of Japan, 20% of export of Japan goes to China. And also, even without any problem in China, we still have a lot of the geopolitical tension. So I think any development going forward in China will be a very important element for the BOJ to judge about that.
Because also, if we're not expecting any change to come from the BOJ until next year in the spring, what are the implications for the bond market? Because for the longest time, we've talked about how distorted it's been, and what would be the implications for the global bond markets once the BOJ moves?
Well, that is a very good question. First of all, we don't know yet to what extent the bond yield goes up in Japan and ultimately, even though the BOJ finally decides to abandon the YCC yield curve control, my best case is the next spring and also terminate negative interest rate. Still, beyond that, how much BOJ can raise interest rates really depends on the inflationary development going forward 2024, 2025. And my judgment is that what is known as neutral interest rate in Japan has been a negative territory. So even though the neutral rate goes up significantly, still it could be very low at the positive range. So it all depends on the situation going after. And the implication for the bond market in the global, well, I don't think that would be a very big shift in the global environment in terms of the bond pricing. I think Federal Reserve impact is much more important in terms of global market.
Kazuo Momo, Executive Economist for Mizuho Research and Technologies and a former BOJ Assistant Governor. Always great to chat with you on BOJ Week. And you can catch Japan Ahead every week. That's every Monday at 8:40 a.m. if you're watching in Tokyo. That's 7:40 p.m. Sunday evening in New York. This is Bloomberg.
Welcome back. Here are some of the top geopolitical stories that we're watching. South Korea has condemned military cooperation between North Korea and Russia. President Yoon Suk-yeol says the alliance violates international sanctions, and he plans to raise the issue at the UN this week. Russian President Vladimir Putin met last week with North Korean leader Kim Jong-un in Vladivostok. The Kremlin insists no military agreements were signed during Kim's visit. Brazil has called on rich nations to pay for the world's transition to sustainable energy. Its energy minister says developing countries cannot finance an energy transition like Europe and the U.S. Brasilia has been calling on developed nations to follow through on their climate financing pledges, which currently fall short of the trillions of dollars needed. Heidi.
Let's take a look at how we're setting up when it comes to Asian markets. Coming online in just about 5 minutes or so. We are looking pretty muted there, given we didn't have a terribly strong lead on Wall Street on Friday with the tech-led declines. We also saw a gauge of US-listed Chinese stocks lower as well, which doesn't bode well for the Hong Kong and Greater China Open. Not to mention, we do have Japanese markets closed this Monday as well for a public holiday. All of this as we embark on what is going to be a central bank heavy week with everything from the Fed to the BOJ to the BOE all weighing in there. We are seeing Sydney futures off by just about 0.5%. Off those session lows, though, I should say. Kiwi stocks are just modestly on the downside. We are looking at S&P futures looking like we could see a little bit more optimism there. Watching dollar yen as we head into that Bank of Japan decision into the end of the week. What that policy divergence between the US and Japan kind of looks like by them will be key. We are seeing just sitting under that 148 handle there. Broadly speaking, though, it is looking like really risk off as we get into the start of cash trading. We also had derivatives contracts tied to stocks indexes, options and futures expiring on Friday. So we did see that rollover of existing positions or the commencements of new positions, as well as that benchmark rebalancing as well. So there is a lot in the fray when it comes to what investors are contending with. The market opens in Sydney and Seoul are next. This is Bloomberg.
This is Daybreak Asia. We're counting down to Asia's major market opens. In an action-packed week in terms of central bank decisions, we do have policy decisions from the likes of the Fed, the BOJ, and BOE, just to name a few.
Yeah, you can't really blame investors perhaps for feeling a little bit cautious going into the start of this week, given we've got so many other things at play as well. A new RBA governor starting today. We also have, labour unrest and organisation with the unions, be it you talk about, the impact on natural gas or the impact on the auto sector. Let's get you to Belle for a look at how all of this is coming together for the start of trading.
Thanks, Heidi. Sherry, yeah, a lot of things for investors to be weighing as we approach the opens here for Japan, or rather Japan shut today, but South Korea and Australia coming online. So no trading in Tokyo, no start of cash trading for cash treasuries either. Now, the start of the day here, we can expect something fairly downbeat throughout the session. That's the last close from Friday that you're seeing for the Kospi there. We'll wait for live pricing on this one. But we did have Wall Street ending the week on a downbeat note. And then there's that general level of uncertainty as well. As you said, Sherry, it really is this 36-hour window where it's the central bank's bonanza really kicking off with the Fed on Wednesday. No changes expected in terms of the key rate, but still we do have a lot of policymakers guiding to stay on hold, and economists as well expecting that. But a host of other central banks in focus, and in Asia, it is the Philippines, Indonesia, and then ending the week on Friday with the Bank of Japan. Again, question marks of whether it's going to start to signal any sort of exit away from negative rates. But the Fed, the cues that policymakers are going to be taking from there could really set the direction and the tone for markets through the end of the year. So that's the live pricing that we're starting to see now for the Kospi and then the Kosdaq, the tech-heavy index. And we did see big tech leading the losses in the U.S. session on Friday. The Korean won there, a key watch as well. We are seeing a little bit of weakness coming through in the currency, but still it has been one of the bigger gainers over the past few sessions, given that stronger than expected yuan fix from China. Let's change on, take a look at what's happening in Australia at the start of trade here, because, again, it is that central bank focus, but here on a new governor taking the helm at the RBA. So this is Michelle Bullock, and she is seen as really a continuity person from Phil Lowe, but she is as well a point of difference from Phil Lowe, really being counted on to shore up the RBA's credibility, because this hit a low point during Lowe's tenure. When his forward guidance that interest rates were unlikely to rise before 2024, and that was clearly proved incorrect. So Bullock, she's someone who's been described as a very effective communicator, and those skills, of course, set to be tested. But we do have the ASX 200 fairly flat as we come online. Still watching Brent crude, and you're seeing further gains here at the outset. Very modest ones, but still we're coming off 3 straight weeks of moves higher. It is still that market that's really assessing those production cuts from Saudi Arabia and also from Russia, Sherry.
Right, Belle. Our next guest thinks U.S. equities are heading into a bull market with the earnings recession now behind us. Let's discuss the implications for Asian markets with Mark Matthews, Head of Asia Research at Julius Baer. Mark, always great to have you with us. So you think that this is actually a bull market that we're already seeing. Is that why you're overweight U.S. equities, and what are the implications of the Fed potentially staying higher for longer?
We're overweight U.S. equities because they have a much higher return on equity than equities in most other places in the world. And I'm not American, but I'll say that Americans work harder. It's not because they want to, but they only get 8 paid holidays per year. Canada, where I'm from, we get 29 paid holidays per year, etc. And then you've got, I think, the fact that the technology sector is a third of the index and just kicks off these massive cash flows and is highly scalable. And that cash, by the way, on their balance sheets makes them, in fact, earnings accretive in a higher rate environment because they're now getting, 5% in that cash. Apple has $60 billion in net cash on its balance sheet. But as to the bull market, which started in June, that's when the S&P rose 20% from its low in October last year. Yes, we do think it continues. The earnings will be, the consensus thinks, around flat in the third quarter. But if you exclude energy, where earnings are forecast to be down 40%, then for S&P X Energy, it'll probably be up about 3.5% to 5% year on year, and that'll be the first positive earnings reading in 3 quarters. Next year, we're looking for earnings growth for the S&P of about 8 to 10%. And so with that backdrop, I think markets can go higher.
Mark, getting back to your point about U.S. labor conditions, I guess there's a reason why we continue to see this United Auto Workers strike. Given the risks in the U.S. economy, whether it's a potential of this labor negotiation to drag or a potential even government shutdown as soon as next month, are you concerned at all that it might dent consumer sentiment further?
I'm not. I mean, I'm very sympathetic to those auto workers, but I would note the UAW and the three car companies already started talking on Saturday, so the standoff didn't last for very long. And in terms of dealer inventories, I think the average is, oh, gee, now I can't remember, but it's easily over 30 days. And so, no, I take that back. It's more like 2 months. And so unless this drags on for 2 months, I really don't think you're going to see a disruption in consumption. And so if you look at the quits rate, according to the JOLTS labor reading, it's actually been decelerating, which means there's less people leaving the workforce. Intuitively, therefore, less more supply of people should mean that I think the labor force remains, we're not going to get, a big wage spiral. At the same time, I don't think we're going to get higher unemployment. It's in a nice place right now.
That's interesting, Mark. So do you think that the kind of peak window of opportunity for labour and union organisation and negotiation has perhaps peaked? Because we have seen, spots of it, whether it be automakers, whether it be the ongoing, LNG workers striking at Chevron as well. Is that really not a, I guess, significant element when you take a look at upside inflation risks?
Well, I think it is, in the sense that baby boomers are retiring, and you've got this entire cohort of people in their 20s who mysteriously have stopped working. So there is a structural dynamic to what's going on. And on top of that, we have the election next year. Michigan is a swing state. Right now, it's erring on the side of the Democrats, but you never know. So I think that the federal government would be sympathetic to trying to help those workers get some increases in their wages. And the car companies have pledged to increase the wages by 20%. That's about half as much as what the workers want over the next 4 years. But still, it's something. It's better than nothing.
You talk about a structural dynamic, and I've got to ask for your views about China at the moment. We've seen these sort of, 200 plus tidbits of policy support. It may stabilise the property sector. What do you make of the structural challenges going forward?
Well, I look at it very simply in that the government feels there's a big mess, they have to clean it up, and if they don't do it now, it's just going to be out there waiting to be done. And so they're attacking all these various problems in the economy, and the property one happens to be the biggest one because it is a third of GDP, and in no country should property be a third of GDP. So they're right to want to address it, but it does mean a very painful process of rebalancing, and I don't know how many years that takes, but could take several more years. And meanwhile, property prices will continue to go down. They're 3 times GDP. And that's too high. So I think if property prices go down, people feel less wealthy, they consume and invest less, and it all becomes self-fulfilling. So hard to see light at the end of the tunnel, but the only good thing I can say is it kind of had to be done. They couldn't run their economy like this forever with all of these inefficiencies that had been built into it over time. So I think we will look back 5 years from now and be glad they did it, but right now it's very painful.
I'm glad that you say 5 years is kind of the window of pain that we're going to see in the medium term. But Mark, I guess that means you probably don't think valuations in China are appealing at this point. I know that you overweight the US. Do you like anything in Asia? Do you believe that this time it's a different story in Japan? Do you kind of believe in India at least partially kind of taking the helm for faster growth while China is sorting its issues out?
Well, Heidi, just to address the first part of your question, valuations in China are incredibly appealing, but unfortunately it is probably a value trap. So we do like Japan and India. Both of those markets, interestingly, are breaking out technically. Japan has the yen in its favor, down 50%, making it extremely competitive. Big buybacks going on across the big caps, which should continue because cash is half of the assets on companies' balance sheets. Incredibly lazy balance sheets for the last 20 years because they didn't do any investment or buybacks or increased dividends. Now they are. And then India, I think the story is just really everything is working out very well there. Now the banks have written off all their bad loans, so they've started to lend. There's a capex cycle. Capacity utilization 80%. The corporate sector needs to borrow. People are becoming wealthier as the technology sector becomes bigger, and they've put in a big physical infrastructure. A lot of people don't realize this. The highways are good. The airports are good. Wasn't that way before. So they actually are in a perfect position to benefit from the rejigging of global supply chains. A lot of manufacturing is moving into India now. That has big repercussions, by the way, for their current account, which I believe will go into surplus and should mean their currency doesn't weaken structurally the way it has in the past.
Mark Matthews, head of Asia research at Julius Baer, with his calls on Asia markets. Thank you. Of course, we're just a few minutes into the trading session in Korea and Australia. Let's see what's moving with Annabelle. Bell.
Thanks, Sherry. Yeah, as you said, 10 minutes into the session, Japan is shut today for a public holiday. So we're taking a look at that index for Asia, excluding the stocks there in Tokyo. But it has been pretty subdued trading so far throughout the session. There's just a couple of different themes that are starting to develop. Firstly, we had seen energy stocks moving higher at the start, and we can get to more of those movers in just a moment. But materials are now starting to take more centre stage, but still only modest gains, up to 0.2%. That did build onto the gains, though, that came through on the Friday session. So it does seem at least some investors from the materials sector are still looking at a lot of these growth signals in China more positively. But let's change on and take a look at the energy stocks in particular, because we did just have Brent crude likewise coming online. We're still seeing some modest gains here, but Brent crude building into gains for a third straight week. So oil is still holding around a 10-month high as the market continues to digest those output cuts from Russia and Saudi Arabia. The question, of course, becomes whether when you have higher commodity prices, how much that feeds into the inflation outlook ahead of some very key central bank decisions later this week. But at least if you take a look in the bond space, bond markets are still quite sceptical that oil rally is going to have major implications for inflation. And that's because perhaps there's an appreciation that Saudi Arabia and Russia can quite readily unwind their current ad hoc output reductions. Heidi.
Well, still ahead, credit sites gives us their outlook on China's ailing property sector as Country Garden faces 2 more debt tests today. But before that, the auto strike continues, as Sherry mentioned earlier. In the US, workers rejecting a pay rise proposal will get reaction from the Republican presidential candidate, Mike Pence. This is Bloomberg.
Wall Street is waking up. Europe is already trading. And starting today, Manus Cranny and Danny Berger will make sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, premiering today only on Bloomberg.
Auto workers in the US are continuing to strike against Ford, General Motors and Stellantis as the UAW union seeks a dramatic reset of wage scales and working conditions. Bloomberg's global business editor currently joins us now. So it appears that the sides are quite far apart at this point.
There's a huge gulf between them as we start off the week. So let's step back for a second. What the UAW has asked for is a 36% pay rise and a 32-hour 4-day work week. That's unheard of, Heidi, in American manufacturing. And over the weekend, Stellantis came back to them with a 21% pay increase. We've seen GM come to them with 20%. And we can infer from comments from UAW President Shawn Fain, who said that that was a no-go for Stellantis. And Stellantis said it was disappointed. It said it thought that was a compelling offer. So where we're standing right now, we're really at an impasse. And these are negotiations that could be worth billions of dollars. And we're going to wait to see where they go.
Do we have any idea at this point how long the strike might last then? And if it continues and drags, what comes next?
Well, this is really hard to predict, of course. Analysts have said that it could go through the end of October, but let's look at the risks. If the UAW succeeds, they could that could boost prices for labor costs, for the automakers by billions of dollars potentially. And if they do not succeed, then that could hamper their efforts to expand. And so we're looking at really severe consequences for both sides. But the important thing to note is also that this is happening in Michigan, and it's happening as we go into a presidential election. President Joe Biden himself has thrown his support behind the UAW. He has called himself the most labor-friendly president ever. And Rep. Debbie Dingell of Michigan has said that this presidential politics has no place in these negotiations. But given that context, that's going to be easier said than done.
Bloomberg's Karen Lee there joining us from Sydney. And in fact, let's hear from former U.S. Vice President and current Republican presidential candidate Mike Pence, blaming the strikes on the Biden administration. He says the White House's EV push has only put pressure on the auto industry.
What I'm hearing around the country is that auto workers are very concerned about Joe Biden's Green New Deal, heavy-handed effort to use taxpayer dollars to drive these automotive companies into electric vehicle production. I mean, you got 145,000 workers out there many of them built a lifetime making gasoline-powered cars, and suddenly they see Joe Biden and liberal Democrats pushing down this electric vehicle agenda. You see states like California that are saying, at the end of the decade, they're not even going to let you sell a gasoline-powered vehicle in the state. I think that's also driving this. So the backdrop of the failed policies of the Biden administration, plus the heavy-handed effort with their Green New Deal to use taxpayer dollars to drive these companies away from the traditional manufacturing that so many UAW workers have made it in. I think that's what brought us to today.
Well, let's talk a little bit more about what Shawn Fain and his union members are saying. They're trying to play catch-up, they say, with a massive gap between worker pay and executive pay. He said we're tired of living off the scraps left by millionaire executives. When it comes to wages, you opposed raising the minimum wage in 2007 as a congressman. At that time, I believe it was $5.15. They wanted to raise it, and I believe did, to $7.25 at the time. And as governor, you blocked an effort that would have had local municipalities essentially demand higher wages from some companies. I know that's actually in line with your politics. So I guess I would ask you here, how should they be catching up? If wages kept par with profit growth over the last 2 decades, would these workers be in the same spot?
Well, let's be clear. I mean, I believe in free market economics. I mean, free enterprise has created the most prosperous nation the world has ever known. We have to preserve that. And minimum wage debates that always came up back in my day in Congress and even when I was governor. I mean, you looked around the state of Indiana, you look at labor shortages today, nobody's making minimum wage. I mean, the marketplace is paying out a higher number all across the country with very few exceptions. But I think you put your finger on it, Joe. I think what's happening with this strike, and I'm glad it only affects 13,000 workers so far. Because if all these 145,000 workers go on strike, that's going to have an enormous impact on an economy that's already struggling and is literally on the verge of a recession. And but I think that rather than going back to the same rhetoric about closing the gap between the executives and others, we'll hear that more. We just heard that from President Biden, is to recognize that under Biden's economic policies, wages have not been keeping up with inflation. And hardworking Americans out in the heartland know that.
That was a Republican presidential hopeful Mike Pence speaking with Bloomberg Balance of Power host Joe Matthew. Much more to come here on Daybreak Asia. This is Bloomberg.
We empower those who act, those who manage risk by anticipating each movement. Identify the goal, match power with precision, reach new heights. CME Group, where risk meets opportunity.
The world's oil refiners are struggling to make enough diesel, a shortfall set to inflate prices of the fuel that powers much of global industry and transport. Energy reporter Steven Stupczynski joins us now with the latest. Steven, is this to do with the crude production shortfall that we're expecting later in the year, and how detrimental is this to diesel supply?
Yeah, you know, this is definitely more of a supply situation than it is demand. Supply is being hit for a number of reasons, right? There have been refineries over the last few months because of the hotter than normal summer weather. They've been having to run at lower rates. Meanwhile, on top of that, you have some refineries looking at, hey, we don't want to produce diesel, we want to produce gasoline, which is the consumer, you know, regular consumers use that for their vehicles, because there was a much stronger rebound in demand there. Now, because of that, diesel supply and storage has been pretty tight. And then there is a layer of Saudi Arabia and Russia on top of that. Earlier this month, Saudi Arabia and Russia said that they were going to continue their cut of 1 million barrels per day of crude oil through the end of the year. Now, the crude that comes out of those two countries are diesel rich, which means that there are a few alternatives for refineries to go to. Not all crude is equal, and when you remove that crude from the market, that makes it very difficult for refineries to produce diesel going forward. So all those things together are pointing to when demand rises for diesel later this year, you're going to be in a much tighter situation. That's being reflected in prices. U.S. diesel prices are at a seasonal record high.
Stephen, what does this tell us about the energy transition, or are there implications for the transition?
You know, you could argue that when the world is transitioning to EVs, there's less interest to invest in refineries. In fact, across much of the developed world, you're already seeing some refiners, you know, roll back the facilities in the United States, Europe, even in Japan, and they're not upgrading their facilities either, because why would you do that if you're going to be in the middle of the energy transition, switching to things that don't need diesel? Why invest in that? And so we're in this weird middle period where there aren't enough EVs out there, and there still is strong demand for diesel. So there's this mismatch between both the supply and the demand. And that's going to continue not just for diesel, but that could be something for gasoline and other refined products for oil, as companies try to struggle with, okay, how do we invest our money? How do we make sure that these oil products keep flowing to the market? But at the same time, how do we prepare for a future where there isn't as much demand? It's a difficult situation, and it's going to cause these sorts of crunches in the future.
Yeah, more market volatility to come, no doubt. Our energy reporter, Steven Stupczynski, there with the latest on the diesel situation. Take a look at our futures in Europe are opening up for what is a massive week when it comes to central bank decisions, including in that region, the Bank of England. But of course, we're also looking at the Fed, the Bank of Japan, as well as others. Euro Stoxx 50 futures looking pretty tepid at this point, about 0.1% low. We really saw that stock rally facing the key economic growth outlook as a major hurdle, right? German stocks have really been underperforming, in particular, lagging the sort of broader performance around the euro area into the
year end, as we've seen that backdrop in Europe and China continuing to deteriorate. DAX futures are down by just about 0.1% there as well. Watching the euro as well, given that we have had a little bit of a breather if you take a look at some of the last couple of trading sessions in the dollar, but of course the Dixie continuing to extend those gains. So much of this is going to come down to the Fed. For Asia too, Sherry.
Yeah, and take a look at the other side of the trade when it comes to the U.S. dollar. The Japanese yen, we continue to see it at around 147 against the U.S. dollar. This, of course, after hitting that November low. The big decision this week is on Friday from the Bank of Japan. Not necessarily any changes expected on policy, but we'll be watching commentary from Governor Ueda around inflation. Now, we're seeing weakness when it comes to the Korean won, 13.28, extending those declines that we saw on the Friday session. Although we did see a weekly gain, it's really to do with falls in equity pricing in the KOSPI and the KOSDAQ as we continue to see overseas investors cutting their holdings. Aussie and Kiwi not really doing much either. Coming up next, U.S. and Chinese officials discuss a possible meeting of Presidents Biden and Xi. Details ahead. This is Bloomberg. Breaking news out of Singapore, we are getting the non-oil domestic exports year-on-year, a contraction of much bigger than expected than economists in the month of August of 20.1%. Really almost at the same level as the previous month, and even the previous month's contraction has been revised slightly downwards. Now, this would mark the 11th month year-on-year that we're seeing this contraction in NODX for Singapore, a heavily exposed market to the global economy. NODX, when it comes to the month-on-month number, is also a contraction of 3.8%. The expectation was for the number to turn positive. That did not happen. Now, electronic exports year-on-year, a contraction, again, double digits of 21.1%. We're talking of double-digit contraction for electronic exports from Singapore for the past 10 months already. Well, it's not necessarily just about Singapore. All other trading partners have seen double-digit declines in shipments, including South Korea, that of course is heavily exposed to equipment exports as well. But the numbers do not paint a pretty picture for Singapore, with a bigger contraction on non-oil domestic exports year-on-year of 20.1%. Let's see how we're setting up for the broader market trading day. Belle, what are you seeing?
Thanks, Sherry. Yeah, we're keeping an eye on what's happening in the energy space here at the start of trade here, because we're seeing Brent crude continue to build on those gains. So 3 straight weeks to the upside here, again, just modestly higher as we get underway. But it tells us that the market is still really digesting those output cuts from Russia and Saudi Arabia. And there are calls for oil to top $100 a barrel by the end of the year. But this chart here, taking a look at net long positions for Brent and WTI, and those jumped 40,000 contracts added by hedge funds over the past few days. We're at a 15-month high here. It is quite a big reversal that we saw rather at the top or the start of the year. You see that big plummet or drawdown as the end of the first quarter, but hedge funds have certainly revised their outlook on where energy prices go from here. Now, amid those changing dynamics for the energy space, that is obviously weighing on the outlook for inflation, and the question is whether that becomes an issue for price pressures again toward the end of the year. But let's take a look at this chart here, because it's something that Garfield Reynolds has been speaking about on the MLive blog, and what he's taking a look at or watching in particular is WTI, which is the line in blue. You can see there that price climb versus what we're seeing in the 2-year break even. And essentially that's the gap between yields on regular treasuries and those that are protected or protected against inflation rather. And you can see that that's the line in orange, and that has increased at a far more modest pace there. And that is possibly due, at least in part, to the Fed's success so far of bringing down parts of the inflation complex. So certainly this is a chart to continue watching, particularly as we approach that Fed decision later this week.
But Heidi, again, it is that question, will we start to see energy prices start to weigh on the inflation outlook? Garfield saying no, but the reason partly building into that as well is that Russia, Saudi Arabia, those ad hoc output cuts, they could just as easily be reversed. This is a question or a game that's driven more by supply, not from the demand picture.
Let's take a look at China-US ties now. A possible November meeting between Presidents Biden and Xi was on the agenda when senior US and Chinese officials met over the weekend in Malta. For more, let's bring our Chief North Asia correspondent Stephen Engel in Hong Kong. So, Steve, how significant do you think this meeting was?
Significant in the fact that, of course, Jake Sullivan and Wang Yi had not met in person since May. It's significant in the sense that they're trying to at least establish better lines of communication and perhaps lay the groundwork for a meeting between Biden and Xi, who have not met in nearly a year since, of course, the G20 in Indonesia last autumn. And that could happen in San Francisco in November on the sidelines of the APEC meeting. And that's what they're laying the groundwork for. Why was it held in Malta? Well, Malta's had a very interesting place in history for these kinds of meetings. It's not as significant, of course, as the Malta Conference in the waning days of World War II in 1945 or the Malta Summit in 1989 after the fall of the Berlin Wall with Mikhail Gorbachev and George Bush Sr. But between Wang Yi and Jake Sullivan, kind of the highest level of diplomatic engagement right now between, battling superpowers, if you will. And really, the sources have told us from that meeting, they were able to talk about difficult issues like Taiwan. They were able to talk about Russia's war in Ukraine. Did they move the needle at all? Probably not. However, Jake Sullivan did press Wang Yi on his upcoming visit, which begins today to Moscow. Wang Yi is going to Moscow. He will be meeting with his counterpart there, Sergei Lavrov. Obviously, the U.S. is concerned by Beijing's support of Moscow amid the war in Ukraine. And it's also interesting because Wang Yi, as the foreign minister, will not be going to the UN General Assembly in New York, nor will Xi Jinping. So while the UN General Assembly is going on, Wang Yi is going to Moscow. So there's a lot of geopolitics going on. They met for 2 days essentially over the weekend in Malta. And again, I guess the big prize of that meeting would be laying the groundwork for a Biden-Xi meeting at APEC in San Francisco.
Steve, any more clarity on what's happening to the defense minister, Li Shangfu?
That's an interesting one because we do know that at the same time that Qin Gang, the previous foreign minister, was relieved of his duties, there was also a launch of an investigation in Beijing of military procurement, perhaps illegal military procurement by the PLA. And this man here is the defense minister, and he's a state counselor, extremely senior. He has not been seen in public in more than a couple of weeks. The United States believes that he has been removed. Other media have reported that he is under investigation for alleged corrupt practices in military procurement. But it's another interesting sign at a time when Xi Jinping supposedly put loyalists around him at the last Party Congress, that at least two senior officials, his former foreign minister and now potentially his defense minister and state counselor, Li Shangfu, have potentially been ousted.
Right. Stephen Engel, our Chief North Asia correspondent there, joining us from Hong Kong. Coming up next, almost a dozen Chinese banks risk breaking their red-hot revenue growth streak this year as Beijing taps its lenders for monetary support. We have the details ahead. This is Bloomberg. Bloomberg Intelligence says more than 10 Chinese banks, including ICBC, are at risk of breaking their years-long revenue growth streak. That's because margins could shrink more than the 18 basis points consensus expects, with fees stagnant. For more, let's bring in our senior banking and fintech analyst, Francis Chan. Francis, of course, we know the challenges that the broader Chinese economy faces, especially with the property sector continuing to see a crisis. How about the fact that monetary policy is also loose? So what are the biggest drivers of this downside?
Well, first of all, there could be lower mortgage yields from the existing mortgage books or back book, just because the Beijing may want to stimulate the consumption, want the mortgagors to pay less interest for their mortgages. That could hurt maybe banks' net interest margins. And our economists are also expecting the lower loan prime rate in the coming months in order to lower overall funding costs for the economy. All those could be some offsetting factor for the net interest margins in second half. And consensus is expecting second half margins to be very similar to first half. I disagree on this point. I think the second half margins could be coming lower than first half numbers.
What's the bad loan situation looking like, Francis?
What situation? Sorry?
Non-performing loans and special category loans.
Well, I think those will still be some lending focus for Chinese banks in the rest of the year. But obviously, now I think the Chinese government really want to pop up the very restricted property market. And many measures have been adopted to stimulate maybe property sales, but overall, at the very least, until this point of time, in August, we still see very bad contracted sales numbers from the top 100 property developers in the country. So they may still need to give more positive measures to help the economy and help the property market, I believe.
Bloomberg Intelligence Senior Banking and FinTech Analyst Francis Chan there with us. Let's take a close look at China's property problems. Despite ongoing policy support measures, our next guest sees continued stress. Sandra Chow is co-head of Asia Pacific Research at CreditSights and joins us now from Singapore. Sandra, as we face two more debt tests when it comes to Country Garden today, we're also kind of watching the sector more broadly. We've had not insignificant support measures coming through, bits and pieces, but still, do you expect cumulatively that over the next couple of months or so we could see at least some stabilisation, if not a huge improvement?
Yeah, that's a really good question. As your previous speaker was saying, the August sales were really bad for the China property sector, and all of the developers which posted increases were the state-linked developers. So we're seeing this continual split between the weaker privately owned developers, including Country Garden, as you mentioned, and the stronger state-linked developers. The easing measures have been going on for some time. So really, for several months, we've had a series of policy loosening, both at the local and the central level. The latest round didn't come in until the end of August. So I think people will be looking very closely at the September data and October to see how the pickup has taken place in the sector, if at all. And we expect markets will still remain pretty volatile because there seems to be a lot of short-term momentum trading on the back of these policy adjustments as well.
So the strategy at this point seems to be extend and hope for the best. I mean, are investors buying this? We see so much caution exemplified by, some of the recent cases that we've seen, including Sino-Ocean.
Yes, I think so. With Sino-Ocean, I think that's kind of forced investors to look very carefully at the so-called state-linked developers, because not all of them are created equal. So there are some which may have stronger state links to the central government. There may be some which have weaker state links, either to a local government or to some government-linked entities. So in Sino-Ocean's case, that would be China Life. So I think that forces investors to do their homework very carefully when it comes to the state-linked developers. I think it's going to be difficult still. It is kind of kicking the can down the road, which is good because Country Garden and other developers do need some breathing space to see if these policy measures do work. But at the end of the day, you still need investors and home buyers to have confidence in the company. And it's going to be very difficult for a brand which is viewed as distressed, such as Country Garden, to kind of instill that confidence again in home buyers and also turn around their property portfolio, because a lot of their land bank is in the lower tier cities, which are really struggling to recover compared to the first tier cities in China.
And Sandra, no relief for China Evergrande. Chinese authorities detained some of their staff. Now we're seeing some criminal implications here. What are the implications for the broader property sector? Could we see more of these investigations into some of these big developers?
I think in Evergrande's case, this one is probably an idiosyncratic event. I don't really have too much information about what was kind of going on behind the scenes and the various misdemeanors that were alleged. But I think that one is probably a company-specific case. I think in times when companies do get into distress and cash is tight, you do tend to see some of these kind of irregularities going on, perhaps as companies get desperate and management gets desperate, and things can get very messy. But I think for this Evergrande case, I would see it as relatively isolated to that company, and I wouldn't necessarily see a read-through to other companies in the sector.
And Sandra, we started the conversation on the weakness that we're seeing in property sales, especially on those August numbers. We saw those measures coming from policymakers in the month of August. So how fast can we expect them to actually be reflected in the data?
So there were some news headlines like just after the policies were announced saying that there was a surge in sales in some areas following that. Now, I don't know if that's kind of an initial pop and then we'll see that die down. But if there was that surge in sales, we would expect to see some of that coming through at least in the September data when it comes out, which will probably be reflected around the middle of October or so. So the individual companies will come out with sales figures, and then the National Bureau of Statistics will come out with the overall sector figures as well. But I think for us as analysts and investors as well, we want to see more than 1 month of progress. We want to see more than a short-term pop in the first weekend of sales. So we'll be looking for a more sustained track record of the developers managing to achieve better sales and an improvement in home buyer confidence.
And Sandra, we were just speaking to Bloomberg's Francis Chen about this ongoing pressure that we're seeing on the banking sector, of course, also to do with what's happening in China's property sector. What other areas of the Chinese economy can we expect this to actually weigh on?
There's been a lot of talk about contagion risks from the property sector. Of course, it's huge. Some people were saying it was contributing to about 1/3 of GDP before the sector went into crisis. So the obvious links are the banking sector, as you say, because they are being required to step up lending to some of the troubled companies. Local government financing vehicles, because local governments are sometimes being asked to take over some of the distressed property projects, although the funding conditions for those seem to be fairly benign at the moment. And with the recent rate cut, that could also improve the funding outlook for local government financing vehicles. So those are the most obvious linkages that we would see. And then, of course, you have the second order effect on the small and medium enterprises, all of those which continue to serve the property sector, such as the construction firms and the suppliers as well.
Sandra Chow, good to have you with us, co-head of APAC Research at Credit Sites. We have more to come on Daybreak Asia. This is Bloomberg.
Powering financial solutions that transform industries. Powering seamless execution in evolving markets. We deliver our entire global bank to power new possibilities for you. Barclays Corporate and Investment Bank, powering possible.
Wall Street is waking up. Europe is already trading. And starting today, Manus Cranny and Danny Berger will make sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, premiering today only on Bloomberg.
Chinese media outlet Financial News is reporting that the country's economic fundamentals will keep improving and providing support for the yuan as recent stimulus measures take effect. For more, let's bring in Bloomberg's executive editor for Asia markets, Paul Dobson. And Paul, of course, we saw the pop in the Chinese yuan as well as we got better than expected data. But how sustainable is this?
Well, it's obviously a good question, and there's a kind of balance to be had here, right? And I think that when you hear those commentaries saying, you know, the economic fundamentals are getting better, that should support the yuan. Part of the reason that the fundamentals are getting better is because there's some policy easing going on, which of course undermines the yuan to a certain extent. And I think for the country as a whole, there's this balance as well between a weaker currency actually being helpful and supportive for the economy, but at the same time, you know, they want to avoid that risk of capital flight or too much money pouring out of the country altogether. For the moment, we kind of seem to have hit a bit of an equilibrium. The PBOC has been using the fix very aggressively and taking a bunch of other measures, including pushing up borrowing costs offshore to stem the losses in the currency. And it does seem to have found that that modicum of stability, a kind of equilibrium for the moment.
Honestly, I can't remember the last time we focused so much on that daily fixing. It's been quite some time, but it has taken renewed kind of importance, right, when it comes to broader Asian currencies as well.
That's right. One of the things that we've been looking at is the way that they've been using the fixing, not just against the dollar itself, but against all the other currencies that are included within the basket of measuring the yuan strength. And we found that, you know, the pushback is spread out right across the spectrum there. So there's efforts to really rein in what the authorities would describe as speculative or one-way flows, you know, but to avoid that kind of downward pressure on the currency have been pretty entrenched and firm as well. And so, as you said, if they can create a little bit of appreciation pressure again for the yuan, if they can push it up a little bit, then that should have read across benefits as well for China-related currencies, thinking Taiwan dollar, which also looks like it's at some sort of a turning point, Korean won maybe, and maybe even the yen as well, which also is kind of under pressure for similar and different reasons. You know, the interest rate differential matters there as well, but it's kind of, you know, not in such a difficult state in terms of the economy as China has been sort of weathering its way through recently.
Paul, plenty of central bank decisions to watch out for this week. What would be the most consequential ones for Asian assets this week?
Great question. Is it the Fed or is it the BOJ? I think, you know, for the Western central banks, for the ECB, for the Fed, the big question is, we know higher for longer. Now it's a question of higher for how much longer, you know, so people will be looking to the dot plot to see, is there one more hike for this year coming from the Fed? How quickly could they get to cutting rates again next year? What's their projections look like? That's going to matter when we get up the morning after the Fed meeting. But really, you know, kind of the BOJ is also now in play. People are interested to know whether there's going to be any more follow through on the Wader comments that we had last weekend, which suggested that they're starting to think about that exit from negative interest rates. And if we do get more confirmation that that is coming onto the horizon, even if far off, but if you know, it's in Fed parlance, if they've starting to talk about it, then, you know, the market will latch onto them. We could see the yen start to really get some sort of recovery from these very low levels that we're seeing of late.
Paul Dobson there in Singapore. It certainly is a big week ahead for investors. Take a look at some of the stocks we're watching ahead of markets opening in Hong Kong and mainland China. Developers still in focus, of course, Country Garden facing these two further tests. It's a dollar bond and a yuan note that we're watching. Meanwhile, authorities have detained some of the staff of China Evergrande's wealth unit. The saga around the defaulted company seemingly entering a new phase. Sherry.
Heidi, take a look at how markets are trading early in the Asia session. Of course, Japan is away on holidays, but we are watching the Japanese yen as it's just hit that November low against the US dollar and is currently trading at that 147.76 level. The Korean stock markets are in the negative right now. We are seeing downside pressure from information tech, communication services as well, although the energy sector is trading in the green on the Kospi. This as we get the crude prices above $90 a barrel right now, WTI at $91 a barrel. The ASX 200 is completely in the red at the moment. We're talking about every sector in the red being led lower by, again, tech and consumer discretionary. Energy is also down. Coming up in the next hour, we'll take a look at how effective China's stimulus measures are proving in boosting
any kind of recovery. Citigroup and Triada Capital join us for that discussion shortly. Plus, Moody's Investor Service turning negative on China's property sector, the economic growth challenges dampening sales. That is it for Daybreak Asia. Our markets coverage continues. This is Bloomberg.
There's a place where global markets are always open, where you can explore and discover innovative new offerings and hundreds of trading products right at your fingertips. That's CBOE, the exchange for the world stage.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, in for Francine Lacqua. Here's what's coming up on today's program. Societe Generale slumps the most in 6 months as the CEO's first strategy update underwhelms investors. Meanwhile, oil pushes closer to $95 a barrel as OPEC Plus supply cuts squeeze the market further. Plus, stocks fall as traders stand by for a big week of central bank decisions from the U.S. to the U.K. and, of course, Japan and around the world. Let's start off the show by taking a quick look at the European markets map. You are seeing quite a bit of movement, but a little bit of red on the screen. Now, a lot of the sentiment is going to be coming from Asia. I think the real underperformer here is going to be in France. The CAC 40 really taking a hit here. That's going to make a lot of sense as we talk about which economies are going to get hit hardest by the ECB. Of course, you are seeing a pullback in the DAX as well. And of course, the FTSE 100, though, not as much action. That's going to be significant, again, as we talk about the read-through from the BOE. We hear from them later this week. But again, and the real underperformer comes from France. The Euro Stoxx 50, I should say, as a whole, down about, we'll just call it 0.3%. So that's going to be your market map for you. But look, it all comes down to central bank decisions right now. Let's take a quick look at the Federal Reserve here, because this is really going to be the tone setter for the rest of the week. Pricing already suggesting that if we do get a hike, this might just be the last one. Maybe the 2-year saga that we've had for the Federal Reserve, well, this is the end of it. And this is really what that chart is showing. At the core of the what is driving inflation? I want to bring it to my next chart. Oil and bonds. We're talking about oil hitting $100 a barrel. Does that actually spark inflation? Remember when we were just amping up the inflation story in 2021? Bond yields following the oil market tick by tick. That no longer seems to case. As we start to see oil's rally really strengthen, bond yields not following the same story. It really tells you that perhaps inflation won't be driven by the commodity story. Where will it be driven by? Wages. At the core of it seems to be the labor conversation. And it's not just about payrolls anymore. It's about the global story about just how much labor actually costs. This chart is one of my favorites here, because, of course, we are fully following the United Auto Workers strike. But take a look at this. Auto workers, essentially the backbone of Detroit's economy in the United States, the assigned auto working industry, is actually taking a way bigger hit than all of its peers in some of the manufacturing sector. That is going to change. What does that mean for the end consumer? Net, what does that mean for inflation? That's going to be a big story from the economic perspective, but also from a financial perspective. That's going to be something that, as we start to see priced into the markets, might benefit some of the banks and the way they are trading very specifically. So, again, keep your eye on what the banks really take their cue from on that, at least on the front in the U.S. front. Here in Europe, you're already seeing a little bit of mixed reaction to the banks, a lot of it coming from SocGen. Shares slumping the most in 6 months this morning as cuts to revenue and profitability targets underwhelmed investors. Let's get to Bloomberg's Caroline Conan in Paris. She is all over this story. Caroline, walk us through the strategy update from this morning.
Could you remember a few hours ago we were saying that we didn't see anything spectacular in this strategic update in terms of numbers, in terms of new targets, only very slight changes? Well, clearly, investors are also disappointed. The shares opened minus 7% for Societe Generale. Clearly not very good when it's a new CEO, Sławomir Krupa, who is presenting his next strategic update after 15 years of the previous CEO, Frédéric Oudéa. So clearly here he wanted to focus on cutting costs and limiting the risks, for example, on risks-weighted assets. But clearly that has kind of outweighed the problem that you have with the average revenue. The average revenue growth new target is between 0 and 2%. It was 3% before. This is a disappointment disappointment for investors. Also a disappointment in terms of the profitability target, with the return on tangible equity slightly lower. And finally, a disappointment on dividend payouts. The payout under the Frédéric Oudéa as CEO was 50%. Now it's between 40 and 50%. So investors are not expecting a high payout with this new CEO. Already, SocGen missed out on their 50% target last year due to the big €3 billion hit they had in Russia. SocGen was one of the most exposed bank in Russia. So a disappointment for investors. One BI analyst actually said that caution is outweighing growth hopes.
I mean, it's a really interesting dynamic, especially when SocGen is kind of lagging all of its European peers, not just its French ones. Caroline, how does it target this going forward?
Yeah, and if you look at the share price for the past 15 years under Frédéric Oudéa, they've actually lost more than 40% of their value, even if they slightly recovered. With the prospects of this new CEO, with the prospects of this new strategic plan since the lowest point this year in March. But the price-to-book ratio of SocGen is the trades at the biggest discount among European lenders. And it seems like this new strategic plan is not going to change much things, at least in the short term. One analyst is also saying that in the long term, the structural issues remain. Some other analysts are saying they wanted to see more restructuring at the investment bank. We'll see also if today, during the Capital Markets Day, which just started in London a few minutes ago, we will get more comments from Slawomir Krupa, more details, for example, on asset disposals. They've already announced the disposal of 4 units in Africa. They're reviewing another one in Tunisia. They're also reviewing the sale of their asset custodian unit. We'll see. We'll get more details to reassure investors throughout the day.
You know, Caroline, I always joke that you couldn't pay me to be a central banker. I got to say, you couldn't pay me to be at the helm of a European bank either. Caroline Conan with our update on SocGen from Paris. We thank you as always. And like I said, you can't pay me to be a central banker, yet some people still do the job. It's a massive week for central bankers this week. The Fed really takes center stage. The FOMC rate decision on Wednesday, the BOE in action on Thursday, and the BOJ on Friday. 3 different ranks, 3 different spotlights, 3 vastly different takes on the global economy. Bloomberg's Zoe Schneeweiss joins us now for more. Zoe, let's start with the Fed here. So if we're not expecting a hike, what are we expecting?
So what we're expecting is some hawkish language regarding November. Overall, as always, the dot plot here is key, and Bloomberg Economics predicts that that will actually show another rate hike in November. But it is very close. And why is it so close? Firstly, the November 1st is the next rate decision. And before that, any data we will get are likely to be very mixed, not really showing a clear indication for a hike or a hold. And what makes things matters worse is that the United Auto Workers strike and a potential government shutdown, those events won't be showing in the data. So that makes it difficult. Overall, Bloomberg Economics does think that it's going to be another hike in November, but again, a close call.
I mean, it's a really interesting dynamic, again, because off the back of the ECB decision last week, we're already getting a lot of pushback from the fiscal authorities. I believe the best example I can give is that over in Italy, Matteo Salvini said Lagarde is literally on Mars. That's how much pushback there is about the effects of these rate hikes. Let's talk about the Bank of England, Zoe. Could we start to see the same pushback against Andrew Bailey as he's expected to hike?
So Andrew Bailey himself said earlier this month that the BOE is likely to be near the peak of its hike. So 25 basis points this week is almost certain. One thing here is the BOE will want to keep open that optionality to say maybe we're at the peak, maybe not. Just because in the current situation, central banks, if they cement themselves into a position that just does not work well and that doesn't give them the flexibility, quite honestly, that they need, and central banks are data dependent, and the BOE's comments are likely to reflect that.
Again, 3 different banks, 3 very different results, I imagine, the back half of this week. Bloomberg's Zoe Schneeweiss all over that story. We thank you, as always, for joining us this morning. Coming up on the program, enough is enough. France's finance minister on the prospects of another ECB interest rate hike. We're going to bring you more from an interview with Bruno Le Maire. That coming up next. This is Bloomberg.
I always say I hope they get it right, because it's not so easy when you have so heterogeneous inflation rates around Europe. Spain, for example, has the lowest inflation rate right now at 2.4%, but other countries are proving to be much more resistant to lowering inflation. So I hope they get it right, and from the national perspective, I also hope they stop now, because our inflation rate is already quite low.
From a national perspective, what you say is a country like Spain does not need rates going above 4%. That's basically what you say.
Well, I think that this is a good summary of.
And you said two interesting things there. You said that there's a conversation about duration and the level of it. But I wonder if there was another hike, and the market does not believe that for the time being there will be another hike, but is there now a real risk that if you were to go tighter, this is now really going to send this economy into a recession? You're suffocating the European economy.
Well, again, you know, it varies very much between the different countries. We were just starting our Eurogroup meeting here, as you said, in Spain, in Galicia, in my region of origin. And what we see is that the situation of the different economies is very, very different and very heterogeneous. Again, you know, Spain is the strongest growing economy in the EU. It is projected to be the strongest growing large economy in the Eurozone next year again. The forecast is for 2.2% GDP growth year on year this year, after very strong growth in 2021 and 22. So in the case of the Spanish economy, the prospect and the forecast is quite positive. But indeed, there are some other countries that are slowing down or even having a recession, and that has an impact overall.
And yet, as a finance minister, you also know, however, you say your projections were upgraded on that. It's very fair, but when you look at the indicators, it seems there's a loss in momentum, and there is some kind of pessimistic take on the economy now, where some say we're heading into stagflation. Is that something that you say not so fast?
Well, absolutely not. I mean, when we're talking about when we're talking about 2.2 GDP growth in the case of Spain after above 5.5% last year and the previous year, I don't think that would be an accurate word, you know, to describe the situation. We're having quite resilient growth, strong growth in our economy, and inflation has gone down by 8 percentage points in 1 year. So I'd say that that would not be a good description of the Spanish economy.
Our exclusive interview there with Spain's economy minister, Nadia Calvino. She's saying the ECB is probably done with tightening, speaking there to our Bloomberg European correspondent, Maria Tadeo. Let's stick with the theme of Europe and central banks. Joining us now, Raffaella Tanconi, founder and chief economist of ADA Economics. Raffaella, a pleasure to have you on the program. Let's start with what Nadia Calvino was saying. She's not alone in simply saying that, look, we are done with the rate hikes, at least from the fiscal authorities in Europe. Is that enough pushback, do you think, against the ECB to really register?
Hi, good morning. Well, I think it's a strong signal that indeed it hurts at this level of interest rate. I don't think it really changes the ECB's trajectory. I think a December rate hike is still plausible because the labor market is going to stay resilient. But it is true that interest rates are very restrictive, and willingly or not, the ECB is going to have to cut very aggressively next year.
What would President Lagarde actually do when perhaps revisiting some of the way that the ECB targets the European economy? Because, again, it's quite clear not all is created equal. If you were President Lagarde, what would you do, Raffaella?
So I think the consequences of keeping interest rates too high for too long in the Eurozone is first of all on productivity and investment. So Lagarde has already said she expects the second half of the year to be weak, but she expects 2024 to be a rebound. If she doesn't handle the communication correctly, then the risk is that invest for 4 quarters, and that has direct consequences on productivity long term. which eventually also hurts inflation. The other issue is also on the distribution of upside. So what we see is that, of course, if you're younger, energetic, or very large company, you're doing better, and then there are a large number of companies that are not as well equipped in the transition. So there is a distributional effect, which eventually also impacts productivity and social cohesion. So if I were Lagarde, I would frankly drop this data dependency communication, which is very 1980s, frankly. And I would upgrade the communication to reflect a more candid assessment of what is the inflation challenge, which is difficult, but just let's be clear, inflation in the Eurozone is coming down. It is going to be between 2% and 3% next year. So she doesn't need to be this aggressive, right?
I mean, at least that is the take from a lot of the world leaders. I read over the weekend, I believe, from Bloomberg reporting that the leader of the league in Italy, Matteo Salvini, calling Lagarde, saying she is living on Mars. So some real fighting words from there. I want to bring you some sound from the French finance minister as well, Bruno Le Maire. Take a listen to what he had to say.
I think that we are at the right level of interest rates in the EU to stop inflation and to reduce inflation, and this is the goal of these interest rates, to reduce inflation. We are on the right track, and I think, as Christine Lagarde said, that we should stick to that level of interest rates. It is the right level to reduce inflation.
Rafael, I bring you and our global audience that sound to really just emphasize how much pushback they are getting from these fiscal governments, because this is a dynamic you see right now in the United States as well. The idea that the Federal Reserve is trying to remain hawkish while Biden administration, I would argue state governments even, are actively pushing back against that narrative. Rafael, how much of the ECB is being led by the Fed here in terms of their approach?
I think they both trying to be very hawkish right now because they're afraid to lose even more credibility in the face of the market, given that the run-up of inflation they miscalibrated. So I think they're both responding to a credibility puzzle. But that being said, I think the Fed is justified. There is a much stronger wealth effect and there's a stronger household demand today. So the Fed is correct in its stance, whereas the ECB really needs to guide the economy through this investment challenge. I mean, don't forget that the EU is trying to do green defense, nearshoring, especially recently. Eventually, we'll need to do the rebuilding of Ukraine, digital transition. All of these transitions require very careful guidance to the private sector on what is the realistic medium-term cost of capital, which is at least 100 basis points below where they are today. So I think the ECB is missing the plot in the sense that the finance minister complain, as they always do, but they also pick up a real worry that the ECB is focusing too much on inflation today and too little on inflation in the medium term.
You say the ECB is missing the plot. I wonder if the Federal Reserve is as well. Rafael, let's shift to our focus to that Fed decision on Wednesday, because often when we talk about tackling inflation, the focus shifts to commodities. And yeah, this oil rally doesn't seem to be lifting break-even pricing or bond pricing at all. In fact, it feels like the biggest inflationary pressure right now is coming from wages, from strikes. You're seeing this from the United Auto Workers and other unions across the United States and across the world as well. Talk to us about how the Fed should approach very sticky wages.
So I think realistically, the way the Fed can approach wages is to provide more analysis, guidance, and data on the granularity of the labor market, because the labor market is very diverse. And these days, the average doesn't really reflect what is going on. So when you say that average wages are rising, for example, the pay award offered in the automakers doesn't quite reflect the fact that the magnitude of the change is big, but the level of wages, especially of the less skilled workers, is so low these days that they really cannot afford to raise a family realistically in the US today. So the problem with the Fed is that to get real credibility with the broader public, it should be very realistic in saying these are the consequences. There is nothing more that they can do because it's not really credible that you will push the economy into a 2008 style recession, which is what you will need to push the unemployment rate high enough to be disinflationary. This whole decade will see the labor market very tight, wages rising. There is no way you can get out of it.
I mean, a historic moment truly around the world, especially when it comes to the labor market. Rafaela Tinconi of ADA Economics, we thank you, as always, for joining the program. Coming up, we go from monetary policy to perhaps a little bit more of what the government can do. The death toll from devastating floods in eastern Libya tops 11,000 in just one city alone. That comes as hope fade for thousands still missing.